And what do they mean by? And so the price changes which can. Everyone, welcome to the class on investments. So now this investment is when the company invests in either debt or equity instruments, how will the accounting be? So let me just explain it to you with the help of a chart for you to understand the overview of the investment accounting. Okay, so when a company invests in financial securities, they would either invest in debt instruments or equity instruments. So in other words, they might buy shares or bonds, right? So yes, so how do we account for this? If it is equity, I'll finish the equity side first and then come to debt. Okay, so if it is equity, first of all, okay, let me just put it here. I just hope that it fits in this page so that you will understand. So if it is equity, we test for significant influence. Significant influence. Meaning that if the company holds 20% of or more on the investee company's shares, of the investee company's shares, and can it exercise some influence on its operations, etc. So then it's said to be having significant influence. If it is yes, then the accounting would be equity method. I will explain this later on. If it is no, then there are two options. Is fair value determinable? Okay, fair value determinable. That means, is there a readily available fair value? In other words, are the shares quoted in the stock market? Okay, fair value determinable and fair value not determinable. Like for example, private limited companies. Fair value is not readily available there. Okay, so if fair value is determinable, okay, then it will be accounted at fair value. It will be accounted at fair value, and unrealized gains or losses. I'm using a lot of shortened forms here, so you have to pay attention to what I'm saying. So unrealized gains or losses would be accounted in net income. If fair value is not determinable, it will be accounted at cost. Okay, and then impairment losses, and visible or observable price changes would be accounted in net income. So the price changes which can be observed clearly, you would recognize that in net income. So generally, where fair value is not determinable means that it's a private limited company. If fair value is determinable, there's a stock market for it. So prices are as per the stock market. So in a private limited company, one would account it at cost, what they've spent for it. And if there is clear indication of impairment, if the profits are dropping, if there is a strong competitor in the vicinity, or who has come up with a different product which has caused losses for the company. So wherever it's very clear that impairment has taken place, impairment is recognized in the income statement. It will be a loss, of course, so impairment loss would be recognized in the income statement. And what do they mean by observable price changes? It means that suppose a new partner has entered and that particular business partner has purchased shares from the company at a much higher rate. So that means there has been a price change which the others have accounted for at the time of their purchase. So if somebody else comes in and he has paid a higher price, that means the share price has gone up, and that is clearly visible. And the company, if they have invested in such an instrument, would account it for that price change. All unrealized gains and losses would be to net income. Now, the major part here is the equity method, which will be tested. Fair value not determinable, the cost and accounted for it at cost with impairment losses, etc., are not very much tested. They would be tested in the CPA, but I did not observe much questions in the past papers, though those two students give me a feedback. So I'm not I noticed whether they have questioned the students or tested the cost concept in the exam. But when fair value is determinable, yes, they have tested, they're given questions on this. Okay, now comes the debt part. So if you have invested or the company has invested in a debt instrument like a bond, then first of all, does it have the ability and intent to hold to maturity? So if it's going to hold to maturity, if it is yes, if it is no, there is one particular accounting. If it is yes, if they are going to hold until maturity, it will be categorized as held to maturity and be accounted at amortized cost. Yes, I'm going to explain to you what is amortized cost later on. And if it is no, there are two ways of accounting for it. Then you would see, if it is no, is it a trading security? Trading securities are those which would be sold in the very near future, like a couple of hours or a couple of days. Okay, so if it is a trading security, then it would be accounted at fair value. I'll put a short form, fair value, and unrealized gains and losses, unrealized gains or losses in net income. In net income. If it is no, it will be accounted as available for sale. Now, let me explain here a little further. If the firm is going to hold it until maturity, yes, it will be accounted at amortized cost, which I will show you later. If no, it's not going to hold it until maturity, it's further classified into trading securities, which will be sold so soon or very early that it will be accounted at fair value, and unrealized gains and losses, even though they are unrealized, it's expected to be realized anytime. So that would be accounted in the net income, in the income statement, right? Because it is expected to be sold in the very short term. So the unrealized gains is as if it's as good as realized gains, and it will be shown in the income statement. If it is available for sale, that means you're not going to sell it in the very near future, nor are you going to hold it until maturity. So the company is planning to hold it for some period of time, not as short as trading securities, then it would be categorized as available for sale securities. And this would be only for debt, not for equity. So for example, if the company is planning to hold a bond for 6 months or so, or even 1 or 2 years, but before its maturity, it will sell it. It plans to sell it, then it would be accounted at fair value. And unrealized gain and losses will be accounted in other comprehensive income in the equity section. It will be accounted as other comprehensive income. So this is an overview of investment and the type and categories of different investments in equity as well as debt. Let us speak about the accounting, more about the accounting in the next session. Hello everyone, welcome to the class on investments. Now in the last session, I explained an overview of debt and equity investments. How will they be categorized and how will they be basically accounted? I did mention that it will be accounted, some of the instruments will be accounted at fair value, some at cost, some at amortized cost. So now what exactly is this? I will just explain that to you before we attack the multiple choice questions. So now, let us assume that it's an equity instrument and its fair value is readily determinable, right? So if that is fair value is readily determinable and it's an equity instrument, let us say its cost is 100. It's a share, let us say a public limited share, which is quoted in the stock market. So now you have spent, or the company has spent $100 for it. And on 31st of December, when they are going to make their financial statements, the market price for it goes to 110. So what do? We would debit the investment, by $10. But by investment, we can also debit a valuation account and credit investment income, which will go into the income statement. Okay, and this will be an unrealized gain. So, okay, let us put it as unrealized gain rather than investment income, which we would use it in the equity method. So we'll credit unrealized gain, putting short forms here, unrealized gain, which would be accounted for in the income statement. On the other hand, instead of 110, if the price goes down to 90, you would be debiting unrealized loss by by 10, because you're going to account it drop from the original price, 100 to 10. So 100 to 90. So debit unrealized loss, which would hit the income statement, and credit the investment account, which can be a valuation account. So I'll put valuation account in the brackets, 10. So in the first case, when you're accounting it in the balance sheet, you have an investment, maybe an ABC company investment at $100, a valuation account at $10, since we have debited it. And please bear in mind that all these investments would be on the asset side of the balance sheet. The company is investing in other companies. So the carrying amount would be 110. And in this case, in the balance sheet, the investment, if it drops in value, that is, the investment originally carried at 100, the valuation account would be getting a credit of 10, and the carrying amount would be 90, which is the fair value. This is also called mark-to-market accounting. And the same kind of accounting would be for trading securities as well. Trading securities as well. So this is for shares. This kind of accounting or mark-to-market accounting is for shares, trading securities, which is not shares, which are debt instruments, and available for sale securities. All these would be accounted in this mark-to-market function type. Okay, so it would be mark-to-market. However, if it's an available for sale security, that is an available for sale debt instrument, then you would actually debit the valuation account if there is a price rise, if the market price has gone up, and credit unrealized gain, but it would not go to the income statement. Now let me just show it to you separately. Suppose we have an available for sale, and remember, available for sale now will mean only debt securities, not equity. Equities are no longer categorized as available for sale. So if this is the case, and any unrealized gain, for example, if you purchase it for 100 and at the end of an accounting period, when you're making your balance sheet is 110, you would debit the investment or the valuation account 10, credit unrealized gain 10, right? The difference is this unrealized gain would not be accounted in other income statement, but it will be accounted in other comprehensive income. I have already explained to you in the previous videos about other comprehensive income. If you are not clear on this, please refer to that. Right? And in the balance sheet, it will be shown the same way as I showed for shares. You have investment in a bond. I'll just put bond there so there's no confusion that AFS, available for sale securities, for bonds only or debt securities only. We'll put this as 100, the original, and the valuation account would receive 10 with the credit going to unrealized gain in the OCI, and carrying amount would be 110. Also, please note, whether it is available for sale or trading securities, before marking it up to market, you'll first amortize. It would be first accounted at amortized cost and then compared to the fair value. And then the unrealized gains or losses would either go to other comprehensive income, if it is AFS, available for sale securities, or if it's a trading security, it would go to the income statement. Now, what exactly is amortized cost? So now, for example, I'll show it to you with a very simple example. Suppose the bond's face value is 100. This is the face value of a bond. And it was issued at 110. This is the issue price. So now remember, this is an asset which the company is investing in other companies' bonds. So it would debit bonds by the original amount, by the face amount, because this is what they're going to get ultimately, 100, and debit, put here, debit bonds again, sorry. So debit premium, because the company paid a premium, 10, and credit cash, 110. Now let us assume that this bond has a tenure. I'll put it as a bond. This bond has a tenure of, let us say, 2 years, and you're going to amortize this premium on a straight line basis. Straight line basis is amortizing it equally over the tenure of the bond. So in the balance sheet, it would be presented on the asset side. Please don't forget, it's an investment. So on the asset side as 100, a premium of 10, carrying amount of 110. By the end of the first year, we would debit, because we are not going to get this 10. Okay, the company is not going to get that. It's going to get only 100 at maturity. So we are going to debit a premium account. I'm sorry, debit debit interest, let us say 5, and credit the premium account 5. This would actually, the bond is going to pay interest, right? If the bond is paying, let us say, a 20% interest every period. Okay, so if it is paying a 20% interest, debit cash 20, right? It would be debit cash 20, and then credit interest 20. Credit interest income 20, right? Assuming a very high interest percentage of 20%. Now, since we have paid more for the bond, it would go to reduce our interest income, right? So this debit to interest and crediting premium account would reduce the interest income to that extent, this credit and this debit. So definitely the interest income would be a net of 15, right? So that is how it would be accounted. So now in the balance sheet, the bond would be carried at 100 after the year end, after December 31st, since you have amortized the premium by 5 at a straight line basis. The premium account now would show only $5, and the carrying amount from 110 would become 105. The next year, when the bond matures, this premium also would be amortized and your carrying amount would be 100 with 0 premium. And thereafter, the bond matures and the company would receive cash for it. So the final entry would be debit cash 100 and credit bonds 100. However, I must mention that if this is amortized cost, okay, now what I just now showed you is amortized cost. Sometimes it is at a discount, which goes to increase the interest income, because they paid less, but they'll be getting the face value. So it's nothing but the investee is paying the company interest at the end of the period, at the end of the tenure of the bond. So once the bonds are amortized in this manner, like I showed you, here the premium is now 5 and 105. I'm talking about here. This 105 would be compared with the fair value in case of available for sale securities as well as trading securities. If the fair value is, let us say, 107, then the company would have an additional valuation account for 2. So let me just show it to you on a fresh page so that you understand. Let us assume that this is an available for sale security and the investment in the bond is 100. The premium has been amortized. It was 10. Now let us assume it to be only 5 and 105. But available for sale securities would be accounted at fair value, not amortized cost. So you will further compare it with the fair value as of that date. And if fair value is 107, we would pass another entry, debit valuation account 2, because it has increased compared to the amortized cost by 2, and credit unrealized gain 2. And where does this go? Please don't forget, since it's available for sale securities, it would go to other comprehensive income. So now, here you would have an extra valuation account with the debit of 2, and the carrying amount would be equal to the fair value. So this is how the accounting is done. Whereas if it is a hold to maturity or held to maturity security with the intent of holding it till maturity, you would not compare it with the fair value. You would account it, you will stop the accounting here. Only amortized cost after amortizing that year's premium or discount. However, you should remember that if the decline in market is other than temporary, in other words, there is a permanent decline. There's a permanent decline in the market value of the available for sale security because they may not pay. The investee may not pay the amount at maturity. In such a case, instead of recording the loss, in this case it will be a loss, instead of recording the loss in other comprehensive income, the company would record it in the income statement because it is other than temporary. Anything due to market fluctuations or interest rate issues, that would be accounted in other comprehensive income. However, if the decline is not expected to be restored, so in fact it's other than temporary, then it would be accounted, that decline or that loss would be accounted in the income statement and not in other comprehensive income. So these are the basic things you have to remember. We will start doing questions from the next session. And while doing questions, again, I will be explaining certain concepts. which you should bear in mind. There'll be certain takeaways with every question that I select. See you in the next session for the multiple choice questions. Hello, everyone. Welcome to another session on accounting for investments. In the previous session, I had already explained the accounting for available for sale securities, explained the concept of amortized cost, and also a permanent decline in value, right? So it's not called a permanent decline, it's called other than temporary. Now you might ask me, why is it called other than temporary, rather it's the same meaning as permanent, is it not? But no, they don't want to use the word permanent. Permanent has a very strong, it's a very strong word because it means that the security would never recover, right? But nothing in this world is permanent. We cannot tell it for sure, right? So they use it other than temporary because as long as the investor is holding the security, there is no hope of it recovering its value, right? So that is the reason it's called other than temporary, not permanent. Permanent, they don't use it because nothing in this world is permanent, right? So that is the reason they use other than temporary. But for all practical purposes, take it as permanent as long as the investor is holding the security. So let us do a multiple choice question on that concept. So you can pause the recording, read it, try to answer it based on the explanation I gave in the previous session, and then later on look at the solution. So a decline in fair value below amortized costs of an available for sale investment in debt security. Now, again, they don't have to mention debt security here because if it is available for sale, if it is categorized as available for sale, it is a debt security. That the company does not intend to sell before possible recovery of its amortized cost basis, right? So there's been a decline in fair value, and the company does not intend to sell it before the recovery of its amortized cost and is deemed to be other than temporary. So in other words, this decline in fair value below the amortized cost of this investment is deemed to be other than temporary. How it should be accounted? A, should be accumulated in a valuation account resulting from the passage of time is not right. Because if it is accumulated in the valuation account, yes, where is the debit going to go? So in other words, since it's a decline in fair value, it will be a credit to the accumulation, to the valuation allowance, right? But where is the debit going to go? That is not clear, and it's not resulting from the passage of time. And B actually is the right answer. So B is, it's evaluated for impairment and for determination whether the unrealized loss, it's a decline in fair value, so whether the unrealized loss is a credit loss. What do they mean by credit loss? A credit loss is the investee or the issuer of the bond is not going to pay the principal or interest. So that is a credit loss. If this impairment or decline in fair value is due to the fact that there has been a probability that the investee or the issuer of the bond would not pay principal or interest. That would be recognized in net income. Usually available for sale security unrealized losses or gains are recognized in other comprehensive income. But no, if this impairment other than temporary and is considered to be a credit loss, then it will be recognized in the income statement. So, or whether it's caused by other factors. So the decline could be due to other factors like interest rate changes. When interest rate changes drastically, there will be change in fair value of the asset, in which case it is recognized still in other comprehensive income. When they say recognized in equity, please note that it means recognized in other comprehensive income because accumulated other comprehensive income is a part of equity. It is shown in the equity section, right? So this is correct. If it's a credit loss, it will be shown in the income statement, and it should be other than temporary. And if it's caused by other factors like interest rate changes, it would be recognized in other comprehensive income. So B is right. Not be realized until the security is sold is wrong. All unrealized gains or losses would be shown either in other comprehensive income or in the income statement. Be treated as an unrealized loss? No, it is treated as a realized loss. That is why, see, all realized losses would come into the income statement, right? And he's saying treated as an unrealized loss and included in the equity section, that is other comprehensive income, is not correct. So B is the right answer. So that gives us the concept of what we just learned. And now let us go on to the next question. The next question is about classifying, which again I have explained with a chart, as well as explained while explaining the chart, I explained all the classifications. So he's asking, just look at the last line. Which would be classified as available for sale securities, right? A US Treasury bill is a bond. It's a debt security. So we have to look at it closely. It was acquired on 15th October, going to be sold. It will mature, won't be sold. It will be matured on 15th April, year 2, more than 6 months. And he plans to hold it until they mature. So there is no chance that this will be classified as available for sale security. In fact, it will be classified as held to maturity. Now, the second one, the moment they say shares, just ignore the whole thing, right? Because that will not be classified as available for sale securities. Available for sale securities are only for debt securities. Okay, it's very profitable. He plans to increase its ownership as believes it has strong potential. It's all not relevant to the questions. So long as it is shares, nothing to be seen. 3, bonds of ABC Corporation, which will mature in 3 years. But these bonds will be sold as needed for financial needs, right? And that means it will be sold. It could be sold before maturity. It's a bond. It could be sold before maturity, so it is not held to maturity. Okay, and it will be sold as and when needed, right? So it is not exactly a trading security also, because trading securities would generally be sold in the very short term. Okay, so this among the choices given is going to be classified as available for sale. Now we'll see the choice which says only 3. Only 3, right? So D is the right answer, 3 only. So D is the right answer. So with these two questions, you understood how to account or when to account for other than temporary losses or decline in fair value. And we understood something about classification of bonds or investments. In the next session, we will do more questions to get more concepts correct. Hello, everyone. Welcome to another session on accounting for investments and multiple choice questions. So let us go to a multiple choice question. And these questions are meant for you to understand the concept of classification, and based on the classification, the accounting of unrealized gains or losses. So those are that is the aim of the next three questions which I'm going to do. So try to pause it and try to do it yourself before looking at the solution. So here the question, just look at the last line. You have to find out the impact on the income statement. I'm underlining income statement for the changes in fair value between December year 11 and 12. So from here to here only. And please note, all are marketable debt securities. So trading, held to maturity, and available for sale. So what out of this would impact income statement for changes in fair value? For held to maturity, we are not going to market to market. It will be accounted at amortized cost. It has an impact on income statement, but it is not due to fair value because we are not going to market to market. Available for sale securities would not affect income statement because any changes would go to other comprehensive income. So rather, it would affect the accumulated other comprehensive income. And yeah, so that leaves us only with trading securities. And the difference between 238 and 245,000 is 7,000. So A is the right answer. That's the only one which would have an impact. The unrealized gains or losses would have an impact on the income statement. So let us go to the next question. The next question is similar, in fact, the same data, but different question. Now here is asking again the impact of fair value changes. Impact of fair value changes on accumulated other comprehensive income for the years ended 31st December 2012 and 31st December 2013. Or I'm not saying, I wonder why I'm saying 2012 and 13. It's just year 11, year 12, year 13. So they want us to find out for the years ended for year 12 and year 13 respectively. So the only classification which would affect accumulated other comprehensive income is available for sale. We can just ignore trading and held to maturity. So for 2012, there is an increase of 15,000. The only answer with 15,000 increase is C. So the answer is C. But then let us go further. And it increases to by 6,000 from year 12 to year 13. So that also matches. So C is the answer. Finished. It's a very simple question, very straightforward. If you know the classifications and how they are accounted. The next question is slightly tricky. So here, the same data, but he wants to know the impact of fair value changes on comprehensive income. Now, you would think that the previous answer, this one, should be the answer for this too. But look again, he's not asking accumulated other comprehensive income. He's asking comprehensive income. So here you have to know the concept of comprehensive income. Comprehensive income includes net income from the income statement, net income from the income statement, and other comprehensive income as well, right? It includes both. That's why it's called comprehensive. Comprehensive means covering everything, right? So we have to now look at held to maturity also would affect the net income statement, right? When we amortize the cost, there is an impact. We'll be accounting it as interest expense, right? But it is not due to fair value changes because we don't mark it up to market. So we remove that. Now we have to look at trading and available for sale. So from year 11 to year 12, so that will be the impact on year 12. It is 7,000 plus 15,000. 7 plus 15 is 22,000. We have to look at both because available for sale security would affect other comprehensive income. Fair value changes would affect other comprehensive income. And fair value changes of trading securities would affect net income in the income statement. Both these together would be comprehensive income. So we have to look at both of them. So 7 plus 15, 22,000. The only answer with 22,000 is D. So that is the right answer. But let us look at the next year as well. So here it is going to be, again, we have to look at trading securities and available for sale securities. So here's trading securities has increased by 4,000. It would affect the net income. And available for sale securities would affect the other comprehensive income. And that also is comprehensive income. So that is 6,000. So totally it would be 10,000. So the second thing also matches. So D is the right answer. With this, you have understood the classifications and the accounting for it for both debt and debt trading and held to maturity. Explain the concept of amortized cost as well. So let us move on to other concepts in investments in the next session. Hello everyone, welcome to the lesson on investments. So now today we will be talking about fair value option. So for that, let me take you to the text. So fair value option is when the debt securities, now here we are still talking about debt securities. So when we choose the fair value option to account for debt securities, what are we doing? We're doing the same thing like we did for trading securities and available for sale securities. We're marking it up to the market. However, there's a difference. The unrealized gains or losses, instead of being reported in other comprehensive income under equity, if the fair value option is selected for a particular available for sale security, then as usual, it would be reported at fair value on the balance sheet. But the difference here is the unrealized gains and losses would be reported in the income statement instead of in equity, that is other comprehensive income. So a company can select certain securities to be reported with the fair value option, in which case all unrealized gains and losses would be reported on the income statement. Anyway, trading securities, unrealized gains and losses were reported on the income statement. But if the fair value option is chosen, available for sale securities, also the unrealized gains and losses part would be reported in the income statement, including held to maturity. If you hold, if a held to maturity debt security is generally reported at amortized cost, and unrealized gains or losses are not reported at all usually. But if the fair value option is chosen for a specific debt security, for a specific HTM, then the unrealized gains and losses on that would also be reported in the income statement. So everything would be routed through the income statement. Nothing would be in comprehensive income. It would all be at fair value in the balance sheet. But that doesn't mean that you shouldn't be amortizing the premium or discount. Available for sale security or held to maturity security is accounted at fair value if the fair value option is chosen. But any discount or premium should be still amortized. See, that's why it is bold-faced here in this important note. Then the amortized cost is compared to the fair value, and then the unrealized gains or losses are reported in the income statement, and the security would be reported at fair value in the balance sheet. So that's how it works. And it can be, you can choose the fair value option, or the company can choose a fair value option for a specific security. It doesn't have to account everything under fair value. A specific security it can choose to have to be reported at fair value, and the fair value option can be chosen. And then it should be done initially at the time of purchase. So, and it should be applied consistently, the fair value option. You cannot change it to any other way of accounting. If the fair value option has been selected, the unrealized gains and losses should always be reported in the income statement, and the security itself will be reported at fair value on the balance sheet. And here, one important note. Just a minute. Here he has told you. Yeah. Generally, for available for sale securities, it will be actually carried in a separate account, and a fair value is increased and decreased as appropriate. Okay. Generally, it is done through a valuation account, but if the fair value option is chosen, it is held in a separate account, and there is no need of a valuation account. What is this valuation account? If you remember, I had already told you that for an available for sale security as an investment, let us say if it is 1,000 like this, a valuation account is put here as a contra asset. And if there's a decrease in value, you would be actually crediting the valuation account, let us say by 200, and you'd be debiting other comprehensive income if fair value is not chosen. If the fair value option is not chosen, then you will be debiting the other comprehensive income, and the carrying value would be like this. But if the fair value option is chosen, you don't have to use this. You directly adjust. It will be carried in a separate account. That's what he says, right? It will be carried in a separate account, and its fair value is increased or decreased as appropriate. A valuation account is not used. So that is what to be noted. And as usual, it should be amortized and then compared with the fair value. So that's all about it. So in the next session, we would speak about equity investments. And we have finished all the multiple choice questions in accounting for debt instruments. So now the next session would be about equity investments. Hello, everyone. In the last session, I spoke about fair value option, and now we will do a multiple choice question on this concept. So here, please note, this is not an investment. It is talking about reporting a liability. I spoke about fair value option for investments, but then the same can be applied to liabilities. The liabilities also can be reported at fair value. There's an option for the company to report fair liability at fair value as well. This is to actually have uniformity in accounting between investments and the liability. Suppose generally, let it be, trading securities or available for sale securities. Most of the sale securities, when as an investment would be accounted at fair value. So sometimes, in order to keep that uniformity in accounting, the companies would choose to account their liabilities also at fair value, right? So here, the question is asking, when using fair value accounting, it would be to a firm's benefit to report the liability at fair value when it has a 32 million outstanding bonds trading at 101. See, anything trading more than 100, here 100 represents fair value. So anything, 100 represents face value, I'm sorry. So anything more than that would be more than the face value. So if he accounts this at 101, it means it's being accounted at greater than fair value, greater than face value, and that would not benefit the firm because it's increasing its liability. So that's not the right answer. Then 50 million in variable rate preferred shares outstanding. First of all, preferred shares is not a liability, it is equity. 28 million in outstanding bonds trading at 98. Now 98 is below the face value, and this would be beneficial for the firm because it would be reporting a lesser liability. So C is the right answer. And in any case, when it comes close to the maturity, it would be trading at face value. The market would adjust itself to the face value. But at the moment here, if it is trading at 98, the firm will show a lesser liability on the balance sheet, and that would benefit the firm. 25 million puttable. A puttable bond is the investor can sell the bond or return the bond to the company at his option. So a puttable bond trading at 102 is still above face value, and that would increase the liability, and that would not be beneficial for the firm. So C is the right answer. Hello, friends. In this session, we'll talk about investments and equity investments. So that's what we are going to speak about here. So let us go to the text directly. So the investment accounting would depend on whether the firm has significant influence on the investee. So when does the firm have a significant influence? That would be depending on how much percentage of the voting stock that the firm owns. For example, a lack of significant influence, that means if it's anything less than 20%, uh, it is actually no significant influence. So that is when the accounting is going to be a little different. We'll discuss that further. But if anything is greater than 20%, that is, if the firm or the investor owns stock which is greater than 20% of the voting stock, then the firm is considered to have a significant influence. However, there are some times, even if the firm owns 30 or 40% of the stock, it might not have significant influence. So you should read the question very carefully to determine whether the firm has significant influence or not. So, but now in this session, we will be talking about firms which do not have significant influence on the investee and how the accounting is taking place. So when a firm owns less than 20% of the voting stock and does not have significant influence, you should find out whether the securities do have a readily determinable fair value. That means if it is traded in a normal stock exchange or in the over-the-counter market. So in that case, if the buying and selling prices are quoted there, then it's said to have a determinable fair value, and then it is mark-to-market accounting, and the unrealized gains and losses will be through the income statement. However, a valuation account is used. And there is one other type of securities which do not have readily determinable market value. These are privately held, not traded in a stock exchange or the over-the-counter. So there you would check for any impairment. So it would be accounted for at cost less any impairment, right? You would see you will do a qualitative assessment to find out whether it is impaired, right? If the firms are making, if the firm is making a lot of losses, if the investee is making a lot of losses, or there is cash flow problems, or there is a loss of business due to competition. So all these are qualitative factors that should be looked into and decide about whether the investment is impaired or not, and that impairment loss is recognized in the income statement. Also, it can be adjusted for observable price changes. Now, this is not anything to do with the market because it's not quoted in the stock market. So this would actually largely depend on whether the investee has issued a similar security and what is the price of that security. Suppose the investor has purchased the security in this privately held company for 100, and subsequently the investee has issued another security, similar security to another person or another firm for, let us say, 120. Then the original investor can safely assume that the market price of his holding is also 120 and account for that fair value change. However, if the firm subsequently issues a share or a security for less than 100, then the original investor can also assume that his investment holding has gone down in price and account for that change. So that is how you would be accounting for equities which do not have a determinable fair value. However, this is not tested so often in the exam. You would be tested on equity securities which do have readily determinable fair values. So how do we account for that? So let us go to the text further. It is accounted through a valuation account. Now, supposing the equity security has gone up in price, if there's an increase in fair value, you would debit a fair value adjustment account, which is called a valuation account, and credit unrealized holding gain on the income statement. It will be accounted through the income statement. So, for example, supposing an investor has invested in an equity. So, debit the equity investment, let us say 100, and credit cash 100. And later on, he finds out that at the reporting period, if he finds out that the price has gone up, the market price is now 110, then he would pass debit fair value adjustment account, valuation account 10, and credit unrealized holding gains 10. So this is how it would be. And in the balance sheet, he would report the equity investment at original cost of 100. The valuation account would be below that valuation account. It got a debit, so it is 10. Remember, equity investment is on the asset side because we are talking about investments here. Okay, so and then 110 would be the carrying value. 110 would be the carrying value. Similarly, if it's a loss, the fair value adjustment account or valuation account would get a credit, and a debit would go to unrealized losses to the income statement. Now, that's what he shows in the next entry when there is a decrease in fair value. And then, how do we account for realized gains or losses? Now, remember in my example, I had given you the balance sheet presentation as the investment in equity was 100, valuation account was 10, and the carrying amount was 110, right? Let me write it a little bit bigger so that it's more clearer. Yes. Equity investment in the balance sheet was 100. Valuation account, assuming a gain, unrealized gain was recorded, was 10, and carrying amount was 110. Now, what if you sell this security? That's what they are talking about here. When you sell the security, let us say for 110, right? What would be the entry? You would actually debit cash for 110, the sales price, credit the investment at the original acquisition price, that is 100, and record a realized gain of 10. You record the realized gain as 10. Okay. So now you would be wondering, what about that unrealized gain? Now, after this entry, assuming that this was the only equity investment, generally there is a group of equity investments, and the valuation account is adjusted for the fair value for all those investments, right? But assuming that this was the only investment, now equity investment is 0, but you have a valuation account of 10 and 10, right? So at the end of the reporting period, we are going to reverse this. Automatically, it would get reversed. So it would be debit unrealized gain, because previously unrealized gain was recorded, 10, and credit valuation account 10. So that way this also would become 0, and the unrealized gain would get reversed in such a manner, right? and the realized gain is recorded, right? So, however, we would not be exactly passing this entry like this because it would be in a group of investments. And when the valuation account is adjusted for the remaining investments, the unrealized gain or loss would automatically get reversed, right? I hope that is clear. And that is how the accounting takes place for equity investments without significant influence. So that's what they're telling in the text. It's not necessary to reverse any previously recorded unrealized gains or losses, since it's all accounted in a group of investments or a group of equity investments. The valuation account would be accounted or would be adjusted for the fair value of the remaining investments, remaining equity investments, and then the unrealized gain or loss would automatically get reversed, right? And then, as I told you before, if it is not readily determinable, right, you should look for impairment and account for it accordingly. And I also told you about observable price changes. Now, what when they do not have significant influence and they receive cash dividends? Cash dividends is dividend income when there is no significant influence. So for common stock or preferred stock, there can never be significant influence by holding preferred stock because preferred stock do not have voting rights. So if an investor owns even 100% of the preferred stock, he doesn't have significant influence because it doesn't have voting rights, right? So any dividends when there is no significant influence is income. So when it's declared, let us say 100 is declared, you would account it as a receivable and take it to income on an accrual basis. And after that, when dividend is received, cash is debited, receivable is credited. As simple as that. Dividends are income in case of no significant influence, right? Stock dividends, there is no adjustment, no journal entry for stock dividends. So if an investor receives stock dividend, that he is getting shares without paying anything for it, he would pass a memorandum entry. What's a memorandum entry? Memorandum entry has no amounts in it, right? It has no dollar amount. So he might just account for that increase in shares, right? Like debit the number of shares, increasing the number of shares, right? And that's it. There is no change in amounts, but the per share amount would automatically reduce because now there are more shares. Stock splits also accounted in the same way, or rather not accounted. There is no journal entry, right? So that is what they would do. What is liquidating dividend? Liquidating dividend is paid out of anything other than retained earnings. Who pays? The investee pays the dividend. So if the investee is paying from sources other than retained earnings, it is a return of capital rather than on capital. So they're returning the investor's capital itself. So that portion which is paid from other than retained earnings, like additional paid-in capital, should be accounted for as reduction in investment and not income. For example, a liquidating dividend would be accounted by the investor as like this: cash, debit, let us say 100, and let us say the liquidating dividend is 100. So he would credit the equity investment, not the valuation account, the equity investment directly by 100, because it is the return of capital, not return on capital. So that is how the dividends are going to be accounted for. It is a credit to the investment. You can go through this example and for better understanding. But I have explained the concept, and that's it. Next, we would go for equity investments with significant influence. And this is tested quite often in the exam. So that would be in the next session. Now we would do some multiple choice questions on whatever we studied. That is equity investments without significant influence. Hello, friends. Welcome to another session on accounting for investments. Now, let us do some multiple choice questions on equity investments without significant influence. So let us go to the question bank. I had discussed actually the percentage of ownership to have significant influence in the previous session. So you can easily answer this. So a company should apply the equity method of accounting for an investment whenever it can exercise significant influence over the investee. I have not yet discussed equity method, which I will be doing in the coming sessions, but I had discussed the significant influence ownership levels. So usually the minimum level of ownership which an investor can exercise significant influence is, so very simple question, but if you have not studied, you will not know. So it's 20%. So anything under 20% is considered to be not having significant influence. The accounting is different. It will be the fair value method and taking dividend as income. However, if it is over 20% and they exercise significant influence, sometimes even if they have more than 20% ownership, they are unable to exercise significant influence. Significant influence means taking decisions in the operations of the company and generally having an option to influence decisions, operational decisions. So that would be significant influence. Sometimes even greater than 20% ownership, the company may not be able to exercise significant influence over the investee. So you have to read the question carefully. So C is the answer for this rather simple question. Let's go on to the next one. Now in this question, I'll just reduce it a bit. The same data here in this question, he says, if the investor, which is Boggs Incorporation, exercise significant influence and accounts for it under the equity method, what should be the investment revenue? But we will not do this question because I have not yet discussed equity method. But the same data, they have given this another question stating, if Boggs did not exercise significant influence and accounted for the long-term investment under fair value method, that is, changes in fair value is taken to income, the amount of net investment revenue that the investor should report from its investment in Matley would be what? So we are going to solve this question wherein the investor is not having significant influence. So let us look at the question now. So he has paid 700,000 for 100,000 shares of Matley Corporation, which represents 30% of Matley stock. So generally it would be significant influence if nothing was mentioned. But as I told you, we are not doing this. We are going to do the one where if he does not have significant influence. It's quite possible, even with 30%, they may not have significant influence. It may be because one more shareholder has got 50% or 40%. So this shareholder would get second preference. So now, purchase price was 700,000. 30% of the fair value of Matli's net assets is 500,000. So generally, so he has paid 200,000 more, which is actually goodwill. But we will not show it as a separate line item. We would show the investment in equity as 700,000. We will not put 200,000 separately as goodwill, right? So Matli, the investee, reported a net income of 300,000 and paid cash dividends of 100,000. So as I said, we are doing the one which he doesn't have significant influence. So now they have not given you fair values here, right? So there is no fair values mentioned here. So what will we take as income? We can take income only the dividend amount, but this is the total dividend. 30% of the dividend would belong to the investor. So it is the investment revenue would be 30,000 when there is no significant influence. And since they have not given share prices here, the change in market value is not given. So we cannot apply the unrealized gains or losses due to change in fair value. So only this is the income. The entry would be debit cash or dividend receivable. Debit cash 30,000 and credit dividend income 30,000, since there is no significant influence. So the answer for this would be, we should go to the next one because that is where there is no significant influence. It is B. The answer is B. So now, in the next session, we will talk about the equity method wherein there is significant influence exercised by the investor. Hello friends, welcome to another session on investment accounting. And we are going to do now the equity method when there is significant influence. Let me go to the text. So this is the guidelines on accounting for investments when there is significant influence, when the investor has significant influence over this investee. So what would constitute significant influence? There's a list of indicators here which would indicate that there is significant influence in addition to percentage of ownership. So the investor is represented as one of the board of directors of the investee. And the investor, see, when he is one of the board of directors, he could influence the operations of a company. So the investor participates in the policy making process of the investee. There are material intra-entity transactions. That means the investor might be a major customer or supplier of the investee. So, and that would constitute what they call material intra-entity transaction. And there is an interchange of managerial personnel between the investor and investee. So that is self-explanatory. The interchange of managers would take place between investor and investee companies. And there is also technological dependency. That means one of the entities or both would be using the same systems. And there is, they depend on each other for technology and the systems. So if one or all of these indicators are present, then the investor would have significant influence on the investee. So now what I would do is show you the accounting on the whiteboard. So when there is an investment, let us say there is an investor here and an investee. So when the investor invests in the investee, his accounting entry would be debit cash. Let us say, I'm putting some figures, 100,000. And I'm sorry, it's debit investment. I would do it again. Okay, so investor and investee. So when the investor invests, it would be debit investment in the investee company and credit cash. Let's assume it to be 100,000. And let's assume that this $100,000 constitutes a major part of the investment, which is 30%. Let's assume that it is 30% of the investee's voting stock. Now, thereafter, once the investee makes an income, now let us assume that the investee's net income is, let us say, 1 million. Right? And let us say the investee declares dividend of 100,000. Right? So now, since the investor has significant influence on the investee, he would accrue his share of income. The investor would accrue its share of income from the investee because there's significant influence, and he could actually demand this money from the investee. So the entry is going to be 30% of the net income, which is 300,000. So debit investment. Now his investment goes up. It is sort of like a receivable. It's like if you own 30% of a company and that company makes an income, you get 30% of it, right? You would demand 30% of that income because you have a 30% investment. Similarly, it is like a receivable now. So he would debit investment by 30,000. I'm sorry, 300,000. His share of this 1 million, and credit investment revenue, even though he has not received this. So it's sort of like an accrual, just like a receivable. Receivable is also accrual, is it not? When there's a credit sale, there's debit the receivable and credit sales, credit revenues, right? So it's similar here. The only difference is we are debiting the investment account because that asset has increased in value. And then the dividend is like paying off, like as if the receivable has paid. So a 30% of dividend also accrues to the investor. The cash entry is the same. Debit cash, 30% of 100,000, which would be 30,000. But now the credit, please note, guys, this is not the same credit as when there is no significant influence. When there is no significant influence, dividend is income. When there is significant influence, dividend is not income. It goes to reduce the investment. What's the logic? When the income was earned, the investment got a debit investment, credit investment revenue, just like a receivable. 300,000 is receivable from the investee. So we debit the investment and credit investment revenue. And when we get dividend, it's as if the investee is paying part of this share of 300,000. So it's as if when a receivable pays, when an account receivable pays, we debit cash and credit the receivable, right? So here the investment account is like a receivable account. So we debit cash and credit investment. So how will be the balance sheet presentation? The balance sheet presentation will be as follows. The investment in the investee, you would mention the investee's name. Okay, so the investment in the investee, I'll just write it a little more clearly. So investment account, I'm talking about the investor's books. So he had paid 100,000 originally. The share of income would add to the investment because the debit investment, and the dividend paid would reduce. So dividend paid would be 30,000. So it is 400,000 minus 30,000, which is 370,000. So this would be the carrying value of the investment in the investor's books. Sometimes if there is a loss, suppose the investee made a loss, instead of a net income, it made, let us say, a net loss of, let us say, anything, 500,000 loss. Then 30% of this would also be accounted by the investor, but this time it would reduce the investment. It would debit loss on investment. 30% of 500,000 would be 150,000. So 500 into 30%, 150,000. And it would credit investment 150,000. This is when there is a loss. But usually you'll be tested with profits. I don't think you'll be tested with a loss, right? So if at all there's a loss, there's the opposite effect. The investment account, instead of increasing, instead of it being debited, it would be credited. So that's the basic concept of the equity method. Why is it called equity method? Because the investor takes part of the equity of the investee. Income is nothing but an addition to equity, right? So the investor would take his share of the equity of the investee. So that's why it's called the equity method. So in the next session, we'll do questions on this. It's a simple concept, but I've seen many students go wrong when they ask both, when there is significant influence and when there is no significant influence. They get confused and go wrong. Please remember one important point, that under the equity method, dividend is not income, because that's where all students go wrong. Dividend is not income. It goes to reduce the investment, just like when a receivable pays, we credit the receivable, you would credit the investment. Let's do questions in the next session. Hello, everyone. Welcome to the lesson on equity method. So now we would be doing multiple choice questions on equity method. We have already done this question in the previous session. So we'll go ahead and do this question. If you remember, in the previous session, we had not done this question. We did it when there was no significant influence. But now it is asking for investment income or investment revenue when there is significant influence. So how are we going to do this? So 30% and significant influence. Pause the recording and try to do it yourself. There are no fair values to be considered here, and they're not given also any other fair value. Fair value of the shares are not given. So what happens here? Since the investee, which is Matley, and investor, which is Boggs, investee has got a net income of 300,000. So 300,000, 30% of this would be Boggs investment revenue. So actually it would be 30, sorry, not 30,000, 30% of 300,000, sorry, a little bit of a mathematical mistake. It's 90,000. So D is the right answer. What about the cash dividends of 100,000? 30% of this, where does that go? This is the major confusion among students. 30% of this is 30,000. The entry would be, since there is significant influence, debit cash 30,000 and credit investment in Matley. The investment account would be credited. Dividend is not income when there is equity method. But under fair value method, when there is no significant influence, then dividend is income. So here the dividend goes to reduce the investment. So what would be the balance sheet presentation like? Investment in Matley, it would be 700,000. They could also ask you this. They can ask you what's the carrying amount of the investment. But here they've asked you what is the net investment revenue. So 700,000, you add to it 90,000 because that is the Boggs share of investment revenue, which becomes an asset on the balance sheet. So you have 790,000. 700,000 was paid, right? So 700,000 plus 90, 790 minus 30. The dividend, which goes to reduce the investment. So that carrying amount of the investment would be 760,000. I hope you understood this clearly. There are more questions on equity method in the short courses. Since you're a subscriber of Hawkstream, you would have access to the short courses, and there are many exam style difficult questions there. So I don't want to do it here also because it will be duplication. You can always go and refer that and try to do it yourself and look at the explanation later. So D is the right answer for this. I also prepared you if they ask you for the carrying amount of the investment. When they do not exercise significant influence, was already done in the previous session. Now this is a CIA question asking that when equity method is used to account for an investment in an associate, the recording of a cash distribution like dividend from the investee would result in reduction in investment balance. I just showed you in the last question. It would reduce the investment. It's as if a receivable is paying. So we would credit the receivable. So we credit the investment. The investment account under equity method is similar to receivable account. A recognition of investment income would happen under the fair value method when there is no significant influence. No, a liability account is not increased. A special equity account is not increased. Okay, so it goes to, there's no increase anywhere. It will go to reduce the investment balance. Let's do another question. So take your time and read this question. There is significant influence because it's more than 20%. The investor has a significant influence. One thing you should note, guys, from 20% up to 50% would be significant influence. 20% ownership of voting stock up to 50% ownership of owning stock or voting stock should be having significant influence. From 51% onwards, it is control. The company, the investor would be having control over the investee, and it would actually account it by the equity method, but later on during year end, it would consolidate. It would consolidate the investee's financial statements and its financial statements and show it as one economic entity. We'll come to that later when we do business combinations. Now, for the moment, it has 40% ownership and its cost. It acquired that ownership paying 300,000. Supreme Table is the investee, and he reported their earnings for the prior year. The investor, Best Billiards, proportional share of net income was 10,000. So here they have not given you the total income of Supreme Table. So you don't have to calculate 40% of that total income. They are given this 10,000, which is nothing but 40% of the total income of Supreme Table. Best Billiard also received its share of dividends of 15,000. Best Billiard uses equity method. That means there is significant influence. Sometimes percentage does not necessarily mean there's significant influence. But since he's adopting the equity method, we can take it for granted there is significant influence. Based on the information, proper presentation of the investment would result in Best Billiard reporting what? A decrease in book value of the investment, increase, original cost, or should you consolidate the financial statements? No. As I told you, if it's 51% and there is control, you have to consolidate. Now, what will be the result? In Best Billiard's balance sheet, it would show 300,000 investment in Supreme Table. To this, it would add its share of proportional income, which is 10,000. So that would make it 310,000. And then the dividends go to reduce the investment because it's equity method. 15,000 minus. So that would give it 295,000. So what has happened? The book value was originally 300,000. Now it is 295,000. So there has been a reduction, a decrease in book value. So this is the right way of doing it. And I have shown you with figures also. So in case this question comes numerically, you can answer it. So with that, we finished the equity method. The next thing to study in investments is the fair value option for equity investments. We would do that in the next session. Hello, friends. In this session, I will be talking about fair value option for equity method investments. It's a small clip, so I would finish the explanation fast. Let us go to the Hawk text. In the last class, in the previous videos, I have already explained the equity method and how we do the accounting for that. And we also did multiple choice questions on it. Now, the company has the option to opt for the fair value option for all instruments or an instrument or on an instrument by instrument basis. It doesn't have to apply it for everything. It can apply it on an instrument basis. Now, what is this fair value option? For a specific security that would otherwise be reported using the equity method. So if there was significant influence and then you were supposed to be using equity method, the investor may choose the fair value option for that particular investment. So when they choose the fair value option, all unrealized gains or losses related to changes in fair value would be reported on the income statement. So you would be debiting or crediting the investment due to the fair value changes, and the contra entry would be going into income statement as an unrealized gain or loss. You can choose on an instrument by instrument basis in the sense that for one instrument, for one share or one investment, you can use the equity method if you have significant influence. And for the other one, you can choose the fair value option. But it should be done, this choice should be done when you first purchase the financial asset, and you should apply it consistently. You cannot apply for the fair value option in 1 year and then switch on to the equity method in the other year. No, that's not fair. So if the fair value option is used for a particular equity investment, where of course when there is significant influence, where he should have used the equity method, if he uses the fair value option, he does not have to report the investor's share of investee's income or loss as income, and dividend received would have generally gone to credit the investment or reduce the investment, but it can be taken as dividend income if the fair value option has been selected. So it would actually remain the same. I mean, the accounting would be just like for a equity instrument without significant influence. How you would have otherwise accounted it, the same way you would account it. Only thing, there wouldn't be a valuation account. The equity would be carried in a separate account, and the fair value increased or decreased as appropriate to reflect the unrealized gains and losses. And of course, everything is going through the income statement. So if an equity fair value option is opted, even though the investor has a significant influence, he would not take his proportionate share of income, and also the dividends would not go to reduce the investment. It would be dividend income. And this can be done on an instrument by instrument basis. So that is the concept. So in a question in the examination, you should watch out if the investor has selected fair value option or not. Sometimes they would mention that the investor has not selected the fair value option and has significant influence. In that case, the equity method is adopted. And I have already explained the equity method accounting in the previous videos. That's all for this session. The next, we will be talking about business combinations, that is consolidation. We do consolidations at a very basic level in the CMA, so there will not be too much of complication. We will do this in the next session. Hello friends, welcome to the topic of business combination and consolidation. Now this is a topic under investments, and I will explain the concept to you by looking at the text. So, when should we consolidate? We should consolidate when there is control, and control is established when the acquirer owns more than 50%, even 51% of the acquiree's voting shares. So once he does that, it is going to be control. See, it is like this. From 0 up to 20%, there is no significant control. Okay, no significant influence. Okay, let me just write it neatly. For that, I'll use the whiteboard for a second. Yeah. So, ownership interest from 0 up to 20%. There is no significant influence. No significant influence. Then from 20%, okay, you can say up to 19% there is no significant influence. From 20% onwards, up to 50%, there is significant influence. And from 51% onwards, it is control. Right? So here it is accounted by the fair value method. The investment is accounted by the fair value method, and it is shown on the balance sheet at fair values. Right? And from here to here, the equity method. In fact, until here, it would be accounted under the equity method, unless the fair value option is chosen. Right? You would apply it on the account it by the equity method, but if it is more than 51%, you would do consolidation. Even though you apply the equity method for the investment until the year end, in the year end, there is consolidation of the acquirer and the parent and the subsidiary. And the investment account is eliminated. When you consolidate, the investment account of the parent is eliminated. Right? And we'll go back to the text and see when we consolidate. Now, in this lesson, we are doing this part when there is control. Right? So we will go back and see in the text what are the other things that get eliminated when we do the consolidation. Right? So let's go back to the text. It's consolidated as one single economic entity. What do you mean by this? the parent and subsidiaries are separate legal entities. They are separate legal entities. But once it's consolidated, it is actually treated as one economic entity. And this way, they cannot escape antitrust laws, etc., because they're treated as one. Okay, so they cannot hide behind the corporate veil saying that they are separate entities, right? So it will be treated as one economic entity, even for legal purposes. When it comes to fraud or circumventing antitrust laws, it would be treated as a single economic entity, even though they are separate legal entities. And then there are two models which determine controlling interest. One is the voting interest model. This is when the acquirer acquires more than 50% of the outstanding shares of the acquiring. The other one is the variable interest model. Now, what is that? The variable interest entity model. Here, even though the acquirer or the parent does not hold majority of the shareholdings, it does not hold more than 51%, it is determined to be the primary beneficiary and consolidation happens. Right? And sometimes the other way is also true. Here, even though the owner does not, the parent does not own more than 51%, majority, does not own majority, still it's consolidated because the parent is determined as a primary beneficiary. It actually, in substance, controls the subsidiary, right? For example, an example for variable interest entity could have been seen in the Enron incident. The Enron executives opened up partnerships. Now, these partnerships were owned by, the owners or were opened up by the Enron executives, which were in fact controlled by Enron. Right? They were at the beck and call of Enron. So this partnership basically was controlled fully by Enron, and all the risks and benefits of ownership also was taken by Enron. But they escaped by not consolidating these variable interest entities. So that is when US GAAP and legally they need to, then they had to consolidate these variable interest partnerships or entities into their own balance sheet so that any assets or liabilities of these partnerships could be seen in the consolidated balance sheet. So that is when, if it is considered, Enron was considered to be the primary beneficiary and it had to consolidate, even though it did not directly own the partnership or the variable interest entities. So that is one model where they have to consolidate. And sometimes a majority owned subsidiary should not be consolidated if control does not rest with the majority owner. Sometimes, even though the parent might have 100% shareholding in the subsidiary, still, if the subsidiary is under legal reorganization or bankruptcy, it is actually under the control of, it's under the control of the court, the bankruptcy courts. Okay, so then it would not have control over the subsidiary. And sometimes parent may have control, may may have majority shareholding in a subsidiary situated in a country which has foreign restrictions and other governmental rules or restrictions by which due to which it cannot control that subsidiary. In that case also, even though it's a majority owner, it will not consolidate that subsidiary because it does not control it. Substance over legal form is the main point here, right? So in substance, if they own it, then they have to consolidate it, right? So that is the way it is going to happen. Consolidation happens. And when consolidation happens, any income or loss of the consolidated company after the purchase would be consolidated with the parent company's income statement, and a worksheet is prepared. No entries are passed. Please note here, no entries are passed in either the parents or the subsidiaries' books. At the end of each period, a consolidation worksheet is prepared, wherein the balance sheets and income statements are consolidated into one. But the main exercise here, while consolidating, is eliminating certain things. What is that? What do they eliminate? Because now they are one entity, one economic unit. So any intercompany receivables and payables, it is like the father owing something to the son, right? They are all one family. So it will be eliminated. Eliminating the effects of sales of inventory. Now, inventory might have been sold at a profit to the subsidiary or vice versa, subsidiary to the parent. Those effects have to be removed. And then intercompany sale of fixed assets. The parent should, the consolidated entity, the parent should be showing the fixed assets at the original cost of the purchaser, right? And then we eliminate the parent's investment accounts against the equity accounts of the subsidiary. So that is what is, these are the main adjustments which has to be done. Any interrelated transactions or intercompany transactions or related company transactions has to be eliminated. So here is the detailed explanation about it, right? And even depreciation, etc., should be adjusted whenever parent has taken over, purchased an asset, or the subsidiary has purchased an asset from the parent at a cost other than the original cost. The depreciation would vary, and that also should be adjusted, right? So what is non-controlling interest? Now, a parent, an acquirer might have not acquired all the holdings. It might have not acquired 100% of voting shares of the subsidiary. Suppose it has owned, it owns 90% of the subsidiary. Technically, it should show 90% of the assets of the subsidiary, but it will show 100% of the assets of the subsidiary. And that remaining 10%, it would show as non-controlling interest. That is the interest it has not purchased from the shareholders, right? So this is actually due to the shareholders for which it has not having any control, or which it has not acquired, right? So in the consolidated balance sheet, we will be showing non-controlling interest, and their share of income as well would be shown. Income or loss would be shown separately and in the income statement, and then later on consolidated under non-controlling interest in the balance sheet. Of course, you will not be tested on this. you will not be asked to solve questions on this, but it is better you know these things. So because there would be word multiple choice questions on these. Now, in the next session, I will just demonstrate how a consolidation is done with a very, very simple example without complicating it with inventories or fixed assets. I would just show you with a very simple example how actually consolidation is done. Again, remember, it's a worksheet exercise, right? It's a pro forma exercise. No entries are passed in the parents' books and the subsidiary books. At the year end or the end of the period, a consolidated financial statements are presented to the shareholders, and later on, they would operate as separate entities. So in the next session, I will just show you a demo of how consolidation is done. Hello, friends. Welcome to the session of business combinations and consolidations. In the last session, I had explained the concept of how the parent and subsidiaries are consolidated. So it was all just explanation and theory. So unless you see a demo, you will not fully understand it. So I'll just show it to you on the whiteboard with a very simple example. So let us assume an acquirer. I'm drawing their balance sheet in a account form, in a T account form with liabilities and equity on the left-hand side and assets on the right-hand side. So this is the balance sheet of an acquirer, right? And I have used an example. So it is, let us say he has capital of 125 represented by assets, cash of 100, fixed assets of 25. So that agrees. The liabilities plus equity is equal to the assets, right? Now let us talk about the target company, the acquiree, right? So I would call this the target, right? And they have a balance sheet of, let us say, 4 major shareholders, just for simplicity's sake, A, B, C, and D, holding 25 each, $25 each. Okay, and that's represented in the asset side by fixed assets of 100. So that would be their balance sheet. It's tallying 100 on the liability side and equity side, and 100 on the asset side. So at every point of time, the assets must be equal to liabilities plus equity. Now, let us assume that the acquirer has given, okay, first let us assume that the acquirer takes over with his cash. He takes over. Okay, he had cash of 100, right? So he would take over 75% of the shareholding. 75% of the shareholdings. So that is 75. So he has now cash of, after taking over, he would have cash of only 25, because 75 would be in the form of investments, which would be accounted under the equity method until consolidation takes place. So investment is 75. Still, the balance sheet is agreeing. right? 125 and 125. Okay. Now, this amount of shares after acquiring would be owned by the parent. Okay. He has acquired only A, B, C, not D. Okay. So after he has acquired that, he acquired it. So let us call the acquirer as K. I wouldn't put it as A, then it will confuse with that shareholder, which was A. So let us call the acquirer K. So now he has 75 holding here instead of A, B, and C, right? So 75 plus 25 is 100. At any point of time, assets should be equal to liabilities plus equity. Now let us assume that the acquirer gives a loan to the acquiree or the target. So a loan, it's a liability, so a loan payable. I'll put a P there. Okay, so that is 25. So when he gives a loan, there is cash automatically. So 125 liabilities plus equity and assets should agree. Now, the acquirer has no cash. He finished off his cash. He gave this cash also. So now cash is 0 here. Cash is 0, but he has a loan receivable from the acquiree. I'll put it like this, loan receivable, 25. Okay. So when consolidation takes place, what happens? Now I will show you the consolidated balance sheet. Consolidated balance sheet. Right? This, we are actually consolidating it with the parent's balance sheet. We are consolidating the subsidiary. Now this is the subsidiary now. We are consolidating this subsidiary's balance sheet with the parent. So this capital of the parent would remain. Nothing has touched that. Okay. Now the cash of the subsidiary is the cash of the parent. The fixed assets of the subsidiary is the fixed assets of the parent. So parent already had 25 fixed assets. He would take over, he would consolidate with the subsidiary's fixed assets. So it will become 125. Cash was 0, subsidiary's cash was 25, so he will show 25. The intercompany payables and receivables are eliminated. So that is gone. And the investment is eliminated against the equity of the subsidiary. The minority interest remains. The minority interest is that non-controlling interest, which I explained in my previous video. That would remain. And then the balance sheet agrees 150 on the equity and liabilities side and 150 in the asset side. So this is how, with a very simple example, I've shown you how consolidation takes place. And now if you read the text, it would make more sense and you would understand very clearly. Please bear in mind, you would not be asked a number question on this. If at all you're asked a number question, it will be about the elimination of accounts. You may not have to prepare a balance sheet because that's a very complex exercise. In some professional exams, they ask it for 15 marks. So, but you will be asked word questions and the basic principle behind or principle or concept behind consolidation. when it takes place, when there is control. And when there is control, when there is majority voting rights, voting shares owned by the parent, or if the parent is a primary beneficiary of a variable interest entity. And in order to bring everything onto the balance sheet so that everything is transparent. Now, as I told you, Enron hid many of the liabilities, many of the big liabilities in the variable interest entities. And at that time, it was not consolidated. So the true picture could not be seen. However, if everything is now consolidated, everything would be on the balance sheet and the shareholders would get a true and fair view of the whole thing. So this is the concept of consolidation. In the next session, we will do multiple choice questions to see how you have understood this concept. Hello, everyone. In this session, we will do multiple choice questions on consolidations. In the last video, I have already explained the concept. So here would be the multiple choice questions. In a combination, the identifiable assets of the acquired company and the liabilities assumed are to be recorded on the books of the acquiring company at which one? Always, when a business combination or a merger happens, the company, the acquiring company, would pay fair values for the assets and liabilities, and also something more than the fair value of the assets and liabilities, which would be actually goodwill. So B is the right answer. Not original cost minus accumulated depreciation, not replacement, and not book values. In fact, book values where assets are concerned is nothing but original cost minus accumulated depreciation. So the answer for this is anyway fair values. When preparing consolidated financial statements, the entity being accounted for is actually when the financial statements are consolidated, the subsidiary and parent would be one economic unit. Okay, so when consolidation, the entity being accounted for is the economic entity. Even though they are separate legal entities, when it's being consolidated, it is treated as one economic entity. I've already explained the concept of economic entity in my previous video, where I explained business combination and consolidations. In the process of preparing consolidated statements, consolidated financial statements, which one of the following items does not need to be eliminated? The not is highlighted. So this would give us a lesson also about what needs to be eliminated. Profits, intercompany profits are eliminated. So this is not the answer. We have to select the ones which are not going to be eliminated. Profit on sale of fixed assets to a subsidiary should be eliminated. Dividends receivable from the subsidiary, it's an intercompany receivable, so it has to be eliminated. So that leaves us with this, which does not have to be eliminated. Profit on inventory is sold to an outsider, not a related entity. So it is a non-affiliate, an outsider. So that need not be eliminated. All other things has to be eliminated, otherwise it will be double counted. Panko is a parent. He owns 90% of the voting stock of Spani Corporation. After, just a minute. After consolidated financial statements have been prepared, the entries to eliminate intercompany payables and receivables will be where? It will be on neither company's books. I'd explained this when I was explaining about consolidation. It's a worksheet entries. Those are worksheet entries. Just all are pro forma, just for consolidation. Afterwards, they would operate as separate entities. They are actually operating as separate entities, and the receivables and payables will actually be paid and received. So only for the sake of consolidation, it will be eliminated. And that's a worksheet entry, and it will not be reflected on the accounts, in the accounts of either company. I had explained this. None of the companies would be passing those elimination or consolidation entries. It's a worksheet exercise. So with that, we finished investments completely. And the next, we would be talking about and discussing property, plant, and equipment and the accounting there. See you in the next session. Hello, everyone. Welcome to the new lesson of property, plant, and equipment. So I will just give you an introduction of what we will be studying in this lesson. So basically, under property, plant, and equipment, it's also called PP&E, we would be studying first how to record an asset and what to record. So recording of the asset, what amount to capitalize and what amount to expense it as revenue, right? So then a recording of an asset. Then the different types of depreciation methods. There are several: straight line method, double declining balance method, sum of the years digits method, units of production method, etc., etc. We'll do that. And also depletion. And then third one, impairment. Impairment of assets, right? Impairment of long-lived assets, and how to account for assets held for sale. That also we'll be studying. Then fourth would be intangibles. Yeah, before impairment, even sale of fixed assets we will be studying, the entries for it. And with all this, we'll be studying also differences between IFRS and US GAAP on this topic. So intangibles like patents, copyrights, goodwill, etc. Okay. So yes, we'll put goodwill as a separate chapter because it's a different kind of intangible. And also impairment of goodwill. And all the while, we would be studying difference between IFRS and US GAAP. So these are the topics for study. These are the topics for study. So what the first one would be recording of an asset. So how do we record an asset? So let us go to the text and find out what it has to say on this topic. So initially, recording of the asset, right, is all costs. You see the bold item there, all costs and necessary to get the asset ready for use. Okay, so if it is a building, the purchase price, renovating, cost of permits, etc., insurance paid during construction, and materials, labor, and overhead construction, everything, overheads of construction. And then if we are talking about machinery and equipment, the cost of the machine, freight in, handling, taxes, testing, even testing and installation, right? And if he also says one interesting thing here. For example, a wall needs to be torn down and to install the machinery onto the factory floor. If the wall needs to be torn down to install, the cost of demolition and rebuilding the wall is also capitalized to the machinery, because it's all part of making the machinery ready for use. Now, I'll just show it to you on the whiteboard. I'll erase all this so you have an idea what we need to be studying. So, you see, suppose a machinery. Let me draw a strange kind of huge machinery. Okay. And this machinery cannot come within the factory door because the door is too small. This is the factory, by the way. Excuse my very crude drawing. Okay. So such a huge machinery cannot come into this factory door. So what do we do here? We would actually demolish part of the walls. I demolished the whole factory, by the way. That's not the way. Maybe they make the wall, the doorway a little more bigger. Okay, so they make the doorway more bigger. Okay, they demolish it first. They demolish the old doorway and make it bigger. And this is the factory. I'm in the way here. I'll move myself. Okay, I'll move it right down. Okay, so this is the factory, right? They had to actually increase the doorway in order to fit in the machinery, right? So then the machinery can come in now here. So, okay, this is the machinery, by the way, little bit different shape as compared to what we started off, but you get the idea. Now, the issue is the cost of demolishing it and then rebuilding this doorway would also be capitalized to the machinery and not expensed, because it's part and parcel of making the machine ready for use. So even if we have to train the personnel initially, right, it would be capitalized to the machinery cost. Even testing, installing, everything would be capitalized, all the cost to make the machine ready for use. So that is the concept you should keep in mind. Okay, so then let me just share it. Yeah, the cost of improvements made to machinery after its acquisition should be added, also should be capitalized, in other words, if it provides future benefits. See, there is a rule here. suppose the cost of improvement would make the machinery last longer, right? Make it better, right? Make it better, and would generally, yeah, making it better is to improve it, right? So if it makes the life last longer than usual, and if it makes it better, then those costs should be capitalized to the original cost of the equipment. It should be added to the original cost of the equipment. Just, you see, it's like this. Suppose you are doing something to the machinery, like maintenance, just maintenance. So that will be expensed. Okay, suppose you have a factory and you're just painting it, right? When you're painting it, it's not bringing any additional benefit. It is bringing it back to the original state what it was. So those kind of expenses you would actually expense it off. Okay, you will not capitalize. But if it's going to make it longer and better, you would definitely capitalize it. And for land, anything that, you know, if you have to demolish something, yeah, cost of purchasing and raising or destroying an existing structure, right? And any other costs, any taxes paid in order to get a clear title, right? So all that would be capitalized to land. Okay, so cost of destroying an existing building are included in the land cost because it is making the land ready to use, right? So that's what. And then the building is a constructed, that would be capitalized to building, right? So any proceeds resulting in preparing the land for use should be treated as reduction in cost of land, not income. That is when there are some proceeds from sale of an asset resulting from preparing the land and making it ready for use. For example, I'll just give it to you an example. Suppose we have a land here and there are several trees, right? There are several trees on the land. The cost of removing these trees, okay? The cost of removing these trees. And when you sell these trees, maybe there are many trees. The proceeds of that could go to reduce the cost of the land, right? So if the land is like $100,000 or 1 million or whatever it may be, maybe the proceeds from selling the trees, because there could be many trees. It's like a forest probably. And the proceeds from selling all those trees could be a good $10,000 maybe. So the land cost is now 90,000. You don't take it to income. That's what he means here, right? So these are the costs to be recorded. And for machinery, he's saying freight in, handling charges. Now, if it's imported, the customs duty is also going to be capitalized to the machine, right? So that is about recording and the cost to be capitalized. Okay, the note is very important. When a company constructs fixed assets for its own use, self-constructed assets, it will often need to obtain some financing to pay for the cost of constructions. In some cases, the company can capitalize some of the interest it incurs on external financing. Okay, capitalization of interest is covered in other textbooks like the CPA, for example. It's not tested in the CMA exam. Otherwise, it's a very interesting procedure, what they follow in order to capitalize interest costs. But if they buy a ready-made asset, by taking a bank loan, that interest is not capitalized because it's not a part of cost incurred to make the asset ready for use, because the asset is already ready for use. Okay. So that interest cost for a ready-made building cannot be capitalized. It has to be expensed. So that's about it. Let us test our concepts with multiple choice questions in the next session. Hello friends, welcome to another session on property, plant and equipment. We spoke about how to record an asset, what to include while capitalizing an asset. And in this class, we are going to do some multiple choice questions and test that concept. As I told earlier, you have to do as many multiple choice questions as possible in order to get some kind of mastery over the subject. Just theoretical knowledge or just looking at the explanation would certainly not help. Please note that, right? So you have to also work out plenty of it, and plenty of multiple choice questions, and while doing it, you have to get a concept, right? So you have to understand the concept. So now this question says that a steel press machine is purchased for 50,000 cash and a promise to pay an interest-bearing note payable was accepted. Okay, so the cash, the price of the machine is actually 150,000. And in addition to that, you would include the additional costs of the following, except one. The except is bold-faced, if you notice. So yes, freight and handling would be included, sorry. It would be included in the original price of 150,000. Insurance while in transit included. So he's asking what will not be included. So that would be the answer. Interest on note payable will not be included, and that is the right answer, because interest is something which is not spent to make the machine ready. The machine is already ready. Interest is a financing option, right? The person, the company, if they had cash, they could have purchased it for 150,000 and finished. That's it, right? They choose to pay 100,000 by a promissory note, interest-bearing note, and that interest cost does not make the machine ready. The interest cost could be exorbitant. So are you going to put that value onto the machine? No, that is the cost of financing. So that is not included as a part of the fixed assets cost. Assembly and installation costs are to be included because that would make the machine ready for use. So C is the right answer. Let us go to the next question. It's a level A kind of question, basic knowledge. The value of property, plant, and equipment that is included in total assets in the balance sheet is market value, replacement value, acquisition cost. The most accurate is cost minus accumulated depreciation. So D is the right answer. See, whatever you have purchased it for originally, the historical cost minus accumulated depreciation is what we would record on the balance sheet. Market value in US GAAP, we never upgrade the assets. We do not mark it up. We do not bump it up, right? Acquisition cost is not complete. Yes, acquisition cost is nothing but the cost, not only to acquire, but to make it ready for use, minus accumulated depreciation. So D is the right answer. Here is a question wherein they have included several costs and they are testing you, what would you record? Right? So try to do it by yourself, pause the video, and then look at the explanation. 63,000 is the cost of the machine, so that has to be included. I'll put it everything. At one look at it, I know that I can make it in thousands. Okay, so I truncate the zeros. So 63,000, of which 20,000 was given as a down payment. Don't add that, please, because it's already included in this. It's a part of 63,000. And then the remaining was borrowed at a 12% interest. Okay, so he would have to record 63,000, right, of which he has paid cash of 20,000, and a liability he has to record for the remaining. And then additional cost included 2,500 for shipping. You have to add that 2,500 for shipping. Okay, and 4,000 for installation. It's a part of making the asset ready for use. So 4,000 should be added. 3 for testing. Without testing, initial testing, you cannot make the asset ready for use. And 1,290 interest, no, we don't include this. It's not a part of cost to make the asset ready for use. It's a financing decision. So what should be reported for this acquisition? All this. So if you do the math, it's going to be 63 plus 2.5 plus 4 plus 3, 7. So it is 72,500. 72,500, and C is the right answer. So I think now you are getting better at this. You know clearly what to include and what not to. But the next question is a very interesting one. It is CIA. They always give you quality questions. Many students go wrong here. So try to get it right. First of all, please note, he's asking what is not correct. So don't end up ticking something which is correct. What is not correct? Which of the following is not a correct statement regarding the historical cost of fixed assets? That is the amount you would capitalize, in other words. A, purchase price, yes, will be capitalized. Freight cost will be capitalized. Installation cost will be capitalized. Yeah, it should all be included. So this is not the answer because it's all correct. We have to see the wrong one. Okay. Proceeds obtained in the process of readying its land for its intended purpose, such as from sale of cleared timber. If you remember, I discussed the same thing when I was explaining about what to capitalize in the previous video. So, such as from sale of cleared timber should be recognized immediately in income. No, this is wrong. It should go to reduce the land cost. It should go to reduce the land cost. So B is the right answer because it is not a correct statement. So as I explained earlier, you have a land, you have plenty of trees there, right? And the land is not ready for your intended use with all these trees here. So you paid 100,000 for this land, and then you chop off all the trees and sell them. Do not take that to income. It goes to reduce the cost of the land, because had you spent something on demolition to make the land ready for use, you would have added that to the cost of the land. So now you would reduce it, and 90,000 will be the cost of your land. Do not take it to income. So B is not correct. So that is the right answer. The cost of improvements to equipment incurred after its acquisition should be added to the assets cost if they provide future service potential. This is correct, because as I told you, the cost of improvement, if it makes the machine better, bigger, if it makes the machine or the asset better, bigger, and gives it longer life, then it has to be capitalized. The cost of improvement has to be capitalized. What do I mean by bigger? So now you have a one-storied building, right? You have a one-storied building, and you are going to construct one more. So this, you cannot put it as maintenance, right? Obviously, you have made the asset bigger, right? So that has to be capitalized, right? And you change something which was now going to make it better than what it was previously. Now, just painting the house is bringing it back to its original condition. So that is not going to be capitalized. It is a part of maintenance, right? And if you're adding something to your asset which makes it better, makes it bigger, or makes the life longer, then it should be capitalized or included in the cost of the asset. So this part is right. Not the correct answer though. So this is a very good question, because you know the right things here. There are many correct statements here. D, special assessments imposed by the local government. Now the local government is charging something to actually bring sewage and drainage systems to the land, right? So it's recorded by the owner of the land in the land account, which is correct, because these expenses are required to make the land ready for residential purposes. So definitely it has to be included in the cost of the land, but not the building, because it's making the land ready for construction, for residential purpose. So B is the correct answer. I hope with this you got the concept of what to record. You have to work out much more multiple choice questions. There are plenty in the Hawk question bank. Please do work out. If you have a problem, I'm always there to help you. Hello, friends. Welcome to the lesson on depreciation. In the last class, we studied about how to record an asset, what items to include to record an asset. And once the asset is recorded, you would be depreciating it. So let me just explain you the different kinds of depreciation and why we depreciate it. So basically, depreciation, as the word suggests, is bringing down the value of the asset. We are depreciating it. So we are bringing down the value of the asset. And why do we do this? It is a rational allocation of expenses, a systematic rational allocation of expenses throughout the life of an asset. So basically, if the asset is costing 100,000, the benefit of this asset is going to happen over many years, not 1 year, right? So suppose the benefit of the asset is only for 1 year, we would expense the entire thing. We wouldn't calculate depreciation and systematically allocate it to many years. Maybe in year 1, year 2, year 3, okay, you're going to get revenue from this asset as maybe the first year 50,000, and maybe the next year 75,000. Okay, I'm just putting some figures, and the third year maybe 25,000, right? This is your revenues. I'm assuming some revenues. Now just let us suppose that you expense the entire thing in 1 year, show a loss, and later on show all this as income. What's wrong in this? What's wrong in this? There's no proper matching of expenses with revenues, right? So since this is going to happen over a period of time, the benefit of it is going to happen in a period of time. So wherever the revenues are there, you put the expenses there and match it, right? So maybe on a straight line basis, you would charge, let us say 33,000, because 3 years I've assumed. So 33,333 for every year. So this would actually bring in some expenses. And you see now what happens is, at least the years are not in a loss. Of course, here it will be a loss. At least here it will be a profit. Okay, profit. And maybe I put this as 35,000 just so that it isn't a loss. So this will be a profit, and there is proper matching of expenses in income, and that is the reason we depreciate an asset, right? Also, assets depreciate due to passage of time and wear and tear. The more you use it, the more it would get depreciated. But let us assume that there are two assets like this, identical assets. One is kept as a redundant, a spare asset, right? But this is in use, this is not in use. This is not in use. So my question to you is, would you charge a depreciation for this not in use asset also? It's not generating any income, it's just kept aside just as an emergency. Would you charge depreciation on this asset also? The answer is yes. So it is not only the assets which are used, which have wear and tear, but even due to passage of time, the assets would wear off. For example, especially in a coastal region or anywhere for that matter, even passage of time, the asset does get older, and sometimes the asset would depreciate or deteriorate faster when not in use, right? You can experience it if you don't use your car for a long time. It will not start, right? So I feel the assets which are not in use should be depreciated at a higher rate than the assets in use. Okay, so just because an asset is not in use, it doesn't mean it should not be depreciated. So that's one point you should remember. Next is, land is never depreciated. Land is not depreciated. Now, when I ask my students, why is this? Many of them say, because land always appreciates in value. That's not the reason. I have a land in a remote area, which we purchased somewhere around in the 80s. And now it's not appreciated. It's in fact going down in value because that was a lousy investment. And it's not developed, that area, so it's not going down in value. So please don't think that land is not depreciated because it appreciates in value. Yes, usually lands do appreciate in value, but that's not the reason why it's not depreciated. It's not depreciated because it does not have a finite life. Its life, the land which we are on, it may be millions of years, right? So there's no definite life or fixed amount of years for it, right? It's infinite. So it does not have a finite life. So that's the reason we are not depreciating land. All the assets do have an estimated useful life, right? So that is the reason we would depreciate them. Another point to remember is in US GAAP, we never bump up our assets. We don't increase the value. We don't revalue it and put the fair value, right? The fair value might be higher, especially for land. We don't put that higher value because there's no objective value which we can see. Even if we get a professional valuer, one valuer would value the land or building differently from another valuer. So there's no objective base for valuing the land. So we go by historical cost less depreciation, right? So historical cost has evidence, the amount we purchased and all the additional costs have proper documents. So there is evidence to it. And so it's recorded at that. However, under IFRS, they can revalue the asset as per the fair value and upgrade or bump up their assets or increase the value of the assets, right? The increased value would go to comprehensive income. IFRS permits revaluation for its assets or a class of assets. US GAAP does not allow revaluation. Please remember that, right? Now, the different kinds of depreciation. Let us talk about the straight line method. Why is it called the straight line method? Because it's equal depreciation for all the years. So if I got year 1, year 2, year 3, every year it might be, let us say, 20,000. So if you plot the graph, you get a straight line. It's equal, right? So that's the reason it's called straight line method. Now let us assume that we have an original cost of 100,000. Salvage value. These are the data required in order to depreciate. Salvage value of 4 years. I'm sorry, salvage value 10,000. And estimated life is also required. Estimated useful life 4 years. So how much will you depreciate it? The 100,000 minus the salvage, which is, I'm sorry, salvage is 10, is equal to 90,000. And this is called the depreciable base. Okay, this can be depreciated over 4 years, divided by 4 and charge it equally. So straight line method and the unit of production method is the only non-accelerated method. What do you mean by non-accelerated method of depreciation? Accelerated methods are depreciation methods which charge more depreciation in the initial years and lesser depreciation in the later years. Whereas straight line method just charges equal depreciation throughout all the years. So the depreciation amount for each year would be 22,500. And how do you present this? In the balance sheet, we never adjust the original cost. The fixed asset account is carried separately in a separate account. And as a contra asset, we would put the accumulated depreciation.
Contra asset is showing an asset, showing an expense, an item with a minus sign on the asset side. Because generally the expense entry would be debit depreciation expense of 22,500 and credit accumulated depreciation 22,500. A lot of shortened forms here, so please listen carefully what I'm saying and it'll be clear. So this is shown here. You do not adjust this. So 22,500 is shown here, and this one is called the net book value. After deducting it, the net book value is 77,500, also called the carrying amount. So net book value. So you would depreciate it, and after all the years depreciation, what would remain would be the salvage value. The accumulated depreciation on the fourth year would be 90,000, and you would have the salvage value as the carrying amount or net book value. So that's about straight line method. Now, double declining balance method is as follows. So basically, you have cost, again, the same cost. I'm taking the same thing, 100,000. The estimated useful life is actually 4 years, and salvage is 10,000. Now, to find out the depreciable base, we do not deduct salvage value from the cost in double declining balance method. This is the only method where salvage value is not deducted, because I will just show it to you. So what is the percentage of depreciation? The rate would be, assuming 100, because you are talking about percentage, assuming 100 as the asset cost, it has a useful life of 4 years. So it's depreciated at $25 per year. So $25 per year is 25%, because we have taken 100 as the asset. So this is 25%. We would double that in double declining balance. Okay. And we would depreciate the asset at 50%. We do not, I repeat again, we do not minus salvage value from the original cost. So the first year, the depreciation would be, 100,000 is the original cost. The first year is 50% into 100,000, so 50,000. The book value after that is going to be 50,000. The second year, also 50,000, 50%. So that is 25,000. The third year is going to be 12,500. 50% of 25,000. Now the last year, 50% of 12,500. 12,500 into 50%, 6,250. Are we going to put here 6,250? No. Since we have not deducted the salvage value, you will depreciate until the salvage value, so that at the end of the period, at the end of its useful life, it should have the salvage value. So you know the salvage value is 10,000. So the fourth year depreciation should not be 6,250. It should be 2,500 to make the balance or net book value as the salvage value. So at the end of any asset depreciation, the net book value should be the salvage value. I hope that's clear. Had you minused the salvage value in the beginning itself and then calculated depreciation, so this would have been 45,000, you are showing lesser depreciation for the years, right? Right, and you will not have exactly the salvage value if you do it this way. Okay, so what we do is depreciate it until the salvage value, right? So the double declining balance is the only depreciation method where salvage value is not deducted. Okay, so that must be remembered. The next method is the sum of the years digits method. Also an accelerated method like double declining. If you notice, the double declining balance was accelerated, right? In the first year, we had 50,000. In the second year, we had 25,000. In the third year, we had 12,500. So what is happening here? More depreciation is charged in the initial years, and it gets lesser as time goes. So that is an accelerated method. Now, sum of the years digits is also accelerated because it would charge more depreciation in the initial years to the income statement. So how does it work? It works like this. We take the same thing, the cost of the assets, cost would be 100,000. Life is estimated useful life 4 years. Salvage 10,000. So here we do minus the salvage value for the depreciable base. So 90,000 is to be depreciated over 4 years. So now what do we do for this? Over 4 years. So we would take the sum of the digits of these 4 years. 4 plus 3 plus 2 plus 1, which is equal to 10. So the first year depreciation would be 90,000 into, since it's an accelerated method, we would put 4 divided by 10. So the first year depreciation would be 36,000. Yeah, 36,000. Right? And the second year, 90,000 into 3 by 10. 3 by 10. So that would be 27,000. And third year, 90,000. By the way, the accumulated depreciation is going on building up. Okay, so third year is going to be 2 by 10, which is equal to 18,000. And the fourth year, the final year, is going to be 90,000 into 1 by 10, which is equal to 9,000. And by this time, if you add up all this, you would have 90,000. So 36 plus 27 plus 18 plus 9 is 90,000, right? And the balance sheet presentation at the end of the fourth year would be 100,000, the original cost of the asset, less accumulated depreciation of 90,000, and the book value would be the salvage value, 10,000. And if you notice it, it's falling steadily by 9,000 every year. So it's an accelerated method with more depreciation in the initial years and lesser in the later years. So if you graph this whole thing, all the depreciation methods that we studied so far. In fact, there was a question like that in the CMA exam. They had given you a diagram like this and told to mention, they could put this curve as A and this curve as B and this curve as C, falling steadily like this. Okay, pardon my figures, not so good, but it's a straight line anyway. I asked you in the choices that A is double declining, B is straight line, C is sum of the year's digits. So you have to select the correct answer. And as it's evident here, this is definitely straight line method. A is straight line method. B is double declining. And C, if you saw, there was a steady drop of 9,000 of depreciation expense. Steadily, it's dropping by an equal amount. So the C is the sum of the year's digits method of depreciation, right? So they could put this in a multiple choice and ask you this, right? So there's one more method which is not accelerated. It's called units of production method. Now, units of production method is taking the original cost less the salvage value, right? And now out of this, we are going to estimate how much of units you can produce, not the years of life, the estimated amount of units. Let us say we can produce 45,000 units. Then the depreciation per unit is $2 per unit. So if in any year, let us say first year, they produced, let us say 15,000 units or lesser. Sometimes production in the initial years would be very less, right? So I would not say 15,000, probably less in the initial years, or sometimes could be more as well, right? Or let us say, assume that it's going to be less, say about 2,000 units. Then the depreciation would be 2,000 into $2, which is equal to $4,000. This is a perfect matching of revenues and expenses, because if they produce 2,000 units, they would sell 2,000 units and the revenue would be for 2,000 units. And the expenses is exactly for 2,000 units in the form of depreciation. So that's what it would be. And later on, maybe they would increase the units, maybe it's 4,000 units, then the depreciation would be higher, right? And this, based on this principle of units of production, we also calculate depletion based on this principle. Now, depletion is for wasting assets which gets wasted out and something is taken out of it. Like, for example, natural resources, like a forest, or an oil field, or a coal mine, where something is removed from it and it's getting depleted, right? The word depleted is used. It's not getting depreciated, it's getting depleted, it's getting wasted out. A quarry, for example, a quarry rather. So that's all that is going to be depletion, which is on the same method. You would take the original cost, maybe the land cost is originally 100,000. There's a salvage value, a residual value probably the land would have at the end of it. And 90,000 would be allocated to the resources. Let's say it's a forest and there are a number of trees here. Okay, maybe there are 10,000 trees. 10,000 trees. Okay, so they are going to remove this. So 90 divided by 10 is $9 per tree. So any year if they remove out 2,000 trees, the depletion charge would be 2,000 into 9, which is equal to 18,000. Right? So that is how it would be charged, where for assets like natural resources. Right? So with this, we completed the different kinds of depreciation. Of course, there's tax depreciation, which we would talk about later. These are the depreciations which would be used for financial purposes. Let us do some multiple choice questions in the next session, since I have explained the concepts here. Hello, everyone. Welcome to the class of property, plant, and equipment. And now we are going to do depreciation. And in the last video, I have explained the different methods of depreciation. And in this class, we are going to solve multiple choice questions. So let me share the question bank with you. Right. So now, here, pause the recording, have a good look at it, and then try to solve it yourself. And after that, look at my explanation. So what do they want here? They want straight line depreciation. They want straight line depreciation. With a half year's convention. What is the half year's convention? It is that the companies, instead of being too finicky about the calculation of depreciation, they would take half year's depreciation in the year it's purchased, and half year depreciation in the year it is sold, irrespective of whether it is purchased in the beginning of the year or at the end of the year. The depreciation would be half year. And even when it sells the asset, it doesn't matter whether they sell it in the beginning of the year or at the end of the year, it would be half year's depreciation. So the amount of depreciation under the straight line method for the year ended 31st May year 2. Now don't get confused. It's not that we are finding the depreciation for the second year. Anyway, it's straight line method. So the depreciation will be the same. This is for the first year anyways, right? Because they purchased it at the beginning of the fiscal year, which is June 31st, year 1. And it's the beginning of the fiscal year. And the fiscal year ending is 31st May, year 2. So it's just basically 1 year, the first year. So how do we calculate this? With the half year convention, 43,200 minus the salvage value. So 43,200 minus 3,600 is 39,600. This is the depreciable base. Divide this by the number of years, which is 8 years. You get the depreciation for a year, that is 4,950. Notice that there is in the choices, there is 4,950, but this is not the answer. This is not the answer for the reason that there is a half year convention. So there should be half years per depreciation in the year of purchase. So 4,950 divided by 2 would give us 2475. 2475. And A is the right answer. So that's straight line method with a half year convention. Now let us talk about the same question. They've asked us to find out the double declining balance method. So look at the question carefully. They've asked us to find out the amount of the double under the double declining balance method for the fiscal year ending 31st May year 3. So that's the second year of the asset's life. And he has also told you that, has made it slightly easy. And here there is no longer the half year convention because we are going to calculate depreciation for the nearest whole month. Anyway, that doesn't apply here so much because it's purchased on 1st of June, right? So basically 1st of June year 1 to 31st May year 2 is 1 year, the first year. Then 31st May year 2 to 31st May year 3 is the second year, right? So anyway, they've told you that. And how do we do it? Now let's go to the main question. There is no half year convention here. So what do we do? For double declining balance, we would never take salvage value. I explained that when I was doing the depreciation methods. No taking salvage value. In fact, we depreciate it until the salvage value, right? So he has asked you for the second year. So this is 31st May year 2, that is the first year. The depreciation is calculated as follows. 100 divided by 8. So per 100, the depreciation is 12.5%. 12.5% because it's for every 100, it is 12.5. Right? So the double declining, this is as per the straight line method. So you calculate the depreciation as a percentage by straight line method and then double it. So 25% is the rate which would be applied to the depreciable base, which is actually 43,200. To the full amount, rather, the full cost. So 43,200 into 25%, it's 10,800. Remember, there's no half-year convention. When he's asking you about double declining balance, he told to calculate to the nearest whole month. So minus 43,200 is 32,400. It is 32,400. And we'll calculate 31st May year 3 depreciation, which is 32,400 into 25%, which is 8,100. Stop at that and see the answers. 8,100. B is the right answer. B for Bravo. B is the right answer. So remember, what's the takeaway here? In order to find the double declining rate, we take 100 divided by 8. That would be the rate for the straight line method. Just double it. That is for double declining balance method. And each year, the depreciation is not going to be the same. It depends on the written down value. Let us go to the next question. The same data. The next question asks you the sum of the year's digits for the first year. Sum of the year's digits. So, yeah. Remember one thing. For all methods of depreciation except double declining balance, salvage value is minus. For double declining balance method, the salvage value is not deducted. So here the depreciable base is 43,200 minus 3,600, 39,600. This is the depreciable base. Now, we have to find out the sum of the digits for 8 years. So 8 plus 7 plus 6 plus 5 plus 3 plus 2 plus 1 is equal to how much? So 8 plus 7 plus 6 plus 5 plus 3 plus 2 plus 1. I think I made a mistake. 8 plus 7 plus 6 plus 5 plus 3 plus 2 plus 1. So 5, 6, 7, 8. No, I missed a 4 here. Okay. So I'll do it again. 8 plus 7 plus 6 plus 5 plus 4 plus 3 plus 2 plus 1, which is equal to 36. Now, instead of adding up everything like this, suppose if it's 15 years, it becomes very, very laborious to add 15 plus 14 plus 13, etc. So we can apply a formula here. We will not go into the derivation of the formula. We just use some of the mathematical tools to make it easier. N into n plus 1 by 2 would give us the same result, where n is the number of terms. As you know, the number of terms is 8. From 1 to 8 is 8. So 8 into 8 plus 1, 8 plus 1, which is 9, divided by 2 would give us the sum. So 8 9s are 72, divided by 2 would be 36. We get the same result in a much easier way. So why are we taking the sum of the digits? When I explained the depreciation methods, I did not explain why we are taking the sum of the digits. So here I will just make an attempt to explain it. Now, let us take an asset with 4 years life. What's the sum of the digits? 4, applying this formula, 4 into 4 plus 1 divided by 2. So which is equal to 4 into 5 divided by 2, which is 20 divided by 2, and it's 10. That's the sum of the digits. Now, why did we take the sum of the digits? Because the first year is 4 by 10. First year depreciation is 4 by 10. The second year depreciation is 3 by 10. And the third year depreciation is 2 by 10. And I'm sorry, this is the first year. Yes, correct. First year, second year, third year. And the last year depreciation is 1 by 10. So when we have taken the sum of the digits, the sum is 10 and 4 plus 3 plus 2 plus 1 is also equal to 10. And that way we would charge 100% depreciation. So it becomes 1. That's why we take the sum of the digits. And when we take 4 by 10 and 3 by 10 as depreciation, it would actually sum up the whole asset or depreciable base. So the entire thing would get charged to the P&L. So that is to ensure that we take the sum of the years. Now, for this one, 39,600 is the base. And the first year would be 8 divided by 36, the sum of the digits. So 39,600 into 8 divided by 36. 39,600 into 8 divided by 36 would give us 8,800. 8,800. So that should be the right answer. This one. Yeah, it's there in B. So B is the right answer. So now basically we have seen in this particular question, the straight line method with a half year convention, a double declining balance without, it's actually a full year's convention. Now this one is a full year's convention, full year's depreciation on all assets purchased, but no depreciation when they are sold. Okay, the double declining balance was the normal double declining balance question was the normal question where we would take depreciation for a in the month it was purchased, right? So what was the wording exactly? It was said that calculates depreciation to the nearest whole month. So that's what we did. We didn't have a problem there because it was purchased on 1st of June. So this one, for sum of the year digits, it is 8,800. So we have done straight line with a half year convention, double declining, normal, and SYD with a full year convention, where full year's depreciation is charged on the assets purchased during the year, no matter when you purchase it, January or December, you charge full year's depreciation under the full year's convention, and no depreciation in the year the assets are retired. Okay, so that's what it is. 3 methods have been dealt with in this particular question. Let us see if there are any more multiple choice questions which gives us a different concept. We'll see to that in the next class. Hello everyone, welcome to the class on depreciation, and now we are going to do questions, multiple choice questions on different depreciation methods. So let us go to the question. So basically we have done, if you remember, we have already done in the previous session multiple choice questions on the straight line method with a half year convention, a double declining balance method with normal depreciation, and an SYD, sum of the year's digits, with a full year's convention. Now here we are going to do units of production method of depreciation, right? So let us see how it goes. The units of production method. Pause the recording, try to do it by yourself. So basically, they have put the machine into operation during the second half of the year because the company employs a calendar year. A calendar year for financial reporting is from January to December, right? And so they basically put the new piece of equipment in operation for on July 1st. So first of all, let us find out the depreciable base, 300,000, the cost less a salvage value of 30,000 would give us 270,000. This is units of production method. It's not considered an accelerated method because it depends on the production. If less amount is produced, definitely lesser depreciation would be charged. So the total estimated units is 400,000, which gives us a rate of depreciation per unit as $0.675, right? So in the first year, that is from the period of July to December, its calendar year, 34,000 units were produced. So 34,000 units into 0.675 would be the depreciation. So that would be 22,950. Right. So C is the right answer. Now, what students do generally is, since they have put it into operation only during half the year, they would do 22,950 divided by 2 and get 11,475. Okay, that is wrong because you don't have to, even though it has been put into operation for only half the year, you don't have to divide this 22,950 by 2 because since it was put into operations for half a year, the units also would be lesser. For example, if it was placed in operation for the full year, probably the number of units would have been 68,000 or close to that number. So since the units are 34,000, these units are actually showing half year's production, and that is why half that itself would actually indicate that depreciation is half the amount. Okay, so we don't have to make 22,950 divided by 2 again. So that will be making it half twice, right? So this itself represents half year's production, and appropriately the depreciation would be 22,950. I hope you understood this. So C is the right answer. So now what remains is the depletion method. So depletion method, also we would do that question. Right, this is the question for depletion method. This question has a very low strike rate. The reason being the language. Some people misunderstand the language of this question. So pause the recording, try to do it by yourself, and then look at the explanation. So now, we have to find out the depletion amount for 10,000 tons of ore, 10,000 tons of ore in 2009. right? And what is the appropriate calculation? That's what they're asking. Now, if you notice, the depreciable base is 600,000, the cost of the land minus the salvage value, which is 100,000. So 500,000. And at the time they purchased it, the estimated ore was 200,000. So divide this by 200,000. This method is depletion because it's on natural resources which are depleted. So this would give us 2.5 per ton. And thereafter, from 2001, it was placed in operation up to 2008, that is 8 years, they extracted 100,000 tons of ore. So in that period of time, the depletion would have been 2.5 into 100,000. So that is 250,000. So basically, what we have done here is 600,000 minus 100,000, which is the salvage value, minus 250,000, and that would be the amount of the intangible. This is an intangible because it's a right, or if they have purchased a land, okay, so probably it's their own asset. Okay, so that would be the value of the land in the beginning of 2009, right? So how much is that? That would work out to be 600,000. 600,000 minus 100,000 and 250,000 would be 250,000, right? It would be 250,000. And now this is where people go wrong. The revised estimate of ore still to be mined is 250,000. What they would do is they would take 200,000 was the initial one, 100,000 they have extracted already, and then they would add that extra 100,000 to this 250,000 and make it 350,000. That's wrong, because now they have revised the estimate of ore still to be mined. So it should have been 100,000 more. It is 250,000 because they found a very promising vein. So instead of 100,000 to be extracted, it's now 250,000 to be extracted. It includes that extra 100,000 of the previous estimate. Okay, so this 250,000 would be divided by 250,000, and you are going to get $1 per ton into 10,000 into a 10,000 tons, which would be $10,000. That would be for 2009. So what did we do here? If you notice, we did 600 minus 100, the salvage, minus 250, which is already extracted, divided by the revised estimate 250. This is exactly what we did. Got 1 and into 10,000. So basically D is the right answer. In the first one, it's all wrong because they have not taken, because we are talking about 2009. So they have not here taken how much was already extracted. And this is all wrong. This one, Also, they are not taken how much was already extracted, and this is not correct. Many people do C as the right answer, but it's wrong because you don't have to add the previous estimates of 100,000 to the the revised estimate of 250,000, because the revised estimate of 250,000 includes the previous unextracted 100,000. So this part is not correct. So this is right. D is the right answer. With that, we finished doing multiple choice questions on all the methods of depreciation and depletion as well. And in the next session, we'll speak about impairment. So it doesn't mean that you have to stop working out depreciation questions. You have to continuously work out. And if you find any problem, if you cannot get the particular question, there's always question hours to have a live session with me, and I would help you solve it. Hello, friends. In the last class, I discussed about types of depreciation, and we did questions on depreciation as well. So this class, it would be about impairment. But before that, let us have a look at the text and find out which depreciation method is best for the company. Yeah. So if we are talking about the depreciation method, there is no such thing as the best depreciation method. Okay, the company has to select the one which best suits their stream of income, rather than choosing a depreciation to window dress their financial statements. That is, to make their financial statements look good. That shouldn't be the motive of selecting this depreciation method. So as it says here, the method of depreciation should not be selected to result in a desired net income, but you should select a depreciation which best matches the revenue stream. That is, for example, if the management expects a steady revenue from the asset, then straight line method of depreciation is best. If the management expects a higher revenue in the beginning of the year, in the earlier years, and later lower revenue as the asset gets older, then an accelerated method of depreciation like double declining balance or SYD, some of the years digits, would be good, would be best suited, rather than a straight line method. And if revenues from the asset is expected to be lower in the beginning years and later it picks up, then the best method would be not an accelerated method, but units of production method, because that would charge depreciation just for the amount of units produced in a particular year. So that way the company should select depreciation methods which is best suited for its revenue stream, right? Okay, so that's about depreciation now. Now we would go to impairment. Now, what exactly is the difference between depreciation and impairment? In both cases, we are reducing the value of the asset in both cases. So then what is this? See, I'll give you an example what it can be, the difference between depreciation and impairment. Now, as human beings, we are all getting depreciated every day. As days go, we are getting older, and our bodies are depreciating, right? And the same thing happens to assets. However, suppose, God forbid, we meet with an accident, and then our leg or hand gets amputated, for example. I'm giving a very bad example, actually. But if something happens which would be a permanent disability, then we are said to be impaired. Similarly, that same thing can happen to an asset as well. Because of new technology, the asset's value goes down. So depreciation is due to wear and tear and passage of time, right? Just like us, how we are getting slowly wear and tear is happening in our body, as well as we are getting older, right? So that is depreciation. Impairment is some permanent disability. Now, in assets, it would be new technology, or the market price of the long-lived asset or the group decreases significantly, right? And also there might be legal factors which would bring about an adverse action for the company. And also the way the asset is being used, maybe it's used more now, this physical condition changes adversely. So many things can be the reason. Okay, and the operating cash flow from the asset has gone down significantly. All those things can happen, for which an impairment is said to be done. Okay, so for that, a qualitative assessment is done just like this to find out whether the asset could have been impaired, right? And then there is a quantitative test. Now here, basically it is a two-step process. First, they will check for impairment. Okay, so first they will check for impairment. I would just give it to you on the whiteboard. I'll give an example on the whiteboard. So impairment, first of all, a qualitative assessment is done to see whether the asset could be impaired. Like I told you, a new technology could have come, or the cash flows of the asset has decreased significantly. In fact, there may be a cash loss. So those kind of things, when it happens, we can judge that the asset is impaired. Then the recoverability test is done. Suppose the original asset cost 100. I'm just giving it a very simple example. Original cost is 100. And accumulated depreciation is 20. And the carrying value is 80. Now, this is the carrying value. And we should see whether it's recoverable. That is, we would check the undiscounted cash flow. Estimated undiscounted cash flow, which is expected from the asset, right? From its use and from its sale, the undiscounted cash flow. So suppose that is like 90. Then impairment has not taken place because it's recoverable. In other words, it has passed the recoverability test. So we don't have to calculate, we don't have to impair the asset at all, because we can get more than the carrying value. The estimated undiscounted cash flows is much more than the carrying value of the asset. By the way, the 80 is the carrying value. Okay, so that's it. It's not, no need to impair the asset. This 100 went off, I'll put it back. Okay, then suppose the undiscounted cash flow is, let us say, 50. Now, the carrying value is higher than the expected recovery from the asset. So, if we hold it, if we carry the asset at a higher value, we are overestimating or overstating our assets. So it has to be written down. So there is impairment here. And then we would check the fair value. We would check the fair value. If the fair value of the asset is, let us say, 60. If the fair value of the asset is, let us say, 60, we would impair it to the fair value, not to the estimated undiscounted cash flows. Not to the recoverable amount, but to the fair value. Right? So what would be the impairment? The impairment is 20. And what is going to be the entry? The entry is going to be debit impairment loss, debit impairment loss 20, and credit, can you guess? Credit accumulated depreciation 20. So now this would become as following. The original cost we are not going to touch. Accumulated depreciation would get an extra 20. Already there is 20 here. So it would become 40. And the carrying value will be now 60, which is equal to the fair value. This is how the impairment takes place. Two-step process in US GAAP. First, you will check whether the asset is impaired, the recoverability test. And once it's determined that is impaired, then you actually write down the asset, right, to its fair value. So that is how it is done under US GAAP. Under no circumstances, the assets are written up, but IFRS allows the asset to be written up. So that is one major difference. Under IFRS, asset can be revalued upwards, and the credit goes to accumulated other comprehensive income, and it is credited to equity in an account called revaluation reserve. Let us go to the text and look at IFRS further. I have already explained US GAAP. So let me go to the text now and look at IFRS. I explained all this, so you don't have to worry. This scenario is given to you, but I have explained it. So impairment process in IFRS is a one-step process, right? That process I will explain in a little while. Under IFRS, a company may increase the value of its fixed asset. This is what I was talking to you about, writing them up, right? And the credit part will go to other comprehensive income and carried in the equity section, I told you, in a reserve called revaluation surplus. If the revaluation is a recovery of a previously recognized impairment, right? suppose the asset was impaired for, let us say, 20, and it is now recovered, it's revalued, its market price or fair value has gone up by 20, then we would credit income statement, because previously the impairment of 20 would have been recognized in the income statement. So a reversal of that or a revival of that would also be reported on the income statement. Decrease due to impairment is recognized in income statement. Okay, unless the loss or write down is a previous increase in its fair value. So if you understand this clearly, supposing they had increased the value by, they can increase the value by debiting accumulated depreciation. You reduce the accumulated depreciation, the value automatically increases. Say they did this and credited revaluation reserve, right, of 20. So it is lying in equity, right? And then there is a decrease due to impairment. Okay, there is decrease in the due to impairment, which is generally recognized under the income statement, but later on, because of this revaluation, there is a credit in the revaluation reserve, and let us say now in future it gets impaired by 20. When it gets impaired by 20, you would actually debit not the income statement, but the revaluation reserve for that 20. Okay, and credit accumulated depreciation, which would bring down the value. Why? Because we are now reversing a previous write-up of an asset. So previously we had written it up, and then subsequently the asset value goes down. So then we don't have to recognize in the income statement in that case, because it would be just a reversal of the previous write-up. You see here, a credit to revaluation reserve is countered by a debit to revaluation reserve. So in such cases, we don't have to debit income statement. Otherwise, impairment loss is debited to income statement and credited to accumulated depreciation, just like in US GAAP. Okay. Now, have you understood that portion? If you have understood that portion, we would actually now look at the impairment process under IFRS. So under IFRS, it's a one-step process. Of course, there would be a qualitative assessment. Okay, and then later on, what we do is, let us take the asset value like we did before. Carrying value is 80. This is the original cost. This is the accumulated depreciation. Carrying value is 80. Okay. Then the recoverable amount is the fair value of the asset. Let us say the fair value of the asset is 70, and the value in use. So value in use is nothing but the present value of the cash flows, okay, of the cash flows to be received from the asset, discounted at the market risk-free rate of interest, right? In US GAAP, if you remember, we use undiscounted cash flows, right? So supposing we find out the present value of the discounted cash flows is like 60, let us say 60, then the write down is done to the higher of the two, higher of the fair value or the value in use. Value in use, I told you, is present value. Okay, so here directly it's a one-step process. We take the present value of cash flows and the fair value and write it down to the higher of the two. Now 70 is higher, so you'd write it down to the higher. The impairment loss is recognized to the higher of the two. So 70 is higher. So if present value was 70 and fair value was 60, we would have written it down again by only 10. So we'll see the higher of either of these two. Okay. So the entry is going to be again debit impairment loss, just the way we did in US GAAP. 10, because from 80 to 70, and credit accumulated depreciation 10. So that is how we would do it in IFRS. And one more difference in IFRS between IFRS and US GAAP is component depreciation. Now, what exactly is component depreciation? I'll just show it to you on a whiteboard. I'll remove this. I've explained this. So suppose there's an aircraft. Okay. If there's an aircraft here, right? And let us say there is an engine here. And then the remaining aircraft, right, with the seats, etc. Right? Right, all this is there, the remaining part of the aircraft. Now let us say the engine's life, it's a main component of the aircraft, that is 5 years. And the rest of the aircraft life, I'm talking 5 years is the life of the engine. And the rest of the aircraft, the seats and everything else is, let us say the life is 15 years. Then the depreciation can be calculated for the engine separately and for the rest of the aircraft separately. So IFRS, in IFRS, component depreciation is a must. In US GAAP, component depreciation is allowed. You can do this, but it is not compulsory. Right? You can depreciate the aircraft as on the whole. But in IFRS, component depreciation must be done. So that's a small difference, not such a big major one. The major one is the revaluation in IFRS is allowed. That is, you can write up your assets. And then the impairment process. In US GAAP, it's a two-step process. In IFRS, it is a one-step process where we would compare it with the present value, which is called value in use, and the fair value. So these are the differences you have to keep in mind under UFRS and US GAAP and IFRS and about impairment. So that's about it. Let's see if there are multiple choice questions in the next session. Hello, everyone. Welcome to the lesson on impairment under property, plant, and equipment. So in this lesson, we are going to do multiple choice questions. I've already explained the concept. So let us attack the multiple choice questions. Okay, so now this question is a question on impairment under US GAAP. So try to do it by yourself and then look at the explanation. So we have an original cost of long-lived assets of 10,000 and accumulated depreciation of 5,500. So that would give us a cost, a written down value, or the book value, or the carrying amount of 4,500. Right? So we would now test it for recoverability, the recoverability test. Okay, but he has also told you that the fair value is 3,500, right? So now the recoverability test is, if he's asking you what is the impairment loss to be recognized if expected cash flow. So the undiscounted cash flow, if the undiscounted cash flow, I'll put it all in short forms, it's undiscounted cash flow. If that is 5,000 and that is compared to the carrying value, the carrying value is recoverable, right? So impairment does not take place here. So under here, no impairment. No impairment. In the second case, the undiscounted cash flow is said to be 3,000. So if the undiscounted cash flow is 3,000, impairment has taken place because it's not recoverable. You're carrying the asset at a higher value, which is overstating the assets. So it has to be, impairment has to be recognized, but you will not write it down to 3,000. You will write it down to 3,500. You always write it down to the fair value, right? And the entry is going to be debit impairment loss debit impairment loss 1,000 and credit accumulated depreciation 1,000, because 4,500 minus 3,500. So the impairment loss is 1,000. So when this happens, the accumulated depreciation amount would go up. So it will become 10,000, and it is existing is 5,500. It would become 6,500, and the carrying amount would be 3,500, which would be equal to the fair value. So that is under US GAAP. So now we'll do it under IFRS. I have selected a question for IFRS. Not exactly this, but we can do this first and then go to the IFRS impairment question. So here, basically, is testing you on the differences between US GAAP and IFRS, which is a must to know. He's asking which is not true concerning the difference. So everything would be true and one would not be not true. So it's a good chance to study which is true, true differences of IFRS and US GAAP. Under IFRS, revaluation of fixed assets, that is writing up the assets, is permitted if their fair value is materially different from their carrying value, while under US GAAP, revaluation is prohibited, which is correct. This is right. So this is not the correct answer because we have to select which is not true. Under US GAAP, LIFO is permitted and IFRS LIFO is not permitted. It's also true and it's not the answer. Under US GAAP, research and development costs are expensed when incurred. While under IFRS, some developmental costs can be capitalized if certain criteria is met. This is also true, and I have not yet discussed it. I'll be discussing it in future when I do intangibles. So, but this is also true. Under IFRS, no attempt is made to report the asset at their fair values. In fact, we do try to revalue the assets under IFRS. Whereas US GAAP does permit, it's the opposite. US GAAP does not permit write-up of assets. But IFRS does allow write-up of assets. So this is wrong, it's not true, but it's a correct answer. So study these three because these are true differences between IFRS and US GAAP. So let us go to that question which I was speaking about. Yeah, this is the question. Read it well and then answer it. So basically, the company Blake Limited has determined that impairment exists on one of its machine, but the company expects he cannot want it. He says he cannot sell it right now. So he's going to use it, right? Then he has to recognize impairment, right? And according to IFRS. So they're giving you the original cost all in GBP pounds. They're giving you the carrying amount. Now this is relevant. Carrying amount is original cost minus depreciation. So this is the carrying amount. Okay. And value in use is the present value of future cash flows that is taken. It's a one-step process. And then the fair value less cost to sell. Okay, when I was explaining the difference, the impairment under IFRS, I forgot to say that under IFRS, it is fair value less cost to sell, which is compared, and the higher of the two is taken. Under US GAAP, we take only the fair value, not fair value less cost to sell. But under IFRS, it is fair value less cost to sell, which is taken in the one-step process. And now you'll write it down to which is higher, the PV or the fair value. Of course, the PV is higher, so the write down the impairment loss to be recognized is 5,000 and not 8,000, because you will not write it down to fair value. Under US GAAP, you will write it down to fair value, but it's not fair value less cost to sell. It's only fair value. This is fair value less cost to sell. I'm sorry, I forgot to mention that while explaining impairment under IFRS in the previous video. So the answer for this is B. With that, we finished about impairment. But then, why are assets called long-lived assets? You might have seen in many places they have said long-lived assets. Because long-lived assets is when the company plans to use it for the foreseeable future. It's not planning to sell it. But if the company is planning to sell it, it is not called long-lived assets. It is called assets held for sale. And that's accounted separately at fair values. So that part I will deal with it. I will explain it in the next session. How to account for assets held for sale. Hello, everyone. So this class, we are talking about assets held for sale. So if the firm plans to sell one of its assets, what's the accounting like? For that, let me go to the text and we'll discuss from there. So what he says here is assets should be reclassified from held for use, that is long-lived assets, to held for sale if it meets all the following criteria, right? Management has a plan to sell the asset or asset group, and the asset to be sold is available for immediate sale. It's already there, ready for selling. An active program to locate a buyer or buyers, and all actions are taking place in order to sell it. The sale will be probable in 1 year's time, unless otherwise mentioned or when something is out of the entity's control. The asset is being actively marketed at a reasonable price, okay, or in relation to its fair value. So marketing is also taking place, and actions required to complete the plan to sell the asset or disposal group make it unlikely that the plan would be withdrawn. So they are going to sell it, in other words. And the sale is probably going to take place within a year. In such case, the asset is removed from the long-lived assets or asset held for use group and is going to be reclassified as asset held for sale at its fair value. So one thing you should remember, at the lower of its carrying amount or its fair value, but here I'm going to underline fair value less cost to sell, right? So it's going to be valued at the lower of, suppose the carrying amount is lower than the fair value, we are not going to recognize the gain there. Unrealized gain is not going to be recognized if the fair value is higher than the carrying amount. We would classify the asset as held for sale at its lower carrying amount itself. However, if the fair value less cost to sell, it's not just the fair value, its fair value less cost to sell is lower than the carrying amount, and impairment is recognized. You know how impairment is recognized: a debit to impairment loss and credit to accumulated depreciation, right? So an impairment loss is recognized for the write down to fair value less cost to sell, right? While it is classified for held for sale, depreciation is not done. It's not going to be depreciated because already it is impaired, right? You would continue, the company would continue to use the asset, but it would not be calculating depreciation, right? Subsequently, if a gain is recognized, now for example, let me just put an example here. Let us say the carrying amount is 80. Fair value less cost to sell is, let us say, maybe 50. Okay, so you have written it down. You will be holding the held for sale asset after the impairment loss. You'll be holding it at 50. How much is the impairment loss you would have recognized? You would have recognized 30, right? And subsequently, now you have dropped it down to 30, right? And subsequently, there is a gain. Okay, so subsequently, if there is a gain, now see, he says here, okay, if the asset being held for sale increases in its fair value, less cost to sell during the period before it is sold, an unrealized gain would be recognized, but only to the extent of the cumulative losses recognized previously for the asset or disposal group. In other words, the asset or disposal group cannot be written up to a book value greater than the last book value it was classified as held and used. That means under no circumstances you will be recognizing a gain greater than this carrying amount. So eventually, if the held for sale asset becomes 60, you would recognize that 10 unrealized gain, right? You would recognize that 10 unrealized gain because it is, you had written it down to 30 previously. So up to this 30, you can recognize, right? Up to the 30, that is up to the carrying amount, the original carrying amount, when it was classified as held and used, you can recognize unrealized gain up to that extent. That means up to $30, you can recognize unrealized gain. But under no circumstances, you should write it up more than this original carrying amount, right? So that is about assets held for sale classification. Let us do a multiple choice question right away to cement this concept. I have just a question for you. Yeah. Try to do it yourself. So here, I hope you are seeing this after pausing it and trying and you have attempted it yourself. Here you should note that the fiscal year is November 30. But as of the fiscal year end, the company had an irrevocable contract to replace its mainframe computer on December 15th. Now, December 15th falls in the next fiscal year. Okay, but of the current calendar year, at a net cost of 750,000, reflecting a trade-in. Trade-in is an exchange of the old hardware for 10,000. The trade-in value allowed by the vendor. That means the new one is actually 760,000. Okay, the new mainframe computer would be 760,000. They are going to, the vendor is going to give you a 10,000 credit for the old exchange, old equipment exchange, And that is how they have come across, they come to 750,000. Okay. So the net book value of as of 30th of November of the current fiscal year is 27,000 of the old equipment. On November 30 statement of financial position, balance sheet, how much he should report the value of old computer equipment, because as of November 30, he has not exchanged the old computer. Okay, but it's as good as held for sale because it's going to be exchanged for the new computer. It will be trading, so he has to classify it as held for sale. So he has to classify it at its market value, or the value which he is going to get from the vendor, 10,000. So he will write it down from 27,000 to 10,000. So he will write it down. He'll recognize an impairment loss of 17,000. What is the entry? Debit impairment loss 17,000 and credit accumulated depreciation 17,000. And that way he would be bringing the book value of the old equipment to 10,000. 10,000. So that is how it would be shown on the balance sheet. So with that, we finished impairment and accounting for machinery held for sale or equipment or assets held for sale. In the next session, we will talk about sale of fixed assets, the entries which we'll be making if we are selling an asset, a long-lived asset, or an asset held for sale. Hello, everyone. In this class, we'll be talking about the entries for an asset disposal. So let me go to the whiteboard and explain the concept. So suppose you have an asset of original cost of, let us say, 1,000, accumulated depreciation of 800, the book value of 200 or carrying amount of 200, and it is sold for 300. So how do we record the entries? Remove everything pertaining to the asset. Everything pertaining to the asset should be removed from the books. The original cost, the accumulated depreciation, and record the cash. So first thing, record the cash. So debit cash, 300. And then remove because the fixed asset account is not touched, right? It's not altered in any way, either for impairment or for anything, it's not altered, right? So we can directly credit the fixed asset account with the original cost of 1,000. Remove the related accumulated depreciation also. Accumulated depreciation is a credit item. To remove it, you have to debit it. Debit accumulated depreciation of 800. And the balancing figure or the plug-in figure to make debit and credit equal is the gain or loss. So we are having here 1,100 on the debit side and 1,000 on the credit side. So credit gain on disposal of assets 100 to make the debit and credit equal. So this is a sort of a plug-in figure. And as you can see clearly here, the gain is 100. Okay, so that is how we would record an asset sold at a gain. Now, let us take the same example, original cost. Now, I don't want to repeat the whole thing. I'll just change the sold amount. Everything else is the same. And now, instead of selling at 300, we sell it at, assume that this is one situation, assume that we sold it at a loss. Let us say 150. You would record the same way. First record the cash, debit cash, 150. Remove the asset account completely, debit, credit fixed asset, at the original cost 1,000, debit accumulated depreciation 800. And now, in order to make debit and credit equal, you would plug in the gain or loss. Now you have credit 1,000 and debit side only 950. So the debit, the loss of 50. So it's a plug-in. So you can see clearly the loss is 50. The book value is 200 and you sold it for 150. So this is how you would record the sale on fixed assets. We have now finished everything to do with long-term, long-lived fixed assets and held for use fixed assets. We also dealt with impairment and also the difference between IFRS and US GAAP. All to do with tangible assets. The next session, we will talk about intangible assets, including goodwill. So I'll see you in the next session. Hello, everyone. Welcome to the class on intangibles. So in the last class, we have studied everything to do with tangible assets. And this class is going to be intangibles. So let me just first share the whiteboard. What exactly is intangibles? Are all intangibles non-physical? First of all, yes. All the intangibles cannot be smelt, seen, or touched, right? It can be even an internet link giving access to a computerized computer program, right? Also, all intangibles are non-physical, but not all non-physical assets are intangibles. Now, for example, if you're talking about accounts receivable and prepaid expenses, etc., these are categorized as current assets, right? These are current assets and they are not intangibles. So now intangibles, what's the difference? Basically, intangibles will be long-term with not a definite monetary value. One cannot estimate the exact benefit we can get from it. Whereas accounts receivable, prepaid expenses are monetary assets. We can determine exactly whatever is in the balance sheet, that's the amount we are going to receive. And prepaid expenses, whatever in the balance sheet, that's the amount exactly we are going to use. So that is very definite monetary amounts. Whereas intangibles do not have a definite monetary amount. So it's a non-monetary asset, and intangibles are usually intellectual, sorry about the spelling, intellectual properties. Okay, it's intellectual property, and it is long-term in nature, and it will be amortized. It won't be depreciated. We don't use the word depreciated for intangibles because the value of that is not depreciating like asset. Asset gets wasted, so it is depreciated. But here, intellectual property is amortized over the useful life, over its economic useful life, to match, just like similar to depreciation, to match the expense with the stream of revenues. And the example for intellectual properties would be patents, copyrights, trademarks, franchises, to name a few. Goodwill is also an intangible, but that we are going to deal with separately. So this is a brief about a difference between intangibles and non-physical assets. So let us now go to the text. So the initial recording of the intangible would be just like recording a tangible asset, right? So that is how we would record it. Right? And then we would amortize it. We would amortize it over the useful life of the asset. It's equal to, it's just like depreciation for tangible assets. Okay. Okay. Then we will adjust the value to recognize permanent decreases, only permanent decreases in US GAAP, and it is called impairment. Right? So now recording the assets, like I told you, is actually very similar to the tangible assets. But a note here, these notes are very useful. Value attributable to self-generated patents or other intangibles would be capitalized to the extent of their registration fees and legal fees for filing the patent. Okay. So only that would be capitalized. Any other expenses would be like R&D, research and development, and it is expensed as and when incurred. Okay. So that is how it is done. And research and development, like he has told you here, generally expensed as incurred, and they are not capitalized, not under US GAAP, not capitalized. Okay. And for example, a patent that results from an R&D activities would not lead to an asset on the books that developed it, although the registration fees and legal fees for filing the patent may be capitalized and amortized. And I don't think that would be such a huge amount as all that. Okay. So this is one thing you have to remember. Self-generated assets, nothing gets capitalized except the legal fees and registration fees, etc. So usually intangibles do have a finite life and they are amortized over its useful life, right? But there are some, if they are indefinite, it has an indefinite life, those are not amortized at all. For example, a franchise which is actually forever, okay, or until the foreseeable future. So it is sort of having an indefinite life and it will not be amortized, but all intangibles should be evaluated regularly for impairment. Indefinite life assets will not be amortized, but will be tested regularly for impairment, and if it's found to be impaired, it would be written down. But all intangibles should actually, including the ones with the finite life, should be evaluated regularly for impairment, right? And once it is written down under US GAAP, you cannot bump it up again. You cannot reverse it. Okay, so that is about US GAAP always. So what else is there? Okay, now purchased patents. Now patents gives you a right to use a manufacturing, to use a certain certain product, right? Even a design could be patented, and if you are using it, you have to purchase the rights for it. Okay, so generally patents in US are valid for, its legal life is 20 years, but it will be amortized to the shorter of either the patent's legal life or economic useful life of the patent, whichever is shorter. Generally, it's the economic useful life which is shorter because technology changes very fast, right? So one thing you remember, even the Coca-Cola bottle, okay, that particular design, however they designed it, okay, they have designed it with sort of, grooves like this side, So this design is also patented. So anybody using that design should pay for that patent. They cannot copy the design just like that, right? Again, the note, internally developed patents will be capitalized only to the amount of registration fees and legal fees. And one more thing, if the company successfully defends a patent in court, right? So those, they call it infringement suits. So those, the legal cost of successfully defending the patent could be capitalized along with its registration fees and other legal fees. But however, if it is unsuccessful in its defense, everything should be expensed, including the remaining amount which they had earlier capitalized. Now, what do you mean by this successfully defending a patent in court? Supposing somebody comes, puts a claim that that particular patent is not the company's, the company has not generated it, that they developed it first. Okay, and they had registered it in the beginning. So it's sort of a fight that who found it out first, who discovered it, or who invented a particular thing first. So if the company wins it and the court rules it in the company's favor, saying that they are the first who actually came out with the idea, then it is successfully defending an infringement suit. And all expenses can be capitalized and eventually amortized to the patent's remaining useful life. Unsuccessful defense is the other party won, so that it is that person's, that company's invention. So you have to expense out everything. So contractual franchises are nothing but contractual agreements, okay, to operate a specific business using the franchise's name, just like KFC, right? A franchise can be with indefinite life, so that has to be not amortized but tested annually for impairment. Now, what are leasehold improvements? Now, leasehold improvements is something the lessee, the person, the company who has taken it on lease, cannot move it to another premises. Now, for example, there is a building wherein they have converted it into a cinema, a theater. So a screen is put, and then there are speakers here, right? So everything is custom built to suit the building. So these are leasehold improvements, just like a central air conditioning system, right, on a leased building. So now this is for rent. These leasehold improvements are made to fit that particular building, and it cannot be moved to any other premises. So such improvements are leasehold improvements. So what is the it's not actually it's just a right to use the asset. So what happens is, how do you amortize it? You would amortize to the shorter of the life of the improvement or the lease period. If the lease period can be renewed, lease of the building can be renewed indefinitely, then it will be amortized to the life of the leasehold improvements. Now, for example, the company's lease for this building is, let us say, 5 years. And the leasehold improvement, the screen and the speakers, etc., let us say, just for this example's sake, has a life of let us say 8 years. And if the lease of the building is not renewable, the company should amortize all these leasehold improvements for 5 years, over 5 years, because it cannot recover it anywhere else. It cannot move it to other buildings, right? It's custom made for this building. So if this lease for the building is not renewable, and so 5 years, the company would amortize all these leasehold improvements for 5 years, even though it has a life of 8 years. So that is the concept behind it, and it's quite logical. So, and then trademark. Trade name is a distinctive sign. So generally, it's registered for 10 years, 20 years, and renewed for longer periods, right? It is a sign of the company, right? Like Aramco has a particular sign and logo, etc. So the cost should be capitalized. That should be capitalized, should be actually the legal and registration fees, the design cost for the trademark, right? And any cost in successfully defending the name, right? So those kind of things should be actually capitalized, but on no condition it should exceed 40 years. So within 40 years, you have to amortize the whole expenses incurred towards trademarks. Now, copyright has a life, right? It has a, if somebody has written a book, actually, or a play, or a story like James Bond, so Ian Fleming's, for example, it's his work, right? And it's actually the life of the author plus 70 years. So even after author dies, right, he gets royalty for each movie or book which has been sold, right? So that would be it. So a purchase copyright is recorded at its purchase price. If somebody else purchases it for whatever price they purchase, they would record that. And generally, it's difficult to assess the useful life of a copyright, and usually they write off the amounts in fairly short periods. Internally generated copyrights would be recorded only at its registration cost. Impairment is exactly the same way as we did for tangibles. If you remember, we did for tangibles. So limited life intangibles, the same thing. First, an evaluation, a two-step process to a recoverability test. And then if it is not recoverable, it is written down to its fair value. Exactly the same way as tangibles, right? For indefinite life intangible assets like an indefinite life franchise, there's a step of qualitative factors to be determined. Even intangibles, we did have qualitative factors, right? And then the same, right? So it goes the same way. And goodwill impairment, we would deal with it a little differently in another session. Okay, so that's mainly about intangibles, right? That's mainly about intangibles. So a lot of material here on goodwill impairment. I would try to condense it and explain it to you in a short way, right? Because we really don't know whether this will be tested, but still we should know about it. So I would show it on purely for the examination point of view with an example. So that's about intangibles, the basic concept of it. Let us go and do the multiple choice questions in the next session. Hello, friends. In this session, we would do multiple choice on intangibles. So let us go to the question bank right away. I have already discussed this point, this concept, when I gave a lecture on intangibles in the previous video. So costs that are capitalized with regard to a patent right? What you can capitalize is legal fees of obtaining the patent if you have purchased it, and any incidental cost of obtaining the patent, any other cost which you have incurred, and cost of successful patent infringement suits, which I spoke about. Like if somebody is contesting, saying that it was their invention, okay, and somebody else is claiming the right for that, and you have to, and if you don't win it, if you don't win that case, then you have to expense the whole thing, right? But if you win it, if it is successful, you can capitalize it. So actually, A is the right answer for this. A is the right answer. Let us see B. Legal fees of obtaining the patent, incidental costs of obtaining the patent. Actually, this question should be costs that are to be capitalized with regard to a patent which is internally generated. I think the question should have been that. I'll clarify this point with Hawk International, because otherwise the cost, if it is just a patent, costs that are to be capitalized with regard to a patent, and they say it can be a purchased patent also. This is an internally generated, the company themselves have created some or invented something and got it patented. Okay, so in that case, the legal fees of obtaining the patent, incidental cost, and cost of successful patent infringement suits. If somebody opposes it, saying that it is their invention and the company wins it, they can capitalize it. So it should be an internally generated. There should be a word here, internally generated. We will look at the text also later on for this particular point, and I would explain it too. I would ask also Hawk International. So what is B? What's wrong with B? Legal fees, yes, we have to capitalize. Incidental costs, yes, we have to capitalize. Research and development costs are not to be capitalized. They have to be expensed. They have to be expensed whenever it is incurred. Okay, so that cannot be capitalized. So legal fees of obtaining patent right, successful patent infringement suits is correct. Again, they have included research and development, which should be expensed as incurred. By the way, why do you think they are expensing research and development costs? It's huge. Sometimes it runs into millions. Why do you think they are expensing it instead of capitalizing it? The reason being that we don't know the outcome of research and development. It can be a failure. Okay. So being a conservative standard, US GAAP would prefer to expense the whole thing, since the outcome is not sure, right? It can be a success or a failure. So to be on the safer side, it's better to err in the side of conservatism. So the expense the whole thing, okay? And even development costs are expensed. So incidental cost of obtaining a patent, yes. Cost of successful patent infringement suits is correct, but not unsuccessful. If the patent infringement suit was unsuccessful, they have to expense everything connected to that patent. Right, so that's about it. And the value of any signed patent licensing agreement, yes, probably this also could be capitalized, but unsuccessful patent infringement suits cannot be. So that's the reason A is the correct answer. Let us go to the next question. I'll move this down here. Right, now, read it carefully. It's to do with what I have discussed in my previous videos. Yeah, so this company has purchased a patent for a secret fruit pie recipe. An additional 10,000 was spent to secure it, so totally 85,000. Now, the company who purchased it expects to keep the secret recipe a secret indefinitely. Okay. Because of taste changes, the industry has found the recipes to have been used for an average of 8 years. Yes, that happens. Because the people, the generations would not have the same taste forever. See, now there's big cut down in sugar intake, right? Previously in the 70s, people were eating sugar without a care, but later on, nowadays, people don't prefer so much of sweet things. So like this, the taste would differ. So the economic life of this recipe could be only 8 years. Based on this information, what should the company do? Capitalize the 85,000. Yes, he can capitalize it because it's a purchased patent, and then amortize it over 40 years. Yes, it should not, the amortization should not exceed 40 years, but it should be to the shorter of its economic life. So this is not correct, right? Because if you amortize it over 40 years, the charge is going to be very less. We have to be conservative also and try to recover it as fast as possible. Expense the cost. Now, this is being a bit too conservative because the benefit of it would happen over a period of time. So expensing it would cause a matching mismatch rather, right? So that would not be correct. Capitalize, yes, you capitalize it and demonstrate and amortize it over the period in which the recipe is to remain a secret. Okay, he is going to keep it a secret indefinitely. So are we not going to amortize it at all? No, it's not that. It has an average of 8 years, so it doesn't have an indefinite life, right? Generally, it would be having an average life of 8 years. So D is the right answer. Capitalize the 85,000 cost and amortize it over 8 years. Let us go to the next question. an employee of M, a public company, developed a new product. So this is an internally generated patent, and it has just been patented. Development costs were negligible. Okay, so but the patent rights are almost worth millions of dollars. Okay, so which accounting concept would prevent the company from recognizing the value of the patent as a non-current asset in its balance sheet? Many people use, say, conservatism for this particular question, but that's not correct. Okay, development cost would anyway, even if it was not negligible, it would have been expensed. All the research and development costs pertaining to this patent would have been expensed as and when incurred, right? Even though it's worth millions of dollars. Okay, and what could be registered, what could be capitalized is only the legal fees and any incidental expenses to get it, or registration fees to get it patented. That's all can be capitalized. But why are we expensing the whole thing? And what is preventing the company from capitalizing? The historical cost concept. See, why? Because there is no historical cost. First of all, to capitalize an asset, you have to own it first. Yes, the company owns the asset. Then it should bring in future benefit. Okay. Right? Then it should bring in future benefit. Of course, it will bring because it's worth millions, they say. And then 3, it should be as a result of past transaction. It should be as a result of a past transaction. Right? Only then it can be capitalized and shown on the balance sheet. On the other hand, a liability also has, it should be owed to somebody outside. It should result in an outflow of resources. And 3, again, there should be a past transaction. So there is no historical past transaction to record it. They say it's worth millions of dollars. Says who? There's no objectivity in this, right? It's very vague. So that, and there is no result of a past transaction to prove that it is worth that much, right? So C is what is preventing them from recognizing this so-called millions of dollars on the balance sheet. Let's go back to the text in the next session and discuss about goodwill impairment and research and development in more detail. Hello, everyone. Welcome to the lesson on intangibles. Again, so because there are some more explanations that I have to do. So let us go to the text. And talk about a little bit about impairment, including goodwill impairment, which I have not discussed in the previous sessions. So here, basically, I told you in the previous video that impairment of a limited life intangible would be the same as for tangibles. You can refer to my video on tangibles impairment, it is the same, right? Because there are two steps. There are two steps here also. The company performs a recoverability test by comparing the undiscounted cash flow, just the way we do for tangibles, undiscounted sum, including its use and eventual disposal, like what they expect to get money from that asset, that is compared to the book value. If the book value is greater, then the asset is impaired because the carrying amount is greater than the benefit it can bring. So it's impaired. Then, if it's impaired, it's not written down to the undiscounted sum of cash flows. It's written down to its fair value. But here, they're told that the fair value is the present value of future net cash flows discounted at the company's market rate of interest. Right? So that is what is the difference between tangibles and intangibles. Okay, because tangibles, they have just mentioned fair value of the asset because they might be a readily available market value. Actually, for fair value, the readily available market value is the first choice. If that is not present, that is not determinable, then they can take the present value of future net cash flows discounted at the company's market rate of interest, right? The loss amount is the difference between book value and fair value. I have discussed that in tangibles. Now, what about intangibles like franchises, which has indefinite life? Now, here the issue is they cannot compare it with the undiscounted cash flow because for the very fact is the cash flows are infinite because the life is not exactly infinite, I would say indefinite. So we really don't know for how long should we estimate the cash flows, right? So since that is not possible, what they do is they do actually optional qualitative factor test to determine whether impairment has taken place. Okay, whether it's more likely than not that impairment has taken place. More likely than not is a probability of greater than 50%. So examples or factors that would impact the indefinite life intangible would include, increases in raw material, labor, the economic conditions, both negative and positive circumstances should be taken in order to determine the fair value of the asset. And if the fair value of the asset is greater than the carrying amount, then no impairment has taken place. But however, if the fair value of the asset is lesser than the carrying amount, then impairment is said to be taking place, right? So the next step is calculated. The fair value of the intangible asset is calculated and compared with the asset's book value, right? And then what we do is If the fair value is more than the book value, then the asset is not impaired. However, if the fair value is less than the book value, then the asset is impaired, and actually impairment loss will be a part of continuing operations shown as a separate line item. The difference of the higher book value and the lower fair value would be the impairment loss, right? Actually, it's a two-step process. The first step is optional, just to determine whether there is a chance of the fair value being lesser than the carrying amount. So that is an optional. And in second step, we would actually determine the fair value. In the first step, we do not determine the fair value. We just see whether there's a probability of the fair value being lesser than the carrying amount, right? So basically, since that is optional, probably they would do 2 and 3, which would be 1 and 2 if they don't do the optional step. Okay. And one more thing, any previously recognized impairment loss will not be reversed. In US GAAP, no reversal. In IFRS, it can be reversed to the extent it was written down. Okay, so that, oh no, for other intangible assets, it can be up, if there's a significant increase in market price, it can be bumped up as well. Okay. Right. We'll just go to IFRS and verify that thing. Yeah. Here he has told clearly that a previously recognized impairment loss on intangible asset may be reversed if the estimates of recoverable amounts have changed. So he talks only about a previously recognized impairment loss, whereas in US GAAP, it is not reversible at all. Whether they can be actually revalued more than the original cost remains to be seen. We'll just go ahead and see if there is a note on that. Speak about this. Initial recording. There is no note about whether it can be revalued more than its original cost. They talk about reversal of previously recognized impairment. That's all. Okay. Now, so we did for indefinite lived intangible assets also. And then goodwill and goodwill impairment. Now, first of all, only purchased goodwill can be shown on the balance sheet. Self-generated goodwill or internally generated goodwill is very subjective and it cannot be shown on the balance sheet because it doesn't have a historical cost. But a purchased goodwill can be shown on the balance sheet. Now, what is a goodwill? Goodwill is any amount paid more than the fair value of the assets. Now, for example, if a company is acquiring assets worth, fair value of the assets worth 100, but it pays 1,000. Yes, that can happen. It pays 1000, that means 900 is goodwill and 100 is the fair value of the assets, right? So anything more than the fair value of assets is goodwill, right? And goodwill is the only unidentifiable intangible. That means now for a patent, when you purchase a patent, you know for what you're purchasing it. It is for the right to manufacture or use that particular invention. If you purchase a copyright, you know exactly for what you're paying that amount for you to use that script or the author's work into an economic use, right? So it's very clear for why you're paying that particular amount for those intangibles and what you're buying with it. But for goodwill, it's really indefinite. Why are you paying goodwill? You really don't know. It may be because of the name the company has created, the acquired company has created, right? Its brand equity, or it can be because of its leadership, if you're taking the leaders also along, and a good leadership or managerial expertise, and it could be a loyal customer base. It could be so many factors for which you're paying more than the fair value of the tangible and intangible, other intangible assets other than goodwill. So it's indefinite. You don't know. It's not specific exactly, right? So that is what is goodwill all about. Now, once goodwill is purchased, how do you recognize impairment? Right? So goodwill, once it is purchased, when they talk about here, okay, he talks about bargain purchase as well. That is when suppose I will tell you when there's a bargain purchase. Suppose the fair value of the assets, in simple words, fair value of the assets acquired of the company, of a company which you are buying, is, let us say, 1,000. Generally, you would pay more than 1,000. That extra amount being goodwill. But if you pay less than 1,000, like 800, it is considered to be a bargain purchase. Bargain purchase is less than the market value. Anything less than the market value is a bargain purchase, and it should be recognized as a gain. That's all. Okay, right. Okay, cost of developing goodwill or maintaining purchased goodwill is expensed. It is not capitalized. Only the amount which was purchased, right, that is fully capitalized. Example of this cost may be training and hiring employees from the purchased company. So those cannot be capitalized. Impairment of goodwill. So first of all, goodwill has indefinite life and is not amortized, right? However, sometimes tax rulings would be different in different countries, wherein they allow amortization of goodwill as a deduction, but that is not the thing. For financial reporting under US GAAP or IFRS, goodwill is not amortized, but it is tested at least annually for impairment. and it is done at a reporting unit level. A reporting unit level is if you're showing that particular unit as a separate segment along with your consolidated financial statements, then it should be tested. The goodwill impairment should be tested for that reporting segment, right? And its steps are as follows. It's actually a single step process, but there's one step which is optional, exactly the way we do for indefinite life intangibles other than goodwill. A qualitative assessment to find out whether goodwill could have been impaired. If it's more likely than not, that is greater than 50% probability that goodwill or the fair value of the reporting unit is less than the carrying amount. And what would be those factors? Macroeconomic conditions, general economic conditions being deteriorated, right? You cannot get capital, foreign exchange rates are fluctuating, and markets for equity and debt may not be developed very well, okay, or is causing some problems to get finances. That would be it. A competition demand going down for the product, cost of raw material and labor going up, and deterioration of an overall financial performance. And one more thing, changes in management, especially key personnel. Maybe a key personnel passed away, like Steve Jobs, for example, right? When he passed away, definitely Apple company would have gone down in fair value, right? So, and litigation also could cause, the fair value to get affected. So when the company concludes it's not likely that the fair value is going to be less than the carrying amount, then no impairment is taking place and nothing needs to be done. However, if they feel that fair value would be less than the carrying amount, step 2 is going to take place. Step 1 is optional. So step 2 would happen. If step 1 doesn't happen, then step 2 is step 1, right? So what they do is they value the company, including goodwill, and see the carrying amount. Okay, so the fair value of the company, including goodwill, is compared with the carrying amount, including goodwill. If the fair value is less than the carrying amount, the difference goes to reduce the goodwill amount recorded by the firm up to the amount of goodwill. They cannot reduce it further than that, right? So goodwill impairment loss would be recognized, cannot be greater than the carrying amount of the goodwill, right? Obviously, right? You cannot recognize a goodwill impairment loss greater than the goodwill. So basically, it's a simple one-step process. If the optional step is omitted, find out the fair value of the firm, find out the carrying value of the firm. If fair value is less than the carrying value, the difference would be impairment of goodwill, provided the goodwill is greater than 100, right? So If the goodwill is 50, right, you will just write off that 50, that's all. The original goodwill recorded 50, you'll write off 50. Suppose the goodwill recorded was 200, then this would be the impairment. 200 minus 100. 100 should be the resulting goodwill. Right? If the carrying amount of the, yeah. Yeah, correct. Exactly what I told you, right? So I have just explained these two processes. If the fair value is greater than the carrying amount, it's not impaired, right? So that's all. It's a one-step process, a simple one-step process. Let us do a multiple choice question in order to get this concept. Okay. The question asks you, all of the following are specifically identifiable intangible assets except goodwill. I have discussed that. Because you really don't know from what it arises. I already explained that concept in my explanation. So you know what is patents and trademarks. I explained that. Copyrights. What are leaseholds? Leaseholds are assets taken on lease wherein the lessee has the freedom to do anything with that asset. So other than ownership rights, the owner has sacrificed everything to the lessee. It's as good as the lessee owning it, but he legally doesn't own it. So he owns a right of use. Right of use for the asset for a considerable period of time, right? So this right of use is an intangible. So leaseholds are intangible, and you know for what you're paying that leasehold, right? For a particular asset or the use of a particular asset. So goodwill is a unidentifiable, not specifically identifiable. The question is an except, so C is the right answer. Now here, there is a question. Pause it and try to do. It's just the explanation what I just gave you. So basically, the company has purchased in September 2003. The total purchase value is 6 million. I'm putting it in thousands. And he acquired assets worth 5,496,000. So the remaining is goodwill. The difference is goodwill rather. So how much is that? It works out to 504,000. Excuse me on that. $504,000. So goodwill is 504,000, right? And as of December, the fair value, December 2005, years have passed. The fair value of the reporting unit, including goodwill, was 5.8 million, right? They have not spoken anything about the first qualitative step. And the carrying value, including goodwill, is 5.9. So since carrying value is greater than fair value, impairment has taken place. And that impairment of 100 is attributable to goodwill. So A is the right answer, right? the amount of write down of goodwill would be A. And what's the entry? Debit goodwill impairment. Impairment 100,000 and credit goodwill itself. This would be the entry. Right? And one more thing I should mention. So this is about goodwill. One more thing I should mention. For that, let me go back to the text. Is about research and development. Okay. Now, research and development, let me go to a whiteboard. So one peculiar thing about research and development under US GAAP. Under US GAAP. Right? All expenses of R&D are expensed. Are expensed because we don't know the outcome. So expensed as incurred. To the extent that if you purchased a big asset, I don't know, maybe a huge crane or whatever, okay, right? Something huge crane or whatever. My drawing is all wrong. It's a huge asset, right? It costs maybe, just listen to this, it costs maybe $5 million. It can be used for many years other than the accounting period, okay? But if it is for one specific R&D project, it should be expensed. The entire 5 million should be expensed as incurred. No capitalizing it. However, if it can be used for other R&D projects, it need not be capitalized. You can only allocate the depreciation. You can capitalize and allocate the depreciation to each project. But if this 5 million truck or asset or whatever is purchased only for a specific asset, for R&D project, the entire thing should be expensed as incurred, no capitalizing. So that is the peculiarity about R&D expenses. Let us test this concept with a multiple choice question. Let us do that in the next session. Hello, friends. This is probably the last part of property, plant, and equipment accounting. Let me share the screen to the text. Yes, IFRS notes. The difference between IFRS and US GAAP. First of all, in the IFRS, development costs of self-generated intangible assets can be capitalized when there is economic feasibility and the project, if the economic feasibility and technological feasibility of the project can be demonstrated. But under US GAAP, internal development costs are usually expensed as incurred. Okay. Why they put usually? Usually means most of the time it is expensed, but they may be capitalized only if the specific US GAAP standard allows capitalization. It happens for software. Just for your information, though it's not covered in this text, maybe it's out of the scope of CMA exam. We don't go so deep. But other than software, development expenses and research expenses are expensed as incurred in US GAAP. Right. Under IFRS, a previously recognized impairment loss may be reversed if estimates of the recoverable amount have changed, right? So previously previously recognized impairment loss can be reversed. Okay, the third point, actually I was searching for this point in the last video and about it being written up. So under IFRS, it allows intangible asset with which has a specific active market. It can be written up in value as well to that fair value under IFRS. However, goodwill, even though if it's impaired, once it's impaired, it's not written up, because if you write up goodwill, it will be like creating a self-generated goodwill, and self-generated goodwill is not allowed under IFRS or US GAAP. So goodwill write-up after impairment is not allowed under IFRS and US GAAP as well. Whereas other intangible assets can be written up once it is impaired to the original amount. And then intangible assets which have not been written down can be written up in value to the fair value under IFRS. Okay, so that's what you should be remembering. And yes, let us do a multiple choice question. On research and development, which I have already explained. This is under US GAAP. So it says that expenditures for equipment for research and development must be capitalized in the period incurred and amortized. It depends whether that expenditure for equipment was for a specific project. Okay, so that's what it you should see that. So this is not the right answer. Maybe expense in the period incurred or capitalized. No, again, it has to be seen. It's nothing to do with the probability of future benefits. Okay, it would be capitalized if it can be used for alternate projects. Okay, must be expense in the period incurred unless the costs are for testing a prototype. Testing a prototype again is development expense, right? And that doesn't license them to actually capitalize it. So it should be expensed. So it should be expensed. So here he's saying unless the costs are for testing a prototype, that allows some room for capitalization, which is not correct. D should be the right answer. Must be expensed in the period incurred. Remember, I gave you the example of a big truck for a specific R&D project, which has to be expensed unless the equipment has alternate uses in other R&D projects or otherwise. If it is specifically got for one R&D project, it has to be expensed completely, whatever be the amount and however long the asset can last. It may last for 10 years even, right? But it should be expensed as incurred. So D is the right answer. Very, very conservative US GAAP is. Right, now let us go to an IFRS question. Right. He's asking which is correct about US GAAP and IFRS. The cost of development expenses must be expensed under US GAAP, except for that software, as I told you, unless a standard specifies it to be capitalized, but are capitalized under IFRS if they meet a specific criteria, that is technological and economic feasibility, as we saw. This is correct right away. Let us see the wrong answers and see why they are wrong. The cost of research must be expensed under US GAAP, but are capitalized under IFRS if they meet a specific criteria? No, they are expensed in IFRS as well. But development expenses are capitalized under IFRS if they meet economic and technological feasibility. So this is wrong. All costs of research and development must be expensed under both US GAAP and IFRS. No, development expenses can be capitalized under IFRS, so that part is wrong. Internally generated goodwill may not be capitalized under US GAAP. That is correct. It is not capitalized, not may not, right? Internally generated goodwill, unless it's purchased, it's not put on the balance sheet in US GAAP. And also in IFRS, you can not put internally generated goodwill on the balance sheet. So that is the reason the impairment loss on goodwill cannot be reversed, both under US GAAP and IFRS, because if you reverse it, it's as if you have self-generated that goodwill, right? So here A is the right answer. And with that, we finished the accounting of property, plant, and equipment and intangibles as well. So the next session would be about liabilities. That would be a next lesson. Hello, everyone. Welcome to the lesson on short-term liabilities. Actually, it is mainly about reclassifying short-term liabilities. So let us look at the text first, and then we would go to the multiple choice questions. So reclassification of short-term debt. When a company expects to refinance, what do you mean by refinance? Refinancing is taking another loan to pay off the old debt. Another loan, probably a new loan with different terms and conditions. So that is the meaning of refinance. So by meaning, so it's going to actually refinance some of its short-term debts, refinance some of its short-term debts by issuing a long-term debt or by issuing equity. Okay, so if it does that, it can actually reclassify a short-term liability as a long-term liability on the balance sheet. Okay, so if it has a plan, an intent and ability to refinance, that means taking another loan which is long term to replace or to pay off the short term debt, then that short term debt is not going to be settled with short term assets. So it will be classified as long term or non-current. So reclassification of short-term debt to long-term debt, if the liability will be refinanced after the balance sheet date, okay, is a correct example of treatment of subsequent events or events that take place after the balance sheet date, but before the financial statements are issued. Okay, so issuers of financial statements are required to evaluate subsequent events through the date the financial statements are issued. That means if anything is going to change the financial position of the firm as of the balance sheet date by a subsequent event before the issuance of the financial statements, then it should be adjusted in the financial statements, right? The financial statements should be adjusted. So if there is a subsequent event, okay, wherein a short-term debt is going to be reclassified or refinanced by a long-term debt, then that is after the balance sheet date, if that is going to happen, but before the financial statements are issued, then such a short-term debt should be classified as long-term. Okay, so if the event is significant enough, the financial statements would be misleading without its proper disclosure. And the company should recognize the events in the financial statement. So when do you rather reclassify short-term obligations as long-term? When the company has an intent to refinance them, they want to refinance it, and they demonstrate the ability to refinance it. Okay, so how would they demonstrate the ability to refinance a short-term debt with a long-term debt? Completing a refinancing transaction, okay, and converting the long-term obligation, short-term obligation to long-term after the end of the year, but before the financial statements are issued or available. So they have actually completed the refinancing transaction. Okay, or they have entered into a financing arrangement with another party after the end of the year, but before the financial statements are issued or available. That will enable the refinancing to occur. Okay, so if they just entered into an agreement after the balance sheet date, but before the financial statements are issued, they can adjust the balance sheet by reclassifying the short-term debt as long-term. Okay. Now, please note this important thing. If the short-term obligations that were intended for refinancing are actually settled or paid in the following year before the issuance of the financial statements. Now, by using short-term assets, see, they intended to refinance it, but it was settled by using short-term assets before the financial statements were issued, but after the year end. Then how should you show it in the balance sheet? You should show it as short-term obligations itself, because it was settled using short-term assets. Okay, so there it will remain as short-term obligations itself. Okay, so what to remember here? If the company has the intent to refinance them, as demonstrated the ability by entering into a financing agreement or completing the refinancing transaction before the financial statements are issued, but after the year end, then you can reclassify short-term debt as long-term. It makes sense because it's just going to be replaced by a long-term debt. Okay, so might as well show it as long-term now itself. Okay, so that's the way we have to reclassify short-term debt as long-term. Those are the conditions. The next we'll be studying about warranties. Those are also liabilities. But for the moment, in the next session, we will do multiple choice questions on this concept, reclassification of short-term liabilities. Hello, everyone. Welcome to another session on reclassification of short-term debts. So this time we are going to do multiple choice questions, and here is the question bank. Question is asking, trade accounts payable are valued on the balance sheet at what? At its historical cost? No, you should be valuing it at what amount that you're going to be settling it, because sometimes that can change from the historical cost. Okay, so it is actually the net settlement value. How much you're actually going to be paying the short-term liability, trade accounts payable, that is the amount they should be showing on the balance sheet. Okay, so here they're asking if they pay one of its liabilities twice in error, what are the effects of this mistake? Now, suppose you're talking about assets and liabilities. Let us say there was 2,000 of assets and $1,000 of liability, right? So let us say there's a liability of $300, okay? And we paid once correctly. If we paid once correctly, the liability would get reduced, debit liability, and credit assets also, because cash would be going out. So the correct balance should be 700 here and 1,700 here, right? That should be the correct balance. But if you paid again, 300 again would go off, so you will be having 400 and 300 again would go off here, and you'll be having 1,400. So basically, your assets and your liabilities have been understated. The equity will not get affected at this moment because it's an error, no doubt. It is a loss. But generally, what would happen just by paying it twice, equity will not get adjusted. Suppose we are paying it and we paid it twice and we cannot recover the amount, then you will have to write it off as a loss. Then you have to write it off as a loss since you have paid it twice. Okay. At that time, equity will be affected. But by paying it, and even if you have paid it twice, you can recover it from future payments, okay, from future transactions. So at the moment, when you make the payment twice, your liabilities are understated and your assets are understated. So C is the right answer. Let us go to reclassifying concept. So there's 100 million debt which is due on March 3rd. Okay. So March year 3, sorry. In December year 2, the company entered into a non-cancelable agreement with its lender to refinance the debt with the same interest, and full principal is due now, not the next year, but in year 5. Okay, so how it should be classified? How it should be classified? It should be classified, the short-term debt should be classified as a long-term debt because it's already entered into a non-cancelable agreement. So it has demonstrated the ability to refinance the debt into long-term. So it can be classified as a long-term liability. So that's a small chapter, reclassification. You just need to know the text, what I told you, right? The concept should be clear, and multiple choice can come like this, or they might frame it differently. You should be able to answer it. It's a small chapter, and it ends here. The next chapter, I will be talking about warranties. Hello, friends. Welcome to the lesson of warranty liabilities. So let us understand warranties first, and then we'll go to the MCQs. So this is the text explanation of warranties. What is warranty? A promise made by the company to replace the product if proven defective. But there are two types. The assurance type warranty, which it's also called manufacturer's warranty, which is sold with the goods. It's included in the price of goods. So what does it give you? Assurance. It gives you assurance about the product would meet the agreed upon specifications at the time it is sold, without any additional payment made by the customer separately for it. It's included in the product price. Okay, And right. Suppose the manufacturer or the retailer promises to do something else other than assuring that the product would meet the agreed upon specifications, that would be called the service type warranty, or also an extended warranty. It's sold separately. The customer pays a separate amount for that. Actually, the company now promises to pay the wear and tear of certain items, or promises to the service in addition to product assurance, right? So since they have to do a service obligation is required, it would be recognized as and when that service obligation is completed, right? So we will see the accounting part of it later. So these are the two types of warranties, but sometimes it can so happen that an assurance warranty would be like a service warranty. Okay. It says here, the warranty that is not sold separately may sometimes represent a separate performance obligation. Here, the Hawk text has given a very good example here. The warranty says here, see, for example, a manufacturer of pet accessories promises that the products are guaranteed for life, even if it is chewed upon. So this is more than assuring that the product would perform as per specifications. It goes to even replace beyond the time for which it is guaranteed to perform, right? So the lifetime guarantee is a service in addition to the assurance. So it's a service type warranty, even though it's not sold separately. So it should be accounted for as a separate obligation, and a portion of consideration of each sale should be allocated to the warranty. Okay. So in other words, it should be recognized not all at once. Okay. When the performance is complete. So that's what it means. Now, how do you account for assurance type warranties? I'll just show it to you. I'll just show it to you on the whiteboard. So that would be better. Now, just let us assume that the company made a sale in year one of 100,000. Okay. And I'm just making a sale here, not taking into account cost of sales, etc., and complicating matters. A very simple example. So let us say that the company is giving an assurance warranty. Okay. So the company is giving an assurance warranty. And for a year, let us say the assurance warranty is for a year. And let us say nothing was claimed in year one. So the company would report 1 million net income, 100,000 net income. In year 2, let us say there's no sale, but there is a warranty expense pertaining to this, which the company promised to replace some part or anything like that, right? An assurance type warranty. So that expense, warranty expense, would be accounted when it's incurred. And then we'll make a loss here. Now, what's wrong with this kind of accounting? This kind of accounting is a major flaw because it's not matching revenues and expenses. So revenues in the year 1 is overstated, and profit is understated in year 2, because you see, this expense does not belong to year 2. It is pertaining to something done in year 1. Okay. And when you overstate your income, there's a danger of so many things. In a public limited company, the shareholders would want dividend, saying that there's so much of income. So it's not the correct income, right? So to avoid this confusion, instead of accounting for warranties as and when it's incurred, we would actually accrue it. So the correct accounting would be in year 1, when a sale is made, let us say 100,000, and past experience says that 10% of it would generally be the warranty expense, right? So we would accrue it, 10% of it. So what's the entry for this? The entry for this would be debit warranty expense, estimated warranty expense, because this is an estimate. We really don't know how much we'll have to replace, right? So how much the company will have to replace, they don't know. So it's 10,000, an estimate going by past experience, and credit estimated warranty liability. All short forms here, but I'm saying it out aloud. 10,000. So then proper matching is done and the income is not affected. Okay, now let us say in year 2, we actually incur this expense. This is an estimate. Okay, now let us say 7,000 was actually needed to be replaced. Some part need to be replaced. So the warranty expense actually incurred was, let us say, 7,000. Actual warranty expense, let us say 7,000, and that happens in year 2. So now you will not debit warranty expenses in year 2. It's already taken care of in year 1, right? So what's the entry? You will debit this estimated liability, which you have kept aside. $10,000 or 7,000, and credit whatever you're going to replace. Maybe you're replacing parts, or maybe you're replacing whatever it can be. Maybe cash, I don't know. So something was spent, okay, and it has been incurred. So that's the entry, fine. Income statement is not touched with this entry when the actual warranty expense happens. And the warranty account would look like this. Warranty liability account, estimated warranty liability account would first have a 10,000 by warranty expense, and then to cash, to labor or material, etc., 7,000, and you have a 3,000 credit balance. At year end, every warranty liability account would be looked into to see whether it has a debit balance. If it has a debit balance, we get back to this entry. and book an expense. Or sometimes if we find out this warranty period has expired and still there's a 3,000 balance, we would reverse this entry. How would we do it? It's called write back of warranty liability. So debit warranty liability for this 3,000 and credit warranty expense 3,000. Warranty expense will not have a credit balance because they are continuously selling. So warranty expenses are continuously booked, but it goes to reduce the warranty expense. Warranty liability is a contingent liability. Why? Because there's an uncertainty about it. It's not a definite, certain liability, right? You cannot say that you would actually have to be paying this amount. It's an estimate. Okay. It is probable. When it is probable that it will be incurred and the amounts can be estimated, then we recognize contingent liability in US GAAP. It's not footnoted, it is recognized. Okay. And if we don't know the range, see, maybe the warranty liability might be 100,000 to 300,000. Without knowing definitely, we cannot say probably which amount will be incurring as warranty liability. Then when you accrue the lowest in the range. That's very strange, right? We thought US GAAP is very conservative. I would expected the highest in the range, but no, since it's a indefinite liability, it's not a definite liability, uncertain liability, they book the lowest amount. See, in IFRS, maybe sometimes it's footnoted, but here it's not footnoted. It is actually booked. It is recognized in the financial statements itself. In US GAAP, if you cannot estimate the liability or it is not probable that it will be incurred, probable means a certainty of 70% or more, a probability of 70% of more that it will be incurred. So if it is not sure that it will be incurred, it's less than sure, less than probable that the liability will be incurred, or it cannot be properly estimated, then you footnote it. Okay. If it is probable, that is a 70% or more probability that will be incurred, and it can be reasonably estimated, you would actually recognize it like this. So in fact, it's a contingent liability. So this is the accounting of a assurance type warranty, wherein the manufacturer is giving assurance that the product would meet specifications and agreed upon specification. And if it doesn't meet, the manufacturer is ready to replace it. Okay, so there is no, and not a service obligation as such here. However, if it extends, if a assurance warranty extends to an indefinite period of time, like a life warranty, then there is a service element in it, in addition to assurance. I hope you get it. And in the next class, we would do some multiple choice questions on this topic before we move on to service type warranty accounting. Hello friends, welcome to another session on warranties. So in this class, we will be doing MCQs. So let's go to the question bank right away. And while I do the MCQs, I might tell a concept or two. So please listen to the explanation carefully. So here, he's asking us to, first of all, what they want. The amount of warranty expense in the year ended 2001, 31st May. Okay. So they have started offering 3-year assurance warranty from year 0. So from year 1 actually. So basically this is the first year, June 1st to 31st May. It's the first year. And that time the sales were 2,695,000. I'll truncate the zeros. Okay. The total cost of warranty is expected to be 3%. So on the income statement, this expected to be estimate is what is going to be booked. Okay, so into 3%. Okay, so 2,695 into 3% is actually 80.85, which is 80,850. What would be the entry for this? The entry which is going to hit the income statement would be debit estimated warranty expense 80,850 and credit estimated warranty liability 80,850. So this will be the entry which would hit the income statement. Let's go further and go beyond what is asked here, because we are studying basically, so we want to understand completely. Now, if I drop the warranty liability account, a T account, for expense, warranty expense is booked as a credit to this account, 80,850. Then there are expenses during the actual expenses during year 1. So in labor and parts. So it's actually to labor 31,500 and 2 parts are going out. So 9,100. Okay. And then if they had asked you the balance for this, the balance in the account would be 80,850, 80,850, and the balance would be here. You have to deduct from 80,850 minus what was debited, 31,500 minus 9,100. So if they had asked you what is the balance in the warranty account, it would have been B. If they ask you the balance, what's in the warranty account, it would be B. Okay. Now this balance in the warranty liability account should be classified into current and non-current. So since this is a 3-year assurance type warranty, this liability can be incurred up to the period of 3 years. So we can make a current estimate of this 40,250 and estimate of how much might be incurred in the coming year. Let us say 20,000 would be incurred in the current year, the coming year. So this would be classified as current liability, and the remaining 20,250 would be a non-current liability. It can be classified in this way depending on when it's expected to be incurred, right? So this is understanding the entire question properly. Let's go on to the next one. Read it carefully. Try to answer it yourself. And then look at my explanation. So this is a company which is manufacturing small commercial heating units. Follows generally accepted accounting principles for the type of accountings of assurance type warranty. In other words, it's going to estimate future warranty cost. It's going to accrue it. So there's been a huge sale. Estimated future warranty cost is 150 per unit. And they have asked you, what is the future estimated warranty cost? The adjusting entry to be made to account for the estimated future warranty cost is nothing but what is the warranty expense you would book in the year end. Okay, so it's 150 per unit into 250 units. Okay, so 150 per unit into 250 units would be 37,500. Now, if you notice, there is a debit sale. These are invalid entries, in fact. These are not proper entries. Okay, and debit contract liabilities, we are not going to do that. Okay, and credit crash or accounts receivable, no, this is not going to happen. Debit sales is never debited. Sales returns is debited, but sales is not debited. And this one looks the correct entry. So debit assurance type warranty expense and credit the warranty liability. All these are not valid entries in the first place. So D is the right answer. We'll continue in the next session. Hello, friends. Let us continue with the multiple choice questions for warranty liabilities. So here, they're asking us the balance in the assurance type warranty liability account. So let us drop the account in the first place. So estimated warranty liability account. He has told you the warranty cost is going to be 10%. And there is a 2-year warranty for defects in workmanship. It's an assurance warranty. So it's 10% of sales. Please ignore this. 40% of the expenditure is expected during the first year. These are all estimates. Okay. And 60% during the second year. So that would be useful in classifying the liabilities in current into current and non-current, right? But here they're asking you just the balance in the warranty liability account, okay? So what are we going to do? So we will look at it, 10% sales, 10% of year one sales. So warranty expense for year one would be 30,000. And then here again, warranty expense for year two. So I'll accredit with a debit to warranty expense, 40,000. And then the incurred, we look at the actuals. The actual warranty expenditure, okay, not the estimate. The incurred 12,000, maybe to cash, cash goes out or material is going out, whatever it is, they've not mentioned it. 12,000, that happens in year one. And in year two, let me put something different, to parts maybe. Okay, so that would be 30,000 actually incurred. And then, I'm sorry, yeah, 12,000 and 30,000, correct? So what's the balance? 70,000 is the total. So you balance it. The balance carried down would be 70 minus 42, which is 28,000. 70 minus 42, which is 28,000. So that is the balance in the warranty liability account. So D is the right answer. The company might make a decision to classify this into current and non-current because it runs to 2 years. Okay, but this is the end of the 2-year, second year, so it's over basically. Okay, so it has the balance of 28,000. Okay, that would be probably returned back. It might be reversed if it is no longer required. Now let us do a last question in this area. Yeah. As I told you earlier in my lectures, that warranty is a contingent liability. So if there's an estimate of a contingent liability within a range of 1 million and 3 million, with no guarantee, no estimate of loss within this range is a better estimate than the other, how much the company should accrue? The company would accrue the lowest in the range. I'll explain that. Generally, they are conservative, but since this is a contingent liability, which is not definite, there's uncertainty here, they would accrue the lowest in the range. So D is the right answer. So with that, we finished assurance warranties and its multiple choice questions. In the next session, we'll talk about service type warranties. Hello, everyone. Welcome to the session on service type warranties. In the last class, we discussed about assurance type warranty, and now it's going to be service type. Let us go to the text and discuss it further. So this is a warranty which the customers pay for it separately. Now, an assurance warranty is not paid for separately. It's included in the cost of the product. But here, the purchase of a service warranty involves a performance obligation, so a separate performance obligation under the revenue recognition principle has to be shown, right? So sometimes the warranty does not need to be sold separately in order to be a separate performance obligation. Sometimes it would be a assurance type or a service type warranty, and having both the elements of assurance and service, right? So basically, a service type warranty would happen after the assurance warranty expires. So then the company needs to be doing some kind of service in order to earn that revenue. They have to serve the customer in some way or the other during that period because the customer has paid for it. So the revenue should be recognized either on a straight line basis or depending on the estimated or expected costs. Okay, so in proportion to that, they would recognize the service type warranty revenue. Okay, and expenses would not be accrued as such. It would be expensed as period cost whenever it has been incurred. Okay, and the service type warranty is the contract liability. So it would be accounted when the customer pays for the service warranty, debit cash or accounts receivable, and credit service type warranty liability. Okay. So this is how it would be entered, right? And estimated future costs are not accrued as liabilities, just like assurance type warranties. They are expensed as they are incurred. Okay. Now, there is an example here. There is an example here, a very good example, wherein a customer has purchased. There's a 1-year assurance type warranty and a 4-year service type warranty. The sales consideration is 5,200. 5,000 of it is for the product, including the assurance type warranty, and 200 is for the service type warranty. So when we enter it, when the customer pays, it's debit cash, credit sales revenue, and credit service type warranty liability. It's a sort of an unearned revenue. It depends on the performance. Okay, now they accrue the assurance type warranty, which I discussed in the previous class. So debit assurance type warranty expense 100, credit assurance type warranty liability, right? And then later on, there is a claim on the assurance type warranty during year 1. So that time, at the time of the claim, expense is not debited again because expense was already debited. So it will not touch the P&L. It would be debiting this assurance type warranty liability and crediting cash or labor or parts, etc., whichever is being used. Okay, then it enters into the, after that, it enters into the service type warranty. Now, if you note, in the assurance type warranty, estimated warranty liability, the assurance type warranty liability, you got a credit from warranty expense of 100, and thereafter to parts was 60, and to payroll, okay, payroll 20, right? And then we have still a balance of 20. Now 80 has been used, 20 more. This has to be reviewed every period. Okay, so he evaluates the balance in the assurance type warranty liability account at each reporting period, and let us just see whether the liability there is sufficient or not, or sometimes it may not be needed at all. So in this case, it can be returned back to warranty expenses. This extra 20 can be returned back to warranty expenses, and this account can be closed, right? So that can be done. And now from years 2 to 5, it's going to be the service warranty. Okay, 2 to 5 is 4 years, right? 4 years, and it could be the service type warranty. Okay, so what would happen here? I'll just show it to you. Maybe here itself I'll show it to you. So here would be year 2, year 3, year 4, and year 5. Now this is covered under the service warranty. Okay, so this entry can be passed to account for it on a straight line basis. So debit a service type warranty liability, which is shown here, in fact. I'll just show it to you down. So this is the entry which will be passed. Debit service type warranty liability, which you had accrued before. Okay, and has a 200 balance. And credit service type warranty revenue. You're taking it to revenue, right? So basically, it will be, I'll just show it like this, service type. Service type, warranty revenue. I'll put it like this. It's taken on a straight line basis, maybe, or in any other way where you're in the manner you're expecting the cost to come. Okay, if it's taken on a straight line basis, now this works out to be 200 totally. And when the expense comes, you would debit warranty expense directly by the amount incurred. So let us say service type warranty expense. Maybe 30 would come in 1 year, and in another year, maybe even 60. Okay, because we really don't know whatever the services you will have to provide for it. Okay, without charging the customer anything more. So here, like he made a profit, and here probably he would make a loss, right? So we should see totally, sometimes the warranty expense would be more than the warranty revenue. It could happen that way, in which case it didn't work out for the firm very well, but they have to oblige, right? So the service type warranty expense would be a debit. Cash could be credited, or salary and wages, or parts which is given out, right? So those kind of things could be credited, right? On the other hand, the revenue recognition need not be on a straight line basis, right? For the service type warranty. So totally it's 200. Maybe the company is expecting nothing in the first 2 years, so it does not recognize any revenue. Okay, right? It's not expecting any expenses because the equipment or whatever sold is fairly new. Okay, so they would be expecting more expenses to come in the later 2 years, so they can even recognize it this way. And the expense might be in 1 month 90, and 1 year 90, another year 110 also. Okay, so it can come in any way. So this is how they would account for service type warranty. In the next session, we will do a multiple choice question on this. There are not many multiple choice questions on this service type warranty, but many questions on assurance type warranty. So let's see what the question bank has for us. Hello friends, welcome to the session on service type warranties MCQs. So I have selected a question for this. So the question says, why this company sells a 3-year extended warranty, which is nothing but a service type warranty, when it sells appliances. So service under the warranty is performed by an independent repair technician under contract. Based on experience, the warranty costs are estimated at 30 for each appliance sold. When should they recognize this warranty costs? It should be recognized evenly over the life of the warranty, which is wrong. He's talking about warranty cost. Warranty revenue, service type warranty revenue can be recognized evenly over the life of the warranty. The cost should be incurred or expensed whenever incurred. Okay, so warranty cost should be recognized when the service calls are performed. So this is the right answer. Warranty costs are recognized as a period cost as and when it is incurred, right? So it's recognized as a period expense. So B is the right answer. C says the warranty should be recognized when payments are made. No, right? We do not, we just, the payment need not be made to the repair technician. Okay, the cost which has been incurred, it could be on an accrual basis. So whenever you incur that cost, you have to expense it immediately. And then the warranty cost should be recognized when warranties are sold along with the appliances. No. When the warranty is sold along with the appliances, the entry would be debit cash or accounts receivable. It would be this way: debit cash or accounts receivable, right? Let us say 5,200, which includes the service type warranty, and credit sales, which you will take 5,000, and credit service type warranty liability. A lot of shortened forms there, 200. Okay, and warranty cost will not be recognized when the warranties are sold. Okay, a warranty type liability is recognized on the balance sheet for the cost that would be incurred in the future, but this would be allocated to revenue, and the cost would be expensed whenever incurred. So B is the right answer for this. And with that, we finished liabilities and warranties. In the next session, we would talk about deferred taxes. Hello, everyone. Welcome to the class on deferred tax liabilities. Deferred taxes, actually, not just deferred tax liabilities. Okay. In the last class, we studied about liabilities in general and reclassification of current liabilities into long-term, and also we did warranties. Warranties, as I told you, was a contingent liability. And in this class, we are going to study about deferred taxes, basically. So what's the meaning of deferred? The dictionary meaning of deferred is something put off later, right? So that's what is the actual meaning of deferred taxes. So basically, there could be a deferred tax benefit, which is a deferred tax asset, which you would get the benefit later on, not in the current period. And also there is deferred tax liability, which you would get, which you'll have to pay not in the current period, but later on, right? In future. So those are the meanings of deferred tax assets and deferred tax liability in simple language. Now, I will actually, before going into the text, I would actually show you how a deferred tax liability and a deferred tax asset arises. Okay, I will show it to you on the whiteboard. So, as you know, we make different books for financial purposes and tax purposes. Now, for financial purposes, the books we make, books we make for financial purposes is as per US GAAP, and it would be shown to the shareholders. And what we make for tax purposes is to arrive at the taxable income for which we pay taxes. So now, first of all, let me show you a deferred tax liability. Shortened form for that is DTL, sometimes known as DTL. So let us talk about year one. This is year one, and let us say there is a asset, fixed asset of 100,000 US dollars. Okay, and estimated life is, let us say, 2 years, and depreciation, let us say, for tax and financial purposes is straight line method. It won't be this way, but in case, I mean, just assume for this example that tax also allows based on straight line basis. Okay. Right. Now, let us assume a financial, as per the financial books and tax books, let us assume sales, cash sales maybe. I'm putting a very simple example. Let us say, as we like, 500,000. Okay. And then I'm ignoring cost of goods sold and all that. Just let us talk about depreciation. What do you think would be the depreciation in financial books? 100,000 without salvage value divided by 2 years, which will be give us 50,000. 50,000. Okay. And then the financial pre-tax income would be 450,000. Okay. Let us assume a tax rate of 20%. Okay. Let us assume a tax rate of 20%. So that would be 90,000. And after tax income, 450 minus 90 is 360. Okay, so that would be 360,000 is the income they would report to the shareholders. Okay. Now, in the tax books, we are going to declare this sales of 500,000. Now, depreciation, maybe the tax rules are different and they would allow the entire amount as depreciation. This is just an assumption. Okay. It would actually, tax people would provide for taxation, it would be as per the MACRS, Modified Accelerated Cost Recovery System. Okay, so that way they would based on the MACRS table, tax would allow, IRS would allow depreciation. But however, for this example, I'm assuming, and always tax would give us a higher deduction. Okay, the government is kind, you can say. So they would give us a higher deduction generally. So let us say 100,000. The entire amount is allowed as depreciation, right? So the taxable income is 400,000. Okay, and tax at 20% would be 80,000. Right? We would not bother about after tax income here as per the tax returns, because this purpose of making the tax books, the income as for tax purposes, is to arrive at the taxable income. We have arrived at it, and 400 minus 80, 320, we are not going to show anywhere. Okay. So, I mean, we will not show the shareholders that. Okay. Right. So now, what is the entry? How are we going to record this whole thing? Right. So, credit tax payable for the current taxes. So we have to pay in the current year 80,000. Okay, so it's a very simplified version, assuming the tax in the future years is also 20%. Okay, so debit tax expense, which is 90,000. Now, just to tally the debits and credits, credits is short, so it's a deferred tax liability, credit DTL for 10,000, which means that this 10,000 would have to be paid later. You see, it's like this. The expense is actually 90,000, but we are paying only 80,000 currently. So obviously we have to pay. It is just deferred. The taxes are just deferred to be paid in another period. It is called intra-period allocation of taxes. Okay, so this one we are going to pay it in some other period. The DTL is given. Okay, and it is shown in the balance sheet as a non-current liability. All deferred tax assets or liabilities would be shown as non-current, because we really don't know when it will reverse. Okay, previously it is to be categorized as current and non-current, not anymore. They simplified it, and even as per IFRS, deferred tax assets and liabilities would be non-current. Okay. Now, please remember that we have a deferred tax liability of 10,000. How would this reverse? Okay, how would this reverse? I will just show it to you in the next year. So I'll use another page for that. There we go. It is now year 2. Okay, now financial income, tax. Now financial books, tax books. Now assume any amount of revenue, no problem. It would anyway get reversed. Okay, and this 300,000, the depreciation as per financial books, guess what? It's going to be 50,000, right? Because it was a 2-year asset of 100,000. Okay, so you're going to pay your financial pre-tax income is 250,000. At 20% tax rate, I told you we're assuming the same rate all the years, is going to be 50,000. And the after-tax income, which we will show the shareholders, would be 200,000. Now, this would be declared 300,000. And guess what? No depreciation. Because the entire depreciation was given already in the previous year, right? In the first year. So the full asset is fully depreciated. Now you are going to pay taxes for a higher income, higher taxable income. So 20% of that would be 60,000. Okay. So what's going to be the entry? A credit tax payable, what you have to pay currently, right? That is 60,000. Debit tax expenses, what you're showing in the books. Debit tax expense, 50,000. So the debit is short of 10,000, right? So it's not tallying. So what we do is, actually it's a deferred tax asset. Okay. But since we already have a deferred tax liability, remember we have a deferred tax liability in year 1. So we will reverse that. It gets reversed. So debit deferred tax liability, 10,000. So what does this mean? It means that now we are paying more tax. Okay. So the liability we have booked now is being settled in the next. What the liability what we booked in year 1 is being settled in year 2. So that's what it means. So if we analyze as per financial books and tax books, for year 1, the taxes was how much? We can go to the previous page and see, as per the financial books, the taxes was 90,000 and for tax books 80,000, right? Okay. So year 1, financial was 90,000, tax books 80,000. And in year 2, financial was 50,000 and tax books, as you can see, 60,000. Right? So here it is 140,000. And here also in tax books also 140,000. So what has happened here? It was just a timing difference. In 1 year, we paid lesser tax. In the other year, we paid more tax than the financial tax expenses, right? So as per financial books and tax books, the total tax paid is the same. The total tax expenses is the same. Okay. So it was just a timing difference. That's why it was called a temporary difference. So what brings about a temporary difference? This depreciation brings about a temporary difference. It's not a permanent difference. So at some point or the other, it would enter the tax books or the financial books. Okay. So this is how a deferred tax liability is booked and reversed. There would be many such expenses which would give rise to a deferred tax liability. So you should be able to recognize which are those. Okay. So this class, I explained about deferred tax liability and how it gets reversed. In the next class, I would explain about deferred tax assets. Hello friends, and welcome to the class on deferred taxes. In the last class, I explained deferred tax liabilities, and in this class, I will talk about deferred tax assets. How does a deferred tax asset form, right? And what are the items which would cause a deferred tax asset, right? So what are the transactions rather which would cause a deferred tax asset? So all this we will be looking into in this class. So I will be giving you with the simple example, I will explain the concept to you. So we are going to talk about deferred tax assets. The shortened form for that would be DTA, deferred tax asset. So let us talk about year one, and we are talking about financial statements and tax, right? Tax books. Let us assume a revenue of 500,000. Okay. And let us assume a bad debts expense. Okay. A bad debt expense of what we call now a credit loss expense of, let us say 50,000. Okay. And for 50,000 would be our taxable amount. Now the bad debt expense or a credit loss expense, what will be the entry for that? The entry is going to be debit bad debt expense of 50,000 and credit allowance for bad debts or credit losses, 50,000. Correct? So this is how it's going to be. And then and then it's going to be taxed. So tax expense would be 20% of this. So that would be 90,000, and 360,000 would be the amount of income which we would show the shareholders. Now, when it comes to taxes, we would declare this. $500,000. Okay. Now, this one is an estimate. Now, IRS would not give you deductions for estimate. They would give you deductions for actual expenses. Okay, so bad debt expense or credit loss expense is an estimate. So unless it really gets bad, they are not going to give you a deduction. So there is, for bad debts or credit losses, nothing. Okay. And then you would be paying taxes on 500,000. You would pay a tax at 20% of 100,000. So when you are going to pay more tax than the financial books tax expense, okay, you're actually prepaying some amount as tax. So that gives rise to a deferred tax asset. So let's see how this works. The journal entry, credit tax payable by the amount you show in your tax books, because that is the current tax payable. Okay. Debit tax expense as per the financial books. Here again, we're assuming all the years the tax rate is going to be the same. It's not going to change in the next year. So then, to make debit and credit equal, we would book a deferred tax asset of 10,000. This is something like we have prepaid taxes by 10,000, right? So remember, this would be classified in the asset side as a long-term, non-current asset. Okay, because we really don't know at what point it would reverse. Okay, so now, how does it reverse? Let us assume that it reverses the next year itself for this example. Okay, so I'll go to the next page to talk about the next year. So now year 2 arrives. Financial books, tax books. Okay, so we would imagine any revenue or sales of, let us say, 300,000. 300,000. Now, the estimate of bad debts of 10,000, let us assume that it was actually not paid. First, it was an estimate. Okay, so when the customer goes bankrupt and they actually do not pay it, the entry in the financial books is going to be debit allowance for credit losses. I started by calling it bad debts. I'll put debit allowance for bad debts. the amount was how much? 50,000, I think, right? So 50,000, was it 50,000 or 10,000? Just a minute. Yeah, bad debt expenses was 50,000. Okay, so yeah. So we would debit bad debt allowance for bad debt 50,000. We won't debit bad debt expenses now because we have already made a provision for it, an allowance for it. So, and credit the customer. Credit AR 50,000 because we are removing it since they are not going to pay. Okay, so it's bankrupt. So here the P&L is not impacted at all. So bad debt expense, we will show nothing. The income statement doesn't get touched here. It's all balance sheet amounts. Okay. And we would pay taxes for 300,000. The tax expense would be calculated based on this. 20% of this would be 60,000 and 240,000 would be the income we would show the shareholders. Now revenue we would declare. Now listen carefully, guys. This amount which was actually not paid, if you show proof to the IRS, even a court order, proving that the company has gone to the courts, sued the customer in order to recover this debt. If such evidence is there, the tax authorities would give it to you as a deduction. So bad debt, actual bad debts. Okay. So that would be 50,000. They would give you a deduction on showing some kind of evidence, like a court proceeding, documentation, something like that. Okay. And then you would pay lesser tax. On a lesser amount, you would pay taxes. So that would be at 20%, and that would be 50,000. Right? So what's the entry? Credit tax payable by the amount you are currently going to pay. Debit tax expenses of 60,000. But since you already paid that amount earlier, so you would realize your DTA 10,000. So if you remember, in the last year, in the previous year, there was a debit of DTA 10,000, and that gets reversed as a credit 10,000. I assume that it gets reversed the next year. In reality, of course, the customer may prove to be bad after some time, right? And only then the DTA would be realized. So anyway, it is going to be categorized as non-current asset. So this is how the DTA gets reversed. Now, if you analyze the taxes for both years under financial books and tax books, they would be the same. In the year 2, you can see here, financial books was 60,000 and tax books was 50,000. So totally 110,000. Okay. And in the previous year, I'm sorry. I made a mistake here. Financial books. Yeah, okay, fine. And then here, financial books 90,000. Tax books 100,000. Okay. So year one, financial books 90,000, tax books 100,000. I'm sorry, I have done it wrong. Tabulation, I think, was wrong. Okay, so it should be as following. Financial books and tax books, year one and year two. So year two, we got financial books 60,000, tax books 50,000, and year one, financial books 90,000 and tax books 100,000. So financial books 90,000 and tax books 100,000. So the total taxes as per financial books and the tax books would be the same, but the timing would be different. In 1 year, you would pay 90, you show 90,000 in the financial books and 100,000 in the tax books. Next year, you'll show more in the financial books and lesser in the tax books. And that way, the total tax is the same. There's only a timing difference. That's why it's called a temporary difference. So this is how a deferred tax is formed and reversed, right? So I showed you both deferred tax liability and deferred tax assets. There are many items which cause deferred tax liabilities, not only depreciation in excess of financial books. There is bad debts, which cause, as you saw, a deferred tax asset. There is sometimes rent paid in advance. Rental income, if rent is paid in advance, it would cause a deferred tax asset. So there are many such examples. We have to analyze it this way to find out whether it causes a deferred tax asset or a deferred tax liability. There are various multiple choice questions to test you on this. So let us deal with it when we come to the multiple choice questions. Okay. So in the next class, I would talk about permanent differences. Hello friends, welcome to the lesson on accounting for income taxes. And in this class, I'm going to talk about permanent differences. Let me go to the text and explain the concept. So, what are permanent differences? Permanent differences are those which would either enter the financial books or the tax books, but not both. Okay, so as it's mentioned here, permanent differences are items that causes difference between taxable income and financial income, but do not reverse over time. Now, so far what you saw, the differences do reverse over time. Like, for example, excess depreciation given in tax compared to the financial books would get reversed. And also you saw the example of deferred tax asset, which I gave you, which was credit loss expense, which would at one time enter the financial books and then it would enter the tax books. But here, it will not enter, it will either enter the financial books or the tax books, but not both. And they do not give rise to any deferred tax assets or liabilities. You would see how with an example. When I show you with an example, it would be very clear. But here there is a very important note which you should get prepared for. So in an exam question, candidates might need to identify which are temporary differences, and among these temporary differences, which would give rise to a deferred tax asset or a deferred tax liability. I would do a multiple choice question on this to test that concept. And which are permanent differences that do not reverse and neither give rise to deferred tax assets or liabilities. Okay, so the most common is the municipal bond interest and the dividends received deduction, which we would discuss right now. Right, so let us, there are others also. See, because this is not a regulation class. So we are not going to study the regulation, the tax laws in detail. We would only study the accounting for it. So most of it, where it is regulation related, it would be mentioned in the question itself. You're not expected to know the regulation in CMA. It's out of the scope of the exam because we are not in a regulation is not one of the subjects in CMA. Okay. Now, the most common example of a permanent difference is a municipal bond interest. It's called Muni bond. And it's issued by the local government. Like, for example, the state of Detroit might issue actually a bond so that people can invest in the infrastructure. Actually, the government is borrowing from the people and people can invest in it. So as an incentive for the public to invest in such bonds, the interest given out by those bonds are not taxed. by the federal government. Right? So the income which would be entering the financial books would never be included in the tax books. Okay, so I'll just show you how it works on a whiteboard. So Muni bonds, interest, municipal bond, interest. How is it a permanent difference? It's very interesting to know. So in the financial books and in the tax books, how it will feature. Now, first of all, let us imagine some revenue, common, some other revenue, not bond interest. Let us say it is 500,000. Okay, and the same 500,000 would be shown. This revenue of 500,000 would be shown in the tax books as well. Okay, now let us assume a municipal or muni bond interest. Okay, and let's assume that to be 100,000. Right? It would be shown in the financial books, but it would not be shown in the tax books because it's exempt. Okay, so the taxable income is going to be 600,000, or is it 600,000? Actually, the income, pre-tax income is 600,000. Tax at 20% would be what? Now, I know many of you guys would say 100,000, but no. The tax expenses, because we know that this is not going to be taxed. So it would be wrong to show that as tax expense. We have to show the real thing in the financial books. So only this is going to be taxed. So 20% of this is going to be 100,000 only. 20% of only this 500,000. Okay, that is what we have to show as an expense, because that's the true expense. This is going to be exempt. Okay, and we know that. And the after-tax income, of course, would include this. The after-tax income will include including the municipal bond interest, because it's income, but it will not be taxed. That's all. So the after-tax income would be 500,000. Okay. I hope that is clear. So this municipal bond interest would not be shown as an expense. Now, it's wrong to say it's 20% now, the tax, because the effective tax rate has reduced. This is 100,000 over 600,000. So that would not be 20%. It would be 16%. So 100,000 divided by 600,000 as a percentage. This is not the rate of tax. The effective rate of tax is 16.67%. Similarly, in the tax books, this would never, municipal bond interest would would never ever enter the tax books. Not this year, not next year, not forever. Okay. So because it's exempt, and so 500,000 is the taxable amount. Tax paid at 20% would be 100,000. If you notice, it's the same as in the tax books, in the financial books. So the entry is going to be credit tax payable, the current tax, which is 100,000, debit tax expense, which is also 100,000, and there is no deferred tax asset or deferred tax liability. So this is how a permanent difference works. Municipal bond interest is one of the most common permanent differences. Let us deal with the other permanent differences in the coming sessions. Hello everyone, welcome to the class on taxes. Now we are going to study one more permanent difference, which is the dividend received deduction. So let us look at the rules for that. So this is the dividend received deduction. What does it mean? It means that when a company receives dividend from some of its investments. Now, one thing you should remember, don't get confused with dividends paid here. This is dividends received. When a company owns shares in a qualifying company and receives dividends, some of the dividends would be exempt based on the extent of ownership. So, what does the first sentence say here? First sentence says here that the dividend received deduction is applicable when a US company owns shares in another qualifying company. Now, this qualifying company, that means this dividend deduction, received deduction, is not available if a US corporation invests in any company. It should be certain companies only which qualify for dividend received deduction. Now, what is qualifying company? That is based on the US law. Okay, like they're given the footnote here. The criteria for being a qualified company, ownership of shares, percentage of ownership, and the deduct. If you own less than 20% and you get $100 dividend, only 50 would be taxed. Okay. So between 20 and 80% ownership, 65% of the dividend would be allowed as a deduction. So if you receive 100, you'd be taxed only for 35. If you own between 20% and 80%. And greater than 80%, the company owns more than 80% of the qualifying company, 100% of the dividend received would be deducted. So in other words, if you receive $100, you won't be taxed at all. So that's what it means. Okay. Now to give an example, let us say you own 20%, between 20% and 80% of shares in a qualifying company. And if you receive dividends of, let us say, 320,000, right? 320,000 you would be receiving. So then how much would be taxed? What would be the tax that you will pay? Okay. So let me show that to you in a whiteboard so that you understand properly. So your ownership is between 20 to 80%. Okay. And dividends you receive 320,000. Okay. So in the financial books, in the tax books, what would it be? Let us say you have other revenue from your usual business as 500,000. So that same thing you would declare here. Okay. Then you got 320,000 dividend. 320,000 dividend. Okay. 65% would not be taxable. 35% of it would enter the tax books. Okay. So 320,000 into 35%, 112,000 would be taxed. Okay. And then your taxable income, not exactly fully taxable, your pre-tax income is 820,000. Okay. Tax, I'm assuming tax to be 20%. So how much will be taxed? How much should you show as tax expense? You will show 20% of this entirely, plus only this portion you will show as expense. Okay, so 500,000 plus 112 is 612,000 into 20%. So that would be your tax. 122,400. That will be your tax. It's not exactly 20%, so we'll remove this. Okay. The effective tax rate would be 122,400 divided by 820,000 as a percentage, approximately 14.93. That's the effective tax rate. Okay. And you will show the shareholders. Okay, I'm sorry. Okay, 122. Yes, 820 minus 122.4. This would be the income you would show the shareholders. Now here, what will be the tax? Your taxable income will be 612,000. Okay, you'll be taxed. I'm assuming it to be 20%. So how much will be 612,000 into 20%? It'll be same as the financial books. So the entry would be credit tax payable, what you have to pay, and debit tax expense as per the financial books. There is no deferred tax assets or deferred tax liability because the exempt portion of the dividends, or that is 65% of the dividends, would never ever enter the tax books. It's a permanent difference. Okay, so there would not be any deferred tax asset or liability. So this is just a demonstration of one of the dividend received deductions. Okay, I hope that part is clear with this demonstration. And now, if you read the text, you would understand it better. You would understand it better. So when the investor owes more than 80%, none of the dividends he receives would be taxable. So in the tax books, no dividends are included. But in the financial books, the dividends will be included, but the tax expense related to those exempt dividends would not be included in the tax expenses. Okay, so that is about dividend received deduction. We would talk about the other permanent differences in the next session. Hello, friends. In this session, we'll have a look at more permanent differences where deferred taxes are concerned. Let us go to the text. So I have already explained to you the most common one of permanent differences, which is the Muni bond interest and dividend received deduction. Out of this, the municipal bond interest is more tested than dividend received deduction, but you should know it since it's included here. And I think the rules pertaining to it, it's my personal opinion, the rules that ownership and the amount deducted would be given to you in the question. I don't think you have to memorize this. I don't think. But anyway, I put it in a small, simple table for you in the last session. So you can brush it up time and again, and you might remember it. Okay, so now what are the other expenses, other permanent differences? Any expenses incurred to earn a tax-free income is not deducted from net income. Okay, it's not tax exempt, in other words, or not tax deductible, in other words, right? So expenses incurred in the process of earning a tax exempt income are not deductible for tax. It makes sense, because if the income is not taxed, the expenses pertaining to it should not be given as a deduction, right? So then, a life insurance premium paid by a corporation. This is what is called key employee insurance. That means the company is insuring one of its key employees, the most important employees. For example, like Steve Jobs in Apple. Okay, the corporation, the company, Apple Corporation, is buying a premium, a life insurance premium on Steve Jobs, so that the company would pay the premiums, and in case the key employee dies, his family will not get the compensation, the insurance proceeds. The company would get. It is to it is actually compensate for the losses which the company would incur because the key employee is no more. Okay, so this is an example. That is, the life insurance premium and our life insurance proceeds are an example to show that expenses incurred in the process of earning a tax-exempt income are not deductible. That means the company would not get a tax deduction for these insurance premiums. At the same time, when the employee dies, the insurance proceeds would not be taxed. Okay, let me demonstrate this to you. On the whiteboard, so that you can understand the concept better. So let us talk about financial books and tax books. Let us talk about revenues, some other revenues, the usual revenues by the company, what the company earns, 500,000. Okay, and that would be declared 500,000. And now the key insurance premium, the key employee insurance premium. Okay, so that would be an expense. Let us say that expense is 50,000. $50,000 in a year. A sizable premium, no doubt, because the proceeds also could be sizable. 450,000 is the pre-tax income. Tax at 20% would be how much? Don't say 450 into 20,000, 20%, 90,000. No. this is not going to be allowed as a deduction. So the tax expense would be 20% on 500,000. So that would be 100,000. And 350,000 would be the income shown to shareholders. But it is a deduction here from the net income, from the revenues, because the expense has been incurred. Only thing is not allowed as a tax deduction. Now, when you're making your tax books, this would never come. It's a permanent difference. It would never enter the tax books. So you will pay tax on 500,000, not 450,000. So you'll pay tax at 20% of 100,000. By the way, this is not the effective tax rate. The effective tax rate is more now, 100 divided by 450, because one of it is not given as a deduction. So it's approximately 22.22%. Okay. So now what's the entry? Credit tax payable 100,000 and debit tax expense as per the financial books 100,000. There is no permanent, or there is no deferred tax liability or an asset. I hope that's clear to you. Now, in the next page, I'll just show you when the proceeds are received. Maybe the person passed away for whom the insurance has been taken. And then what happens? Let us see. Let us say financial books, tax books. Let us take a regular revenue from the usual operations as anything as we like. Let us say it is 600,000. The same would be declared, 600,000. Okay. Now the insurance proceeds because the key employee passed away. Let us put it at 1 million. Could be more. Okay. So 1.6 million is the pre-tax income. And what do you think would be taxed at 20%? Only this, because this is the proceeds is tax-free. Okay. So 20% of that would be 120,000. But the income after tax would include 1 million, right? Because that's what the corporation received. The financial books tells you the truth. It's the correct picture. 120,000. So 1,480,000 is the income after tax shown to the tax holders. Again, this 20% is not the effective tax rate. The effective tax rate would be 120,000 divided by 1.6 million as a percentage as low as 7.5%. That's the effective tax rate. By the way, in the tax books, what is happening? 600,000. Would you include this insurance proceeds? No, it's a permanent difference. It would never enter the tax books. So then you are taxed for 600,000. You are taxed for 600,000 and they will pay tax at 20%, which I'm believing which I'm assuming 120,000. The entry is going to be credit tax payable, what you would be paying currently, and debit tax expenses, what you are showing in the financial. No permanent, no temporary difference, no deferred tax asset or liability is shown here. Okay, because it's a permanent difference. Going back to the text. So I showed you, I demonstrated to you the life insurance premium paid is not deductible, never deductible, and insurance proceeds received are never taxable. I demonstrated to you. Similarly, any penalties paid in violation of the law would not be given as a deduction. But in the financial books, it would be deducted. But in the tax books, it would not be deductible. Just like I showed you for the premiums, which was not deductible. Client entertainment is not at all allowed as an expense in income tax books. However, you will show it is in the financial books because that reduces income. And employee compensation in excess of $1 million would not be shown as a deduction in the tax books, but in the financial books. Suppose the employee is getting 1.5 million. You would show the entire 1.5 million in the financial books as a deduction. It reduces net income. Okay, like for example, I'll just show it to you here. Suppose you have revenues of, let us say, 5 million. Okay, in the financial books, and employee compensation, employee salary, one employee salary, let us say, is 1.5 million. So that would be shown there. 3.5 million would be the pre-tax income. But in the tax books, you will show this 5 million. And here you will show only 1 million. Anything over 1 million is not allowed as a deduction. So your taxable income would be 4 million. I hope you got the concept. Okay. And any entertainment expense or client entertainment expense is not allowed. Okay. So that's what it's all about. So these are some of the permanent differences. There may be many more, but it's sufficient. As I told you, this is not a regulation class. So it's an accounting class. So most probably they would tell you the permanent differences in the question itself. You may not have to memorize it, but still, we really don't know how they frame the questions. Okay, so better know it. Since it's included in your study material, right? So those are the temporary and permanent differences. I explained the concept of how a deferred tax liability is formed and how it gets reversed, deferred tax asset, how it is formed and how it gets reversed, all the permanent differences. I think now you're ready to handle multiple choice questions, which we would do it in the next session. Hello, everyone. Welcome to another session on deferred taxes or accounting for income taxes. In this class, I'm going to talk about the asset liability method of accounting for income taxes. So I will show you the whiteboard and take it from there. So here, let us assume year one. So this is year one. And we are going to have, let us say, an asset of fixed asset of 100,000, estimated life 2 years, method of depreciation, straight line method. Okay, for straight line method. And let us assume that, let's remove this for a moment. So let us assume that the tax rate in year one, tax rate is 20%, and year two tax rate is 30%. We have not dealt with concepts like this so far. Always when I have given examples for deferred tax asset or liability, it has been the same tax rate throughout. Okay, now the tax rate is differing. And now let us talk about year one. Okay, in year one, financial books and tax books. Okay, so let us assume some revenue, other revenue of let us say 500,000. Okay, and financial book depreciation would be 50,000 because we are not assuming any salvage value here. 100,000 divided by 2, 50,000. 450,000 would be the pre-tax income. Tax rate is 20%. But let us keep it for the moment, not do anything about it. Okay, I will not calculate right now. Fine. So even I would not even put 20% there. You will see why. Okay, now in the income tax return, we would actually file 500,000. Let us assume now that depreciation for tax purposes, they're allowing the entire amount. It's an accelerated depreciation usually for tax purposes. So let us say that they are allowing the entire 100,000 as a deduction. So you are going to pay taxes for 400,000. Okay. The tax rate for this year is 20%. Okay. So now we would pass the following entry. We would first record all the liabilities or assets. And then the plug-in would be the income tax expense. So that is the asset liability method. So what's the liability first here? Credit tax payable with the current tax payable. Okay, the current tax payable will be 400,000 into 20%, which is 80,000. In fact, I can put here directly 20%, 80,000. Okay, so 80,000 would be the current tax liability. Okay, the deferred tax is always the difference between the item causing the deferred taxes. Okay, so here it's 50,000. Since tax is giving a higher deduction, there is going to be a deferred tax liability because you will have to pay this tax sometime or the other. Okay, since now the tax payable is lesser than the financial books. Okay, so it will catch up sometime or other. It's only a temporary difference. We will have to pay tax for this extra deduction which income tax is giving now. Okay, so this into, now please note what I'm trying to say here. Now we are going to book the deferred tax liability at the future enacted rate. So we know, suppose we know the future enacted rate is going to be 30%, we should book deferred tax liability because we would be paying, once this liability reverses, we would be paying at 30%, not 20%, because that's the future enacted rate. So 30% of 50,000 would be 15,000. So that is the amount we are going to pay income tax. Okay, so we are recording the liability. Credit the DTL 15,000. And now the plug-in figure would be tax expense. Previously, I used to show you like we put the tax payable, okay, and debit tax expenses as per the financial books, and the balancing amount was to be the deferred tax asset or liability. But now, when the rates differ from year to year, we actually follow the asset liability method by booking the assets or liability and plugging in the income tax expense. So income tax expense is 95,000. 95,000. Not 90,000. If it is taxes 20%, it would be 90,000. So it's 95,000. So the effective tax rate, as you can see, is not 20%. It is 95,000 divided by 450 as a percentage. It comes to slightly higher than 20%. And we would report to the shareholders an income of 355,000. So this is how we would actually record based on the asset liability method. Now let us go to year 2 and see how it reverses. It's very important to know how this 15,000 of DTL would reverse. Okay, remember year 2 rate is going to be 30%. So year 2 tax rate, I'll put it here itself so that we don't forget 30%, not 20%. So now in financial books and tax books, assume any income as we like, revenues to be, let us say 300,000. You can even assume 1 million. Okay, so it's no issue. Depreciation, if you remember, it was a 2-year asset with a straight line depreciation. So you would have in the year 2 also, you would have a depreciation of 50,000. You'd pay tax 250,000. You pay tax for 250,000. Tax rate now, if we are assuming it all going to be the same, we can do it the way we were doing before. Anyway, 300,000. There is not going to be any depreciation here because it was already given 100% in the first year. So we are going to pay more taxes here now. Tax at 30% is going to be 90,000. So 300 into 30, just verifying. So it's 90,000. So now we'll credit tax payable with the current tax payable, which is 90,000. Now we can we can actually confidently, since we are assuming now all the future taxes is going to be the same. Okay, so here it's going to be 250 into 30%, 75,000. We are going to pay lesser, showing lesser tax expense here. We'd report 175. So 250 minus 75, 175,000 to the shareholders. Okay, so tax expense as per the tax books is going to be 75,000. And to make it equal, debit and credit, actually it's a deferred tax asset but since we already have a deferred tax liability of 15,000, that gets reversed now. Okay, perfectly. And this is how the entry is going to be. Okay, so when there is differing rates between years, tax rates are different, then it's better to make the accounting by the asset liability method, book all the assets and liabilities, and the deferred taxes would be at the future enacted rate. Can be a deferred tax asset or a deferred tax liability. It would be at the future enacted rate, and the plugin to make debit and credit agree or tally would be the tax expense. When the rates are going to be the same throughout all the years, we can just book the current tax payable and debit the tax expense as per the financial books, and the plugin would be the deferred tax asset or liability. So this is how you would do it. And if you notice that the 15,000 liability gets reversed. Okay, by the way, this taxes which we show in the financial books are, I'll show it to you properly, are actually can be split into two: current tax payable and deferred tax payable. Okay, so this can be split into current, which is actually what you'll pay now, 80,000. Okay, and deferred that went a little too much. So deferred would be deferred would be 15,000. So this is how you can show the income tax expenses in the financial books. So that's it. That's the concept I wanted to tell you about the asset liability method. Now we are all set to answer some multiple choice questions, which we would do it in the next session. Hello friends, welcome to a multiple choice session on accounting for income taxes. So let's go to the question bank directly. Yes. Take your time, read this question, and try to answer it by yourself. Okay, so the question, always look at the last line, even in the exam, so that you're focused on what is being asked, and later on, read the entire thing. So he's asking what's the deferred tax liability in the first year end. Let's see. They purchased the machine on January 2020. Okay, so I'm just assuming 2020. You can assume anything you like. And it was for 100,000. It uses straight line method for financial statement purposes with a 5-year life. And uses 3-year modified accelerated cost recovery system. This is the depreciation with IRS, which IRS allows. That is the Internal Revenue System, the US Taxation Authority. And it has a half-year convention. So it's actually the rates are adjusted to the half-year convention. We don't have to do anything about it. Okay. And later on, it says that it's subject to a 35% marginal income tax rate. There's no deferred tax liability at the beginning. So, and it is in a positive earnings position, that means it has profits. So what would be the deferred tax liability? Now let us see for financial books and tax books. For namesake, we can put some income as we like revenue 300,000 maybe. Okay. For tax also it would be 300,000. Now depreciation as per financial books would be, where can I calculate? Yeah, 100,000. No salvage value by 5 years. So that's 20,000. So 20,000 depreciation. Okay. In fact, we don't have to put the revenue. We can directly do it, but just to give you a better idea, I'm assuming some revenue. By the way, let me reiterate here, repeat. The revenue is assumed. It's not given in the question. Okay. So in under, for tax purposes, it would be at 33.33%. So that will be 333,333 because the equipment is 100,000. Okay, so this will be to 80,000, and this is going to be 300,000 into minus 33 and 333. Okay, so it would be approximately 266,667. This is the taxable income. Now the tax rate is going to be 35% in future also. So I'm just going to put here directly 35%. So 280,000 into 35% is 98,000. And here, since they're given more deduction, it's going to give a deferred tax liability. Into 35%, that is approximately 93,333. Okay, so this is the tax payable as per the current tax payable at 35%. So we would book it this way: credit tax payable 93,333, debit tax expenses as per the books, which is 98,000, and credit DTL, deferred tax liability, 98,000 minus 93,333. It's going to be 4,667. Okay. See, I didn't have to do all this. I just did the whole entry and showed you the whole thing just for you to understand better. So now the answer for this is D. Because they asked you what's going to be the deferred tax liability, which is 466, 4,666. Okay, so D is the right answer. We can do it this way. Since, see, this is the cause for the deferred tax liability, because tax is giving a higher deduction than the financial books. So we have to pay that tax sometime in the future. So what's the difference? The difference is 13,333 multiplied into the future enacted tax rates. This would cause the deferred tax liability, right? This extra deduction. So since we are assuming 35% to be for all the years, book it at 35%. That's going to be our deferred tax liability. So 13,333 into 35% would give us the same. Approximately 4,667, right? So this is how deferred tax is calculated. I hope the concept is clear. But what about the next year? So let's now go beyond what the question is asking for us to understand some concepts better. Okay, so now don't forget, there is a deferred tax liability of 4,667, right? So let me just put that down in an account form. A DTL of 4,667. What about the next year? Next year also in financial books, it would be 20,000. The depreciation part. I'm talking only about the depreciation. I'm not assuming all income incomes, revenues, etc. We'll do it directly. In tax books, it's going to be at this rate. Okay, so that would be 100,000 into 44.45%, which is going to be 100,000 into 44. 100,000 into 44.45%. It's going to be 44,450. This is going to be the depreciation as per tax books. Since tax is giving a higher deduction of 24,450. So this is year one. Okay. So 24,450. We would book, assuming 35%, right? Going to be in year two as well. So it's going to increase. If you notice, the deferred tax liability is going to increase. I'm going to round it off. It is 8557.5. I'll put it as 8558. Right? So this would be the tax liability for year two. Now, year three, financial books is going to be 20,000. Again, because it's 100,000 divided by 5. This is the depreciation we are talking about. And tax books is going to be probably at a lesser rate, which is 100,000 into 14.81%, which is 14,810. Now, since tax is giving a lesser deduction than the financial books, lesser depreciation, a deferred tax asset is created. Okay, so the difference is 5,190 at 35%. So actually it's a deferred tax asset, but approximately 1817. Okay, but since we have a liability here, we would actually debit. So from this year onwards, it's going to get lesser. The deferred tax liability is going to get lesser. Okay. First it increases and then it is reducing. Now, if you're going to year four, we don't have to do all this in the exam. Please note. Okay, this is for you to understand how deferred tax liabilities get reversed eventually. Okay, so this year four, we would have financial books, tax books. The depreciation in financial books is still going to be the same. Okay, tax books, the year four, a little bit of depreciation comes at 7.41. So it's going to be 100,000 into 7.41%, which is actually 7410. Again, a deferred deferred tax asset because tax depreciation is lesser and financial depreciation is more. The difference is 12,590 into 35%, which is going to give us approximately, I'm rounding off, so you may not get, it may not reverse exactly, but this much rounding off is required. So year 4, it is going to be 4407. Okay, now year 5 is interesting. So year 5, under financial books, there would be still a depreciation of 20,000. Because it's a 5-year asset as per financial books. Whereas under tax books, finished, they are given the entire deduction. If you add up all this, it would come to 100%. Right? So it's given. So they don't give you anything. The difference of 20,000 would cause a deferred tax asset, but since we have a liability, we are going to debit that at 35%. So 20,000 into 35% is 7,000. So year 5, it is 7,000. Okay, now let us see what is the debits and credits coming to. Has it fully reversed? So debit side 8174407 and 7,000. It is 13,000 13,224. And on the credit side, when the liabilities were increasing, it is 4467 plus 8 plus 4467 plus 8558. I'm getting a difference. Let me just do it again. 4667 plus 8558. Yeah, it is 13,000 225. A $1 difference. That is due to rounding off. Okay, we can debit the last year 7,001 maybe. Okay, and then that would agree. So this is the way it entirely gets reversed and the DTL would become 0 in the future. So first it would increase and later on decrease. I didn't have given you all this. It's not required for the exam, but it's required to understand. Right? Even if it comes in the exam, it's not required. You have to just find out for the first year, which this is the answer. But for you to get a better idea, I showed you for all the years and how it eventually gets reversed. Let's do more questions in the next session. Hello everyone, welcome to one more session on MCQs on deferred taxes or accounting for income taxes. So there are some questions here. The concept which I have already explained in my previous videos. For example, the asset liability method I have mentioned in the previous, I've discussed in my previous video. It asks you here which one of the following statements describes the asset liability method of accounting for deferred income taxes. So basically, asset liability method would be done when the tax rates are differing from year to year. Okay, so he's talking about A, the amount of deferred income tax is based on tax rate in effect when temporary differences originate. No, it would be booked at the future enacted rates, right? So that would be wrong. And B, the amount of deferred income tax is based on the rates, tax rates expected to be in effect during the period in which the temporary differences are expected to reverse. This is correct. And I showed it to you clearly with one example of how we book at the future enacted rates and how that eventually reverses, right? I've shown you both. You can refer to my previous video explaining this. And the video would be captioned asset liability method. Okay, so what does C say? C says that tax effects of temporary differences are not reported. It's wrong. It's reported as a deferred tax asset and deferred tax liability. It's not adjusted with specific assets and liability. This is wrong. The appropriate tax rate to be reported on the income statement is the tax actually levied in the year, meaning there are no deferred taxes. This was how it was reported before the standard on deferred taxes came into being, right? Before that standard was established, whatever was reported, whatever was going to be paid as income tax was reported as tax expenses. But now, with the standard, the future tax liability or asset is also shown. Initially, there was a great resistance for by the industry to adopt or to use this standard, because they have to show huge liabilities, which makes that balance sheet look a little weak. So they were avoiding this. They were protesting against it. But anyway, ultimately, the standard makers won the battle and deferred taxes started being applied. So now, let us go to the next question. And the next question, it says that a company has purchased a 10-year useful asset. It uses an accelerated method for tax purposes. Usually that's the case. For financial reporting purposes, it uses a non-accelerated straight line method because it's believed to reflect usage of asset more properly, right? So during the 10-year of the asset, the company will report a deferred tax an amount. First of all, it would report a deferred tax liability. They're not mentioned here clearly. Right? Deferred tax asset or liability, but it would report as a deferred tax liability an amount which first increases. If you remember, we did a question wherein I demonstrated to you, even though they had not asked us to demonstrate anything in that question, but I showed you how it initially increases. The deferred tax liabilities initially decreases, and then soon the book depreciation would be more than the tax depreciation, because what's accelerated depreciation method do? More charge in the initial years and lesser charge during the last ending years. Okay, so the deferred tax liability would increase initially and then decrease, and it would become zero eventually. The deferred tax liability would get fully reversed by the end of the 10-year useful life. C is the right answer. We'll do more questions. I will select more questions on deferred taxes in the next session. Hello, friends. Welcome to one more session on MCQs on deferred taxes. I'm doing many questions on deferred taxes because this topic is considered difficult and students struggle in it. So I'm going to give plenty of explanation and plenty of practice for you for the MCQs. Other than what I do in class, you have to work out independently by yourselves and see if you can get the correct answer. So let's go to the questions. So word question, so should be quite easy if you understand the concept. Temporary and permanent differences between taxable income and pre-tax financial income differ in that temporary differences do not give rise to future taxable. Future taxable is DTL, deferred tax liability, or future deductible amounts is DTA or deferred tax asset. They say do not give rise. It gives rise. They do give rise. Okay. So this is not correct. Only permanent differences have deferred tax consequences. Actually, permanent differences do not have deferred tax consequences because they never enter into the taxable income, right? So this is not correct. Only temporary differences have deferred tax consequences, which is correct, which can give rise to either deferred tax liability or deferred tax asset. I've shown you many examples in my previous videos. So it's the temporary differences which causes deferred taxes. Temporary differences include items that enter into pre-tax financial income, but never into taxable income. This would be correct if it was permanent differences. For example, municipal bond interest, it would enter into pre-tax financial income, but it would never enter into taxable income. So it's a permanent difference. So this D is correct for permanent difference and not for temporary difference. So C is the correct answer. Only temporary differences give rise to deferred tax consequences. Let us go to the next question. I have spoken about tax rates being different in some years, right? It may not be always the same. So a tax rate other than tax rate may be used to calculate deferred income tax amount. I've shown you that with a simple example in my previous videos. So a tax rate other than the current tax rate may be used to calculate deferred income tax amount on the statement of financial position. When do you do that? You do it if a future tax rate has been enacted into the law. When I was explaining this concept, I also mentioned it that the future enacted tax rate is used to calculate deferred tax assets or liability. Not when it is more likely than not. Okay. Election has been made to apply past rates. You cannot do that. You cannot do as you please. Okay, it will not give the correct picture. Net, it's nothing to do with net operating loss carry back existing. Okay. So the carry back of net operating losses is no longer in the law. They do not allow carry back these days. Okay. The future, the amended tax law says it can only be carried forward. The losses can be carried forward. I'll be discussing net operating loss and its tax effects in the future sessions. So that is about it. Let us go to the next question. Let us go to the next question. So the next question, these are the kind of questions you can expect in the exam. What would give rise to a deferred tax liability, or what would give rise to a deferred tax asset? So these are the questions they would be asking you. Okay. Now, what would give rise to a deferred tax liability? If you see C, when I was explaining the concept of how deferred tax liability is formed, okay, how does it come into existence? That I explained when I was in my previous video sessions, when I was explaining deferred tax asset and deferred tax liability. So when in financial books, it is non-accelerated depreciation, but an accelerated depreciation for tax purposes. So at least initially, there's going to be a deferred tax liability, which would later on get reversed. So C is the correct answer, which means that all others some. Now, for example, A is a permanent difference. There is no DTL or DTA here because dividend received deduction on an income tax return, okay, before it's reflected in the financial income. Actually, the dividends would be shown in the financial income if it is from a qualified company, but it would never come in the income tax return. So this is a permanent difference. It does not give rise to deferred tax asset or liability. A capital loss shown in financial income, but not in tax books, would give rise to a deferred tax asset. Let me just show it to you here. Suppose we have in the financial books revenues of 100,000. Okay, a loss, a capital loss, he says, right? Let us say of 50,000. And you're going to show 50,000 and you're going to pay, let us say, taxes for 20%. Okay, so 20% would be 10,000, and 40,000 you would report in your financial books. However, in tax books, if they do not allow it, at least for that year, later on they might allow it. Okay, so at least for that year, when they do not allow it, it gives rise to a higher taxable income, and you would end up paying at 20%, 20,000. Okay, so credit tax payable, 20,000, the current tax payable, assuming that it's going to be the same tax rate in future years. Tax expense, 10,000 as per the financial books. And it gives rise to a deferred tax asset of 10,000. Because when you pay more tax than you show as expense in the financial books, it means you're sort of prepaying those taxes. So it gives rise to a deferred tax asset. Right? And similarly for warranty cost. See, warranty expenses are not shown as a deduction. Accruing warranty expenses, estimated warranty expenses are not shown in the financial books. I'm sorry, is not shown in the tax books. Right? So that time it would give rise to a deferred tax asset, because warranty, suppose we have a revenue of 100,000 again in the financial books, warranty expense is accrued and estimated. So that estimated expenses cannot be shown on the tax returns. It should be actually incurred for it to be shown. So it would reverse. The deferred tax asset would be realized once the actual expenses start coming in, actual warranty expenses. So say a warranty expense of, let us say, 20,000 would actually be shown in the financial books, and tax expenses would be calculated on it. I'm assuming a 20% tax. Okay, so that would give us 16,000. It would be shown here, but in the tax books, it will not be shown. No estimated expenses are shown. So you'll end up paying taxes for this 100,000 at 20%, let us say. So it's 20,000. So when you pay more taxes than what you show as expense in the financial books, you're paying the tax of 4,000. Okay, so this would give rise to a deferred tax asset. So I've shown you in my previous video sessions also that these a straight line method for financial purposes and an accelerated method for tax purposes gives rise to a deferred tax liability. So C is the right answer. So these questions are quite common. So you should do plenty of these kind of questions to identify a deferred tax liability or deferred tax asset as asked in the question. And I would suggest you to do all the wrong answers to know why they are wrong. For example, we can directly see that from the examples I've given you in the past, that this would give, C would give rise to a DTL. it doesn't mean we should ignore the other answers. We should find out what is the type of transactions in A, B, and D, and find out what they give rise to, whether it gives rise to a deferred tax asset or whether it can be just a permanent differences giving nothing, right? So all that should be very thorough and not only mark the right answer. At least that's what you should do while studying. In the exam, probably you can just mark the right answer if you are sure of it and proceed. We'll do more questions in the next class. I have a more challenging question, which I would like to do. And then we would go to carry forward of losses, of operating losses. Hello, everyone. Welcome to the lesson on deferred taxes and multiple choice questions. In the previous sessions, we have done multiple choice questions on deferred taxes. And here is one more question, which I felt should be explained because it has a lot of concepts to be learned from this question. So let us go to the question. I would suggest that you pause the recording. Try to do it by yourself. And then later on, look at the explanation. So it says that there is a gain of 80,000 for the sale of real estate. And 2004 financial statements or income statements includes that gain. Okay, so this income before taxes includes that gain of 80,000. For which Lally financed the sale on a short-term note. That means he received this money with a short-term note, and the company received it fully from the buyer in 2 installments during